I thought that I had underestimated the impact of the forces that had diminished market stability. What was your percentage loss during October 1987? I was down over 20% for the month. As you look back on the October 1987 experience, are there mistakes that you believe you learned from? There is a very good investor I speak to frequently who said, "All I bring to the party is 28 years of mistakes." I really believe he is right. When you make a mistake, there is some subconscious phenomenon that makes it less likely for you to make that same mistake again. One of the advantages of trading the way I do, being a long-term investor, short-term trader, individual stock selector, market timer, sector analyst, is that I have made so many decisions and mistakes that it has made me wise beyond my years as an investor. The typical mutual fund adheres to a buy and hold approach. Do you think that concept is basically a flawed strategy? Yes, although flawed isn't quite the word I would use. I would say it is too limiting a strategy. The objective of 82. Participating in the long-term growth of American equities, willing to suffer through those periods when equities decline, is fine, but it leaves so much on the table in terms of potential professional management. It is an incomplete strategy. Yet, the vast majority of all funds fall into that category. I guess so, but less than before. More and more people are paying attention to market timing, not that they are necessarily qualified to do it terribly well, but because they have come to recognize what a buy and hold approach means. When I was a kid, it was common advice to buy a stock, put it in a vault, and forget about it. You don't hear that sort of concept anymore. We have lost confidence in the long term. Do you think the mutual fund industry is going to change? The mutual fund industry is certainly sensitive enough to the whims of the investing public to find products that will meet contemporary needs. How do you handle a losing period? As is true for so many other questions in this business, there is no pat answer or formula. There is nothing that can be articulated precisely enough to lead others in a certain direction. In other words, one losing period may be sufficiently different from another so that, even for yourself, there may be no general wisdom that applies. Correct. How did you get started as a fund trader? When I first got into this business in the late 1960s, I only had an analytical background. I was an agricultural equipment and cyclical goods analyst at Loeb Rhodes. My business was started with two other fellows who were also analysts. As our business grew, trading became more important. I became the trader for the firm, having had very little trading background. If you had very little experience, why did you become the trader? I probably wasn't as good an analyst as the other two. Even in those early years, you did very well as a trader. How do you think you managed that? Without benefit of experience? My father has been a gambler all his life. Although I can't remotely justify it, I feel there is an element of gambling in this business. Maybe I got that talent from my father. You have traded the stock market for over 20 years. Have you noticed any significant changes during that time? The amount of intellectual power on the trading desks 20 years ago was minimal compared to today. The institutional traders were typically kids from Brooklyn, who could hardly speak the language, made a minimum amount of money, and had very little discretion. So when I first started trading, it was like taking candy from a baby. I remember once a trader needed to sell 700,000 shares of Penn Central. At the time, the stock was already in Chapter 11. The last trade was at 7, and the seller didn't bother to check the board. I bought 700,000 shares at 6/8. The seller was relieved to sell that amount of stock at less than $1 under the last trade. Meanwhile, I turned around and sold the 700,000 shares at 61.1. Could have sold 3 times that amount at that price. I made a $500,000 on that trade, and it took me all of 12 seconds. How long did that environment last? Until the consolidated tape in 1975. Now there is a lot more competition, the people on the trading desks are much brighter. Another change is that retail buyers and sellers have diminished greatly in importance. The market has become institutionalized. Individuals buy stock through mutual funds. Brokerage firms don't sell customer stocks so much as they sell those horrible mutual funds and other awful things they call financial products. Perhaps the most important change is that the world has become much more short-term oriented. All sorts of people who used to be investors are now traders. The institutions now define themselves as enterprises whose goal is to achieve the highest rate of return, when they used to define themselves as long-term investors. People's confidence in their ability to predict secular trends has greatly diminished. In 1967, it would be typical to see a report by a brokerage firm estimating McDonald's per share earnings up to the year 2000. Those people thought they could estimate long-term earnings because companies were growing in a stable and predictable way. They believed in America and steady growth. Today, stocks don't lend themselves to the same type of secular analysis. The implication of secular growth trend analysis not having worked in the 1970s and 1980s relates to the question of trading. In the 1950s and 1960s, the heroes were the long-term investors. Today, the heroes are the wise guys. There are people like Goldsmith, who lauds the virtues of capitalism. He talks about what I did for Goodyear. What did he do for Goodyear? He was in there for 7 months, made $8 zillion for himself, and left the management after taking Greenmail. He talks about what he did for Goodyear, because he is uncomfortable and has to somehow associate himself with the capitalist process. He and these other people have to bitch and moan about management, but they don't know their ass from their elbow about running companies. With the breakdown of certain laws, people are allowed to do things they weren't allowed to do before. What laws are you referring to? The Justice Department's reinterpretation of takeover laws, the definition of what is and is not monopolistic. What would be the most important advice you could give to the layman? One of the allures of this business is that sometimes the greatest ignoramus can do very well. That is unfortunate because it creates the impression that you don't necessarily need any professionalism to do well, and that is a great trap. So the major advice I would give anybody is, recognize that this is a very competitive business, and 83. That when you decide to buy or sell a stock, you are competing with people who have devoted a good portion of their lives to this same endeavor. In many instances, these professionals are on the opposite side of your trades and, on balance, they are going to beat you. Is the implicit message that, most of the time, the novice trader would be better off having his money professionally managed? The term professionally managed implies a credit I am not sure I would give the average professional in this business. My point is that you should have a good reason to assume that you are going to achieve a significantly superior return for investing in stocks. If you can get 9% or 10% by investing in T-bonds and 7% or 8% by investing in T-bills, what should you get in stocks to offset the incremental risk? Probably something much higher. You have to decide what that number should be, and whether you have a realistic chance of achieving it. Don't underestimate the difficulty of the game. Right, and forget the shibboleth that stocks are going to give you a higher rate of return because they are more risky. That is not true. They are more risky, therefore, you have to be convinced that you are going to get a higher rate of return in order to play the game. Don't assume that by investing in some mutual fund, you are going to get a higher rate of return. Isn't that true, though? Historically, hasn't the stock market significantly beat interest rate returns? True, but there is a lot of statistical mumbo-jumbo involved. Average return calculations depend heavily on the starting date, If you start in 1968 or 1972, for example, the numbers look a lot less appealing. What are the elements of good trading? Good trading is a peculiar balance between the conviction to follow your ideas and the flexibility to recognize when you have made a mistake. You need to believe in something, but at the same time, you are going to be wrong a considerable number of times. The balance between confidence and humility is best learned through extensive experience and mistakes. There should be a respect for the person on the other side of the trade. Always ask yourself, why does he want to sell? What does he know that I don't? Finally, you have to be intellectually honest with yourself and others. In my judgment, all great traders are seekers of truth. Steinhardt's variant perception is basically a contrarian approach. But you can't be a successful contrarian by just using sentiment survey numbers or other measures of bullish consensus. The markets don't pay off that easily. Although sentiment is always very bullish at tops and very bearish at bottoms, unfortunately, extreme bullish and bearish readings are also characteristic of extended trends. The trick is not being a contrarian, but being a contrarian at the right time. Such judgments cannot be made on the basis of simple formulae. The successful contrarian needs to be able to filter out the true opportunities. Steinhardt's filters are a combination of a keen sense of fundamentals and market timing. Flexibility is another essential key to Steinhardt's extremely favorable return/risk performance characteristics. This flexibility is demonstrated by the equal ease at which he goes short or long, as well as his willingness to trade markets other than stocks when warranted by his perception of the fundamentals. The more things you bring to the table, shorting, hedging, participation in bond markets, futures market trading, and so on, the better off you are, he says. One trait I have noticed among a number of the great traders is their willingness and ability to take on a particularly large position when they perceive a major trading opportunity. The nerve and skill required to step on the accelerator at the right time is certainly one of the elements that separates good traders from exceptional traders. Steinhardt's heavy position in Treasury notes during 1981 and 1982 is a perfect example of this characteristic. Conviction is probably an important quality for any trader, but it is essential to the contrarian trader. Steinhardt has repeatedly demonstrated amazing resolve in maintaining large positions during difficult times, as long as he was convinced he was still right. Witness his conviction in staying with his Treasury note position during the 6-month climax in interest rates in 1981, remaining immune not only to the market move against him, but also to the psychological pressures of complaining investors who questioned his sudden transition into treasuries after a career as a stock trader. Throughout it all, Steinhardt held on, and even built his position, because he remained convinced that he was right. Without his strong sense of conviction, the world probably would never have heard of Michael Steinhardt. Steinhardt also stresses that there are no absolute formulae or fixed patterns. The markets are always changing, and the successful trader needs to adapt to these changes. In Steinhardt's view, traders who try to find fixed approaches will be doomed to failure sooner or later. 84. 85. William O'Neill. The Art of Stock Selection. William O'Neill is an unreserved optimist and ebullient fan of the American economic system and its possibilities. O'Neill says, "Great opportunities occur every year in America. Get yourself prepared and go for it. You will find that little acorns can grow into giant oaks. Anything is possible with persistence and hard work. It can be done, and your own determination to succeed is the most important element." O'Neill is living proof of his own words, a classic American success story. Born in Oklahoma during the lean Great Depression years and raised in Texas, he went on to build dual fortunes as both an immensely profitable investor and a highly successful businessman. O'Neill began his financial career as a stockbroker for Hayden, Stone and Company in 1958. It was there that He first began the research that led to the formulation of the key elements of his investment strategy. O'Neill's trading concepts proved remarkably effective from the start. During 1962 to 63, by pyramiding the profits in three exceptional back-to-back trades, short Corvette, long Chrysler, and long Syntex, he managed to parlay an initial $5,000 investment into $200,000. In 1964, O'Neill used his investment winnings to buy a seat on the New York Stock Exchange and to form William O'Neill & Company, an institutional research brokerage firm. His firm was a leader in offering comprehensive computerized stock market information and today is one of the most highly respected securities research firms in the country. William O'Neill & Company services more than 500 major institutional accounts and 28,000 individual subscribers to their daily graphs charting service. The firm's database contains 120 different statistics on each of 7,500 securities. In what was certainly his boldest endeavor, in 1983, O'Neill launched Investors Daily in direct competition with the Wall Street Journal. He financed the newspaper with his own funds, knowing that it would be many years before he could hope to break even. Skeptics abounded when the paper began with a press run under 30,000 in 1984, compared to over 2 million for the Wall Street Journal. By mid-1988, Investors Daily's subscribership had expanded to over 110,000, and the growth in circulation was accelerating. The estimated break-even point of 200,000 subscribers no longer seems far-fetched. O'Neill believes Investors Daily can eventually grow to 800,000 readers. His unflagging confidence in the paper stems from the fact that Investors Daily's financial tables contain statistical information unavailable anywhere else: earnings per share, EPS, rank, relative strength, and volume percent change. These measures are discussed in the interview. In 1988, O'Neill combined his concepts in the book How to Make Money in Stocks, published by McGraw-Hill. The book combines clarity and brevity with excellent and very specific trading advice. It was the best-selling investment book of the year. O'Neill's various business ventures have not impeded his performance as a virtuoso stock investor. During the past 10 years, O'Neill has averaged over a 40% profit annually on his stock investments. Some of his biggest winners were the Canadian Oils during the 1970s and Pick and Save and Price Company during the late 1970s and early 1980s. Perhaps O'Neill's most famous market calls were two full-page Wall Street Journal ads heralding imminent major bull markets. The timing of these ads could hardly have been better: March 1978 and February 1982. William O'Neill & Company is a no-frills operation. Rarely have I seen a more crowded office environment. O'Neill, however, does not single himself out for any special privileges. In what must surely be a rarity among chief executive officers, he shares his office with two other employees. O'Neill impressed me as being articulate, confident, opinionated, and very bullish on America. I think it would be fair to describe your stock investment approach as individualistic and original. Where did you first develop your trading ideas? I went through the same process that most people do. I subscribed to a few investment letters and most of them didn't do too well. I found that theories like buying low-priced stocks or stocks with low price/earnings, PE ratios were not very sound. When did you first find an approach that worked? Back in 1959, one did a study of the people that were doing very well in the market. At that time, the Dreyfus Fund was a very small fund, managing only about $15 million. Jack Dreyfus, who managed the fund, was doubling the results of all of his competitors. So I got copies of their prospectus and quarterly reports and plotted on charts precisely where they had purchased each of their stocks. There were over 100 of these securities, and when I laid them out on a table, I made my first real discovery: not some, not most, but every single stock had been bought when it went to a new high price. So the first thing I learned about how to get superior performance is not to buy stocks that are near their lows, but to buy stocks that are coming out of broad bases and beginning to make new highs relative to the preceding price base. You are trying to find the beginning of a major move so that you don't waste 6 or 9 months sitting in a stock that is going nowhere. I studied the stocks that were big winners in past years and tried to find the characteristics they had in common before they became major successes. I didn't just limit myself to preconceived notions like PE ratios. I examined a lot of variables to develop a model based on how the real world worked. Can you describe this model for picking winning stocks? I use the easy-to-remember acronym CANSLM. Each letter of this name represents one of the 7 chief characteristics of the all-time great winning stocks during their early developing stages, just before they made huge advances. The C stands for current earnings per share. The best performing stocks showed a 70% average increase in earnings for the current quarter over the same quarter in the prior year before they began their major advance. I am continually amazed by how many individual investors, and even pension fund managers, buy common stocks with unchanged or lower current quarter earnings. There is absolutely no reason for a stock to go up if the current earnings are poor. If, as our research demonstrated, the best stocks had large profit increases before they 86 advanced rapidly in price, why should anybody settle for mediocre earnings? So, our first basic rule in stock selection is that quarterly earnings per share should be up by at least 20 to 50% year to year. The A in our formula stands for annual earnings per share. In our studies, the prior 5-year average annual compounded earnings growth rate of outstanding performing stocks at their early emerging stage was 24%. Ideally, each year's earnings per share should show an increase over the prior year's earnings. It is a unique combination of both strong current earnings and high average earnings growth that creates a superb stock. The EPS rank, which is published in Investors Daily, combines a stock's percent earnings increase during the past 2 quarters with the past 5-year average percent earnings and compares that figure to every other stock we cover. An EPS rank of 95 means that a company's current and 5-year historical earnings have outperformed 95% of all other companies. The N in our formula stands for something new. The new can be a new product or service, a change in the industry, or new management. In our research, we found that 95% of the greatest winners had something new that fell within these categories. The new also refers to a new high price for the stock. In our seminars, we find that 98% of investors are unwilling to buy a stock at a new high. Yet, it is one of the great paradoxes of the stock market that what seems too high usually goes higher and what seems too low usually goes lower. The S in the formula stands for shares outstanding. 95% of the stocks that performed best in our studies had less than 25 million shares of capitalization during the period when they had their best performance. The average capitalization of all of these stocks was 11.8 million shares, while the median figure was only 4.6 million. Many institutional investors handicap themselves by restricting their purchases to only large capitalization companies. By doing so, they automatically eliminate some of the best growth companies. The L in our formula stands for leader or laggard. The 500 best performing stocks during the 1953 to 1985 period had an average relative strength of 87 before their major price increase actually began. The relative strength measures a stock's price performance during the past 12 months compared to all other stocks. For example, a relative strength of 80 would mean that the given stock outperformed 80% of all other stocks during the past year. So, another basic rule in stock selection is to pick the leading stocks, the ones with the high relative strength values, and avoid the laggard stocks. I tend to restrict purchases to companies with relative strength ranks above 80. The I in the formula stands for institutional sponsorship. The institutional buyers are by far the largest source of demand for stocks. Leading stocks usually have institutional backing. However, although some institutional sponsorship is desired, excessive sponsorship is not, because it would be a source of large selling if anything went wrong with the company or the market in general. This is why the most widely owned institutional stocks can be poor performers. By the time a company's performance is so obvious that almost all institutions own a stock, it is probably too late to buy. The M in our formula stands for market. 3 out of 4 stocks will go in the same direction as a significant move in the market averages. That is why you need to learn how to interpret price and volume on a daily basis for signs that the market has topped. At any given time, less than 2% of the stocks in the entire market will fit the Canslem formula. The formula is deliberately restrictive because you want to pick only the very best. If you were recruiting players for a baseball team, would you pick an entire lineup of .200 hitters, or would you try to get as many .300 hitters as possible? Since you use such a restrictive selection process, do you have a high percentage of winning trades? I guess over the years, about 2/3 of my stock purchases were actually closed at a profit. However, I have found that only 1 or 2 stocks of every 10 I have bought have turned out to be truly outstanding. Wouldn't most of the indicators in your Canslem formula, such as EPS, pick up a stock before it goes to new highs? Why not just buy the stock when it is still forming a base instead of waiting for it to go to a new high? You don't want to anticipate a breakout from a base because a stock may never break out. You can buy too soon as well as too late. The idea is to buy when there is the least probability of a loss. If you buy within the base, the stock will frequently fluctuate 10 or 15% in normal trading action, and it is very easy to get shaken out of the position. But if I buy at exactly the right time, the stock is usually not going to go down to my maximum 7% stop loss point. You have stated that the superior stocks have high relative strength figures, 80 or higher. Although high relative strength is good, is there such a thing as it being too high? In other words, might a relative strength of 99 indicate that the stock is overextended and vulnerable to a sharp correction? You have to look at a chart to make that determination. The key point is not how high the relative strength is, but rather how far the stock is extended beyond its most recent price base. You buy stocks that have a high relative strength if they are just beginning to emerge from a sound base building period. However, I would generally not buy a stock with a high relative strength that is already more than 10% beyond its prior price base. The M in the Canslem formula makes sense since few stocks can buck a general bear market. However, that rule sounds easier in theory than in practice. After all, how do you tell the difference between a market top and a normal bull market correction? Top formations in the market averages occur in only one of 2 ways. First, the average moves up to a new high, but does so on low volume. This tells you that the demand for stocks is poor at that point and that the rally is vulnerable. Second, volume surges for several days, but there is very little, if any, upside price progress as measured by market closes. In this latter case, there may not be a pickup in volume when the market initially tops since the distribution has taken place on the way up. Another way to determine the direction of the general market is to focus on how the leading stocks are performing. If the stocks that have been leading the bull market start breaking down, that is a major sign the market 87 has topped. Another important factor to watch is the Federal Reserve discount rate. Usually, after the Fed raises the rate 2 or 3 times, the market runs into trouble. The daily advance/decline line is sometimes a useful indicator to watch for signs of a market top. The advance/decline line illustrates the difference between the total number of New York Stock Exchange stocks advancing each day versus the number declining. Frequently, the advance/decline line will lag behind the market averages and fail to penetrate prior peaks after the averages reach new highs. This indicates that fewer stocks are participating in the market advance. When you believe that the general market has entered a bearish phase, would you advise going short rather than merely liquidating longs? I don't normally advise people to sell short unless they are professional traders. Selling short is quite tricky. I myself have only made significant profits on the short side of 2 of the last 9 bear markets. A stock should never be sold short because its price looks too high. The idea is not to sell short at the top, but at the right time. Short selling of individual stocks should only be considered after the general market shows signs of a top. The best chart pattern to short is one in which a stock breaks out on the upside of its third or fourth base and then fails. The stock should be breaking down toward the low end of its previous base pattern on increased volume. After the first serious price break below the base, there will usually be several pullback attempts. The prior base will now provide an area of overhead supply, as all investors who bought in that zone will be losing money, and a number of them will be eager to get out near break-even. Therefore, pullbacks to failed price bases also provide good timing for short sales. Does the element of unlimited risk present any special problem in short selling? No, because I never take unlimited risk. If a short position goes against me, I will be out after the first 6 or 7% loss. Before you sell any stock short, you should decide the price at which you will cover that short position if a loss occurs. Besides the Canslem formula, which is critical to your stock selection process, risk control obviously plays an important role in your overall strategy. Can you talk a little bit more about that element of trading? My philosophy is that all stocks are bad. There are no good stocks unless they go up in price. If they go down, instead, you have to cut your losses fast. The secret for winning in the stock market does not include being right all the time. In fact, you should be able to win even if you are right only half the time. The key is to lose the least amount of money possible when you are wrong. I make it a rule never to lose more than a maximum of 7% on any stock I buy. If a stock drops 7% below my purchase price, I will automatically sell it at the market, no second guessing, no hesitation. Some people say, I can't sell that stock because I'd be taking a loss. If the stock is below the price you paid for it, selling doesn't give you the loss, you already have it. Letting losses run is the most serious mistake made by most investors. The public doesn't really understand the philosophy of cutting losses quickly. If you don't have a rule like cutting a loss at 7%, then in bear markets like 1973 to 74, you can lose 70 or 80% on your holdings. I have seen people go bankrupt in that type of situation. If you aren't willing to cut your losses short, then you probably should not buy stocks. Would you drive your car without brakes? In my book, I repeat a story told by Fred C. Kelly, the author of Why You Win or Lose, that provides the best example I know of how the typical investor procrastinates when it comes to making a selling decision. A man has rigged up a turkey trap with a trail of corn leading into a big box with a hinged door. The man holds a long piece of twine connected to the door that he can use to pull the door shut once enough turkeys have wandered into the box. However, once he shuts the door, he can't open it again without going back to the box, which would scare away any turkeys lurking on the outside. One day, he had a dozen turkeys in his box. Then one walked out, leaving 11. I should have pulled the string when there were 12 inside, he thought, but maybe if I wait, he will walk back in. While he was waiting for his 12th turkey to return, 2 more turkeys walked out. I should have been satisfied with the 11, he thought. If just one of them walks back, I will pull the string. While he was waiting, 3 more turkeys walked out. Eventually, he was left empty-handed. His problem was that he couldn't give up the idea that some of the original turkeys would return. This is the attitude of the typical investor who can't bring himself to sell at a loss. He keeps expecting the stock to recover. The moral is, to reduce your stock market risk, stop counting turkeys. Okay, you use your cancel methodology for selecting stocks, and your 7% rule for getting out if you are wrong. How do you decide when to liquidate a winning stock position? First, you should hold a stock as long as it is performing properly. Jesse Livermore said, "It is never your thinking that makes big money, it's the sitting." Second, you have to realize that you will never sell the exact top. Therefore, it is ridiculous to kick yourself when a stock goes higher after you sell. The goal is to make substantial profits on your stocks and not be upset if the price continues to advance after you get out. Your writings express disdain for a number of factors that many people consider important, including PE ratios, dividends, diversification, and overbought/oversold indicators. Could you explain what you think is wrong with the conventional wisdom regarding these subjects? Let's start with PE ratios. To say that a stock is undervalued because it is selling at a low PE ratio is nonsense. In our research, we found there was a very low correlation between the PE ratio and the best performing stocks. Some of these stocks had PE ratios of 10 when they started their major advance, others had PE ratios of 50 during the 33 years. In our survey period, 1953 to 1985, the average PE ratio for the best performing stocks at their early emerging stage was 20, compared to an average PE ratio of 15 for the Dow Jones average during the same time. At the end of their expansion phase, these stocks had an average PE ratio of approximately 45. This means that if, in the past, you were not willing to buy stocks with above-average P/ES, you automatically eliminated most of the best-performing 88 securities. A common mistake a lot of investors make is to buy a stock solely because the PE ratio looks cheap. There is usually a very good reason why a PE ratio is low. Many years ago, when I was first beginning to study the market, I bought Northrop at 4 times earnings and watched in disbelief as the stock eventually declined to 2 times earnings. Another common mistake is selling stocks with high PE ratios. I still remember in 1962 when an investor barged into my friend's brokerage office, declaring in a loud voice that Xerox was drastically overpriced because it was selling at 50 times earnings. He went short at $88. Xerox eventually went to $1,300, adjusting for stock splits. Your thoughts on dividends? There is no correlation between dividends and a stock's performance. High fact, the more a company pays in dividends, the weaker their posture because they may have to pay high interest rates to replace funds paid out in dividends. It is naive to hold stocks that are going down because they pay dividends. If you are getting a 4% dividend and the stock goes down 25%, your net yield is a 21% loss. How about overbought/oversold indicators? I rarely pay any attention to overbought/oversold indicators. I once hired a well-known professional who specialized in such technical indicators. At the very point during the 1969 market break when I was trying to convince portfolio managers to liquidate stocks and move to cash, he was telling them it was too late to sell because his indicators said the market was very oversold. Once his indicators were oversold, the market break really accelerated. Investors would be foolish not to use charts. Charts provide valuable information about what is going on that cannot be obtained easily any other way. They allow you to follow a huge number of different stocks in an organized manner. Earlier, you talked about using volume as a clue that the market averages were topping. Do you also use volume as an indicator in trading individual stocks? The volume in a stock is a measure of supply and demand. When a stock is beginning to move into new high Ground volume should increase by at least 50% over the average daily volume in recent months. High volume. At a key point is an extraordinarily valuable tip-off that a stock is ready to move. Volume can also be used in a reverse manner. When prices enter a consolidation after an advance, volume should dry up very substantially. In other words, there should be very little selling coming into the market. During a consolidation, declining volume is generally constructive. How do you handle a losing streak? If you hit a losing streak, and it is not because what you are doing is wrong, that tells you the whole market may be going bad. If you have 5 or 6 straight losses, you want to pull back to see if it is time to start moving into cash. The M in your Cancelum formula emphasizes the importance of being out of the market, at least on the long side, during major bear phases. Since most mutual funds, by their very structure, remain heavily invested in stocks throughout both bull and bear markets, does this imply that you believe mutual funds are a poor investment? This is going to surprise you. I think mutual funds are an absolutely outstanding way to invest. I believe that every person should own their own home, own real estate, and have an individual stock account or own mutual funds. Those are the only ways you can make any substantial income above your salary. Although I think mutual funds are an excellent investment, the problem is that most people don't know how to handle them. The key to success in mutual funds is to sit and not to think. When you buy a fund, you want to be in it for 15 years or more. That is how you will make the really big money. But in order to do that, you need the courage to sit through 3, 4, or 5 bear markets. The typical diversified growth stock fund will go up 75 to 100% in a bull market, but it will decline by only 20 to 30% in a bear market. So you treat a fund very differently from an individual stock account? Very, very differently. With an individual stock, you absolutely have to have a stop-loss point, because you never know how far down the stock is going. I remember selling a $100 stock one time and it eventually went to $1.10. Didn't have any idea it was going down that far, but what would have happened if I had held on to it? One mistake like that and you can't come back. In contrast, in a mutual fund, you should sit through the bear markets. Since most funds will be diversified in 100 or more stocks across the American economy, when stocks recover after a bear market, these funds will recover as well. They almost have to. Unfortunately, in a bear market, most people get scared and decide to switch, ruining their long-term holding plan. Actually, when a good, diversified growth fund is down sharply, you should buy more. 89. Would it be fair to say that the general public tends to treat funds like they should individual stocks and stocks like they should funds? By that I mean, they tend to hold on to their losers in individual stocks, but liquidate their mutual funds when they are down sharply. Yes, that is exactly right. Because of the emotional element, most of what people do in the market is wrong. Along that line, what are the biggest mistakes investors generally make? In my book I have a chapter on 18 common mistakes. The following list of common mistakes is excerpted from O'Neill's book How to Make Money in Stocks, published by McGraw-Hill in 1988. 1. Most investors never get past the starting gate because they do not use good selection criteria. They do not know what to look for to find a successful stock. Therefore, they buy fourth-rate nothing to write home about stocks that are not acting particularly well in the marketplace and are not real market leaders. 2. A good way to ensure miserable results is to buy on the way down in price. A declining stock seems a real bargain because it's cheaper than it was a few months earlier. For example, an acquaintance of mine bought International Harvester at $19 in March 1981 because it was down in price sharply and seemed a great bargain. This was his first investment, and he made the classic Tyro's mistake. He bought a stock near its low for the year. As it Turned out, the company was in serious trouble and was headed, at the time, for possible bankruptcy. 3. An even worse habit is to average down in your buying, rather than up. If you buy a stock at $40 and then buy more at $30 and average out your cost at $35, you are following up your losers and mistakes by putting good money after bad. This amateur strategy can produce serious losses and weigh you down with a few big losers. 4. The public loves to buy cheap stocks selling at low prices per share. They incorrectly feel it's wiser to buy more shares of stock in round lots of 100 or 1,000 shares, and this makes them feel better, perhaps more important. You would be better off buying 30 or 50 shares of higher priced, sounder companies. You must think in terms of the number of dollars you are investing, not the number of shares you can buy. Buy the best merchandise available, not the poorest. The appeal of a $2, $5, or $10 stock seems irresistible. But most stocks selling for $10 or lower are there because the companies have either been inferior in the past or have had something wrong with them recently. Stocks are like anything else. You can't buy the best quality at the cheapest price. It usually costs more in commissions and markups to buy low-priced stocks, and your risk is greater, since cheap stocks can drop 15 to 20% faster than most higher-priced stocks. Professionals and institutions will not normally buy the $5 and $10 stocks, so you have a much poorer grade following and support for these low-quality securities. As discussed earlier, institutional sponsorship is one of the ingredients needed to help propel a stock higher in price. 5. First-time speculators want to make a killing in the market. They want too much, too fast, without doing the necessary study and preparation or acquiring the essential methods and skills. They are looking for an easy way to make a quick buck without spending any time or effort really learning what they are doing. 6. Mainstream America delights in buying on tips, rumors, stories, and advisory service recommendations. In other words, they are willing to risk their hard-earned money on what someone else says, rather than on knowing for sure what they are doing themselves. Most rumors are false, and even if a tip is correct, the stock ironically will, in many cases, go down in price. 7. Investors buy second-rate stocks because of dividends or low price/earnings ratios. Dividends are not as important as earnings per share. In fact, the more a company pays in dividends, the weaker the company may be, because it may have to pay high interest rates to replenish internally needed funds that were paid out in the form of dividends. An investor can lose the amount of a dividend in 1 or 2 days' fluctuation in the price of the stock. A low PE, of course, is probably low because the company's past record is inferior. 8. People buy company names they are familiar with, names they know. Just because you used to work for General Motors doesn't make General Motors necessarily a good stock to buy. Many of the best investments will be names you won't know very well but could and should know if you would do a little studying and research. 9. Most investors are not able to find good information and advice. Many, if they had sound advice, would not recognize or follow it. The average friend, stockbroker, or advisory service could be a source of losing advice. It is always the exceedingly small minority of your friends, brokers, or advisory services that are successful enough in the market themselves that merit your consideration. Outstanding stockbrokers or advisory services are no more frequent than are outstanding doctors, lawyers, or baseball players. Only 1 out of 9 baseball players that sign professional contracts ever make it to the big leagues. And, of course, the majority of ballplayers that graduate from college are not even good enough to sign a professional contract. 10. Over 98% of the masses are afraid to buy a stock that is beginning to go into new high ground. Price-wise, it just seems too high to them. Personal feelings and opinions are far less accurate than markets. 1. The majority of unskilled investors stubbornly hold on to their losses when the losses are small and reasonable. They could get out cheaply, but being emotionally involved and human, they keep waiting and hoping until their loss gets much bigger and costs them dearly. 12. In a similar vein, investors cash in small, easy to take profits and hold their losers. This tactic is exactly the opposite of correct investment procedure. Investors will sell a stock with a profit before they will sell one with a loss. 13. Individual investors worry too much about taxes and commissions. Your key objective should be to first make a net profit. Excessive worrying about taxes usually leads to unsound investments in the hope of achieving a tax shelter. At other times in the past, investors lost a good profit by holding on too long, trying to get a long-term capital gain. Some investors, even erroneously, convince themselves they can't sell because of taxes, strong ego, weak judgment. Commission costs of buying or selling stocks, especially through a discount broker, are a relatively minor factor compared to more important aspects such as making the right decisions in the first place and taking action. 90. When needed. One of the great advantages of owning stock over real estate is the substantially lower commission and instant marketability and liquidity. This enables you to protect yourself quickly at a low cost or to take advantage of highly profitable new trends as they continually evolve. 14. The multitude speculates in options too much because they think it is a way to get rich quick. When they buy options, they incorrectly concentrate entirely in shorter-term, lower-priced options that involve greater volatility and risk rather than in longer-term options. The limited time period works against short-term option holders. Many options speculators also write what are referred to as naked options, which are nothing but taking a great risk for a potentially small reward and, therefore, a relatively unsound investment procedure. 15. Novice investors like to put price limits on their buy and sell orders. They rarely place market orders. This procedure is poor because the investor is quibbling for eighths and quarters of a point, rather than emphasizing the more important and larger overall movement. Limit orders eventually result in your completely missing the market and not getting out of stocks that should be sold to avoid substantial losses. 16. Some investors have trouble making decisions to buy or sell. In other words, they vacillate and can't make up their minds. They are unsure because they really don't know what they are doing. They do not have a plan, a set of principles or rules to guide them and, therefore, are uncertain of what they should be doing. 17. Most investors cannot look at stocks objectively. They are always hoping and having favorites, and they rely on their hopes and personal opinions rather than paying attention to the opinion of the marketplace, which is more frequently right. 18. Investors are usually influenced by things that are not really crucial, such as stock splits, increased dividends, news announcements, and brokerage firm or advisory recommendations. As someone who has spent a lifetime researching stocks and the American economy, do you have any opinions about the quality of research provided by Wall Street firms? An article in Financial World found that top-rated analysts generally underperformed the S&P average. 1. Major problem is that 80% of brokerage firm research is written on the wrong companies. Each industry analyst has to turn out his or her quota of reports, even though only a few industry groups are leaders in each cycle. There is insufficient screening to determine which reports should actually be written. Another major problem with Wall Street research is that it seldom provides sell recommendations. I would assume, given the consistency of your success as a stock investor for over 25 years, that you don't think very much of the random walk theory. The stock market is neither efficient nor random. It is not efficient because there are too many poorly conceived opinions. It is not random because strong investor emotions can create trends. In the most general sense, trading success requires three basic components: an effective trade selection, process, risk control, and discipline to adhere to the first two items. William O'Neill provides a perfect illustration of the successful trader. He has devised a specific strategy for selecting stocks, cancel them, he has a rigorous risk control. RAL. And he has the discipline not to deviate from his selection and risk control strategies. In addition to the specific stock selection methodology detailed in this chapter, traders and investors should find the advice regarding common mistakes, listed near the end of the interview, particularly useful. 91. 92. David Ryan stock investment as a treasure hunt. David Ryan does not believe in buying low-priced stocks. But that was not always the case. He remembers flipping through the Wall Street Journal when he was 13 years old and finding a $1 stock. He ran with the paper in hand to his father and asked, "If I go up to my room and get $1, can I buy this stock?" His father told him that it didn't quite work that way. You have to do some research about a company before you invest in the stock. He explained. A few days later, leafing through the Wall Street Journal again, Ryan found an article on Ward Foods, which made Bit-O-Honey and chunky candy bars. It seemed like a perfect investment, since he ate a lot of candy. His father set up an account for him, and he bought 10 shares of the stock. He recalls getting all his friends to buy the candy bars so the company would make more money and his stock would go up. That was the official start of Ryan's career as a stock investor. Ryan's interest in the stock market increased as he grew older. By the time he was 16 years old, he was subscribing to a weekly chart service and attending investment seminars by William O'Neill and other market analysts. In college, he read every book on the stock market he could find. William O'Neill was Ryan's idol. After graduating college in 1982, he decided to try to get a job at O'Neill's company. He told the receptionist of his interest in O'Neill's work and his willingness to accept any job, no matter how menial, just to get his foot in the door. He was even willing to work for free. Ryan was hired, and within 4 years, his investment success led to his appointment as the youngest vice president of the company, with responsibilities as a portfolio manager and as O'Neill's direct assistant in stock selection for institutional clients. Ryan achieved a degree of fame in his own regard when he won the 1985 stock division of the U.S. Investing Championship, a contest ran by former Stanford University professor Norm Zadeh. His return that year was a phenomenal 161%. As if to demonstrate that his performance was no one-year fluke, Ryan re-entered the contest in 1986, virtually duplicating his previous year's performance with a 160% return second-place finish. In 1987, he won the contest once again with another triple-digit return year. For the 3 years as a whole, his compounded return was a remarkable 1,379%. Although most of the traders I interviewed have a love for trading, none have the unbridled enthusiasm demonstrated by Ryan. To Ryan, the whole process of stock selection is like a terrific game, a treasure hunt as he describes it, and he still can't believe he is getting paid to do it. The offices of the traders I interviewed ranged from the unadorned to the elaborate, but Ryan clearly had the low end of the spectrum staked out. Instead of an office, plain or otherwise, I was surprised to find Ryan's workplace to be a cubicle within a noisy, floor-sized room. Ryan didn't seem to care about the lack of amenities. I suspect that as long as he was supplied with his charts and computer runs, he would probably be content to work in a hall closet. Did your original job at William O'Neill and Company involve any market analysis? No, but once I was in, I just started studying and studying. On your own time, I take it. Yes. I would take stuff home every night and on weekends. What kind of things were you studying? I would go over our charts. I studied the company's past recommendations. I studied historical models of great winning stocks to ingrain in my mind what a stock looked like before it made a major move. I tried to get to the point where I was looking at the exact same things O'Neill did. He was my role model. Were you trading at this time? Yes, I opened a $20,000 account shortly after I started working for the company, 1982. How did you do? Initially, I ran the account up to about $52,000 by June 1983. Then I gave it all back, including some of my starting capital. By mid-1984, my account was down to $16,000. Do you know what you did wrong? Yes. I sat down and studied every mistake that I had made from June 1983 through the middle of 1984. Probably my biggest mistake was that even though we were in a moderate bear market, the Dow came down from 1,296 to 1,078. I continued to play as aggressively as I had during the bull market from August 1982 through June 1983.1. Also made the mistake of buying stocks that were overextended. By that I mean I was buying stocks that had already moved 15 to 20% above their price bases. You should only buy stocks that are within a few percent of their base, otherwise, the risk is too great. I turned it around by learning from all the mistakes that I had made. In late 1984, one sold a piece of real estate I owned and put all the money in a stock account. Were you confident, despite your poor performance during mid-1983 to mid-1984, because you felt that you had figured out what you were doing wrong? Yes, because I had studied very hard and was determined to be disciplined. I thought I was going to do very well. So in 19851 entered the U.S. Investing Championship. I won the stock division that year with a 161% return. I re-entered the contest in subsequent years and substantially exceeded 100% returns in 1986 and 1987. As well. I was doing the exact same thing over and over again. I was buying stocks when they had all the characteristics I liked. How are you doing this year, May 1988? So far this year, I am down. We are in a different type of market. Stocks aren't moving as quickly as they have in the last 3 years. I am playing with a much smaller amount this year, because I think the potential for making a lot of money is much more limited. 93. You mentioned earlier that for a while you read virtually every book on the markets you could find. What reading list would you give to someone starting out who is serious about becoming a successful stock trader? Essential reading on top of the list is O'Neill's book, How to Make Money in Stocks, McGraw-Hill, New York, New York. 1988. Another book that is must-reading is How I Made $2 Million in the Stock Market by Nicholas Darvas. Lau Stewart Incorporated, Secaucus, New Jersey, 1986. A lot of people laugh at that title, but it is fun reading and you learn a ton. Another book I would recommend is Reminiscences of a Stock Operator by Edwin Lefebvre, reputedly about Jesse Livermore. Livermore himself wrote a very good thin volume, How to Trade in Stocks, Institute for Economic and Financial Research, Albuquerque. NM, 1986. Any others? A good one on what to look for in individual stocks is Super Performance Stocks by Richard Love, Prentice Hall, Englewood Cliffs, New Jersey, 1977. The book has a great study on some of the greatest winners of all time. Another good one on picking stocks is Profile of a Growth Stock by Kermit Zieg and Susanna H. Zieg, Investors Intelligence. Larchmont, New York, 1972. I would also recommend Marty Zweig's book, Winning on Wall Street, Warner Books Incorporated. New York, New York, 1986, and Stan Weinstein's Secrets for Profiting in Bull and Bear Markets, Dow, Jones Irwin, New York, New York, 1988, which has some good sections on short selling. Finally, on Elliott wave analysis, which I think has some validity, there is Elliott Wave Principle by Frost and Prechter, New Classic Library Incorporated, Gainesville, Georgia, 1978. And a book called Super Timing by an English fellow named Beckman, Milestone Publishers, London. All those books are good, but you learn the most from the market itself. Every time I buy a stock, I write down the reasons why I bought it. He pulls out a binder containing annotated charts. Doing this helps cement in my mind the characteristics of a winning stock. Maybe even more important, it helps me learn from my mistakes. What kind of things did you learn by keeping your trader's diary? Not buying overextended stocks, using Neil's criteria for stock selection, and being as disciplined as possible. The more disciplined you can get, the better you are going to do in the market. The more you listen to tips and rumors, the more money you're likely to lose. Has keeping this diary been an important part of your success? Absolutely. Can you describe your procedure for selecting stocks? I start out by going through the stock charts and writing down the stocks with strong technical action. In other words, I write down all the stocks I want to take a closer look at. Your company follows 7,000 stocks, you can't possibly look at 7,000 charts on a regular basis. I don't look through 7,000, but in a week I probably go through about 4,000 charts. So, I see a majority of the database. Keep in mind there are probably about 1,500 to 2,000 stocks that trade under $10, and I don't like to look at those anyway. Is that a good rule, avoid stocks under $10? Yes, because they are usually down there for a reason. Doesn't that knock out a lot of the OTC stocks? Yes, a lot of the smaller OTC stocks. But aren't those sometimes the best buys, the stocks that no one is paying any attention to? Sometimes. But many of those stocks stay down there for years and years. I would rather wait until they prove themselves by moving up to the $15 to $20 range. After you have reviewed the charts and written down the stocks that interest you, what do you look at next to screen your selection? I look at the 5-year earnings growth record and the last 2 quarters of earnings relative to the previous year's levels. The quarterly comparisons show you if there is any deceleration in the earnings growth rate. 4. Example, a 30% growth rate over the last 5 years may look very impressive, but if in the last 2 quarters earnings were only up 10% and 15%, it warns you that the strong growth period may be over. Of course, those 2 factors, the 5-year earnings growth record and the earnings during the past 2 quarters, are combined in our earnings per share (EPS) rank. See the O'Neill chapter for a detailed explanation of the EPS. What are you looking for in an EPS figure? As high as possible, at least above 80, and preferably above 90. Actually, a lot of stocks I buy have an EPS rank of 99. In my experience, markets usually anticipate. One thing that surprises me about the EPS is that I would think that the price of the stock would run up well before the earnings growth starts to be extremely positive. That is what a lot of people think. They say, it's too late to buy the stock, the earnings are already on the table. However, in analyzing hundreds of the biggest winners, we found that, in many cases, the earnings had been on the table for a while. What would cause a stock to just sit despite very good earnings? The broad stock market may be weak and holding back the stock, but once the weight of the market comes off, these stocks just go right through the roof. How about if the stock market is okay? What would keep the stock from taking off in that type of 94 situation? Perceptions. People might not believe that the earnings are going to continue as strongly as they had in the past. What else are you using besides the EPS and the earnings breakdown to screen your stock selections? The relative strength is very important. The relative strength ranks a stock's price change relative to all other stocks surveyed. See the O'Neill chapter for a detailed definition. What are you looking for in relative strength? At least above 80, and preferably above 90. Intuitively, I would almost think that it has already gone too far. It can't get any stronger. Well, not necessarily that it can't get any stronger, but it seems to me that, by definition, every stock has to have a high relative strength when it tops. How do you avoid sometimes buying the highs, if you are restricting yourself to high relative strength stocks? I am usually able to avoid that because in my first step of screening the charts, I generally rule out stocks that are overextended from their base. Very often the stocks with the highest relative strength continue to outperform the market for months and months. For example, Microsoft had a relative strength of 97 when it was at $50 a share. It eventually moved to $161. Are you implying that the higher the relative strength the better? Yes, I would rather go with a relative strength of 99 than 95. However, once the relative strength starts falling off, I usually get out of the stock. So you are not only paying attention to the relative strength value itself, but also the trend of the relative strength. Right. If the relative strength starts breaking an uptrend, then I would be very cautious, even if it is still well above 80. Am I going in the right order, EPS to relative strength, in terms of how you filter down your initial stock list? I would probably place relative strength first, then EPS. Many times the relative strength takes off before that big earnings report comes out. Do you also use the relative strength of the industry as a filter in your stock selection? Yes. Investors daily ranks industry groups between 0 and 200.1, usually want the industry group to be in the top 50. To continue the screening process, after checking the stock's relative strength, the EPS, and the industry relative strength, what is your next step? I check the number of shares outstanding. I am looking for stocks with less than 30 million shares and preferably only 5 to 10 million shares. Stocks with more than 30 million shares are more mature, they have already split a few times. It is a case of supply and demand. Because you have more supply, it takes a lot more money to move those stocks. What else do you look at? You want some institutional ownership, because they really power a stock higher, but you don't want too much sponsorship. I would say 1% to 20% mutual fund sponsorship is the ideal range. Are there any other important elements that go into the stock selection process? Yes. There should be something new that attracts people to that stock. For example, Reebok had shoes that were hot. Compaq had a fantastic portable computer. Microsoft was a leader in the software field. Doesn't that rule out most companies that have been around for a while? Yes. You don't want to be playing General Electric because there is usually nothing really hot or brand new going on. Occasionally, there are exceptions. For example, General Motors has gone virtually sideways for the last 5 years, and it looks like they are trying to turn their situation around. With General Motors, might the new be the recent shift to high styling? Yes, but in most cases, you are going to find the new in emerging entrepreneurial growth companies. I would imagine if you go through 7,000 stocks, there must be quite a large number that meet your criteria. On average, there are probably only about 70 stocks that meet the criteria, because it is tough to meet all the conditions. Then I cut those 70 down to about 7. How do you cut down from 70 to 7? I pick those stocks that have all the characteristics plus a great-looking base pattern. I also look at how the stock has done in the past. For example, has the stock doubled before? A lot of the stocks I buy have already doubled and tripled before I buy them. You actually prefer to buy a stock that has already doubled as opposed to a stock that is in a long base? Yes, because that shows me there is something very unusual going on, and if the situation is that good, 95. Doubling may just be the beginning. It is probably going to double again. To sum it up, I am looking for the strongest stocks in the market, in terms of both earnings and the technical picture. Since you use an extremely rigorous selection process, do you have a high percentage of winners in your stock picks? No, only about 50-50, because I cut the losers very quickly. The maximum loss I allow is 7%, and Usually I am out of a losing stock a lot quicker. I make my money on the few stocks a year that double and triple in price. The profits in those trades easily make up for all the small losers. How long do you typically hold a stock? I usually hold my big winners for about 6 to 12 months, stocks that aren't that strong about 3 months, and my losers less than 2 weeks. Do you pick an objective on the stocks you buy? No. I usually wait until the stock runs up, builds another base, and then breaks down. That is when I liquidate. Do you think people should only use market orders? In a dull market that is just trading back and forth, you could put in a limit order. But if you really think the stock is going to make a big move, and that should be the only reason you are buying the stock to begin with, then there is no reason to haggle over an eighth of a point. Just buy the stock. The same thing applies to the downside. If you think the stock is going to drop, just sell it. I learned the lesson about market orders in 1982 when I was trying to buy Text1, which was trading at $15 for $14%. The next day it jumped LLH points, and I couldn't bring myself to buy the stock at $16,000 when I could have bought it at $15 a day earlier. That stock eventually went to $45. One element of your trading style is buying a stock when it makes a new high. Wouldn't the fundamental screening conditions you use have been in place well before that point? In some cases, they might have been. But I am trying to buy a stock when you have the most chance of making money. When a stock is coming off the low end of a base back to the high end, there will be a lot of people who bought it near the highs and sat with a loss for months. Some of those people are going to be happy to get out at even, and that creates a lot of overhead resistance. So, a stock which is at new highs has much more of an open running field? Right, because no one ahead of you is at a loss and wants to get out at the first opportunity. Everybody has a profit, everybody is happy. But the downside of that is if you wait for a breakout to new highs, a lot of times the market will pull back into the trading range. How do you avoid getting whipsawed in those situations? You can tell a lot by the volume. If the volume doubles one day and the stock moves to a new high, it is telling you a lot of people are interested in the stock and buying it. So volume becomes very important as a filtering process to avoid getting whipsawed. Yes. If the stock moves to new high ground, but the volume is only up 10%, I would be wary. Do you buy it the first day the stock breaks out to new highs, or do you wait for it to consolidate for a few days? I want to buy it as soon as it goes to new highs. If you buy a stock at new highs and it then pulls back into the range, at what point do you decide it was a false breakout? For example, assume a stock that has been trading between $16 and $20 goes to $21 and you buy it. What do you do if 2 days later the stock is back to $19? If it re-enters its base, I have a rule to cut at least 50% of the position. If it re-enters its base at all? Do you mean even if it is just below the top end of the base, or do you require some minimum penetration? No, if it just re-enters the base. In some cases, it will break out and come back to the top of the base, but not re-enter. That's fine, and I will stay with the stock. But if the top of the base was $20 and it breaks back to $193, I want to sell at least half of the position because the stock didn't keep on moving. Frequently, when a stock drops back into its base, it goes all the way back down to the lower end of the base. In the example, if it goes from $21 down to $19x, it will often go all the way back down to $16. Therefore, you want to cut your losses quickly. From a technical perspective, is the price going back into the base a bearish indicator? Yes. Stocks should be at a profit the first day you buy them. In fact, having a profit on the first day is one of the best indicators that you are going to make money on the trade. Do you use the table in Investors Daily that lists the stocks with the greatest percentage increase in volume relative to the past 50-day average volume levels? Yes, I use it to help spot stocks that are just about ready to take off. Are you using it to verify stocks you have already picked out? Yes. After I have done my weekly screen to select the stocks I am interested in buying, I sometimes wait for the stock to hit that column as a timing signal. Can you elaborate on using volume as a trading tool? When a stock that has been moving up starts consolidating, you want to see volume dry up. You should see a downtrend in volume. Then when volume starts picking up again, it usually means the stock is ready to blast off. 96. So, in the consolidation phase, decreasing volume is good. If you continue to see very high volume, do you start thinking potential top? Yes, because that shows that a lot of people are getting out of the stock. You want an increase in volume when the stock breaks out, but you want a decrease in volume as the stock consolidates. Any other volume signals you look for? When the market, or a stock, is bottoming, you want to see increased volume combined with an absence of further price progress on the downside. For example, if the Dow declines from 2,200 to 2,100, trades down to 2,085 the next day, and then closes higher on increased volume, it demonstrates support. It suggests that there are a lot of buyers coming in. The screens you have described in selecting stocks are essentially O'Neill's cancel methodology. See the O'Neill chapter for definition. Did you add any of your own elements to his approach? Yes, I learned that most of our greatest winning recommendations started off with prices under 30 times earnings. Nell says the PE, price/earnings, ratio is not important. I think it is, in that your success ratio is a lot higher on lower PE ratio stocks. But I guess not too low PE ratios? When I'm talking about lower PE ratio stocks, I mean stocks that have a PE ratio that is between even and up to 2 times the S&P 500 PE ratio. So if the S&P 500 is at 15 times earnings, you should try to buy stocks with PE ratios between 15 and 30. Once you start going much beyond double the S&P 500 PE ratio level, your timing has to be more exact. You are bound to make a few more mistakes on higher PE ratio stocks. Do you therefore avoid high PE ratio stocks? Yes, in many cases I do. The most profitable situation is when you find a stock with a strong earnings trend that is trading at a PE ratio in line with the broad market ratio. If you avoid high PE ratio stocks, wouldn't that have prevented you from catching the whole biomedical group move? That was a little different because of the fact that the whole group was trading at high PE ratios. Does that imply that there should be an exception made for a new industry? Yes, you don't want to be absolutely rigid with these rules. Has the basic market behavior stayed the same in the 1980s versus the 1970s and the 1960s? Yes, the same types of stocks work time after time. It hasn't changed at all. We can take one of the greatest winning stocks from 1960 and line it up with one of the best stocks in 1980, and they are going to have exactly the same characteristics. Do you have any thoughts on the subject of short selling? I need more time to study it and more experience. However, to pick a short, I think you need to flip all these characteristics we were talking about. Instead of a good growth record, you should look for a poor 5-year growth record and quarterly earnings that are decelerating. The stock should be losing relative strength, breaking uptrends, and starting to hit new lows. Do you think that short selling may be a critical element for superior performance if we go into a long bear market? Yes, I think it would help. But Bill O'Neill will tell you that shorting is about 3 times as hard as buying stocks. Bill says he has made substantial money in only 2 of the past 9 bear markets. He thinks the best thing you can do in a bear market is just sit it out. How do you recognize a bear market before it's too late? By how well my individual stocks are doing. If, during the bull phase, the leaders start losing, it indicates that a bear market is developing. If I have 5 or 6 stocks in a row that get stopped out, a caution flag goes up. What else do you look for to signal a bear market? Divergence between the Dow and the daily advance/decline line, a graph of the cumulative net difference between the number of New York Stock Exchange stocks advancing each day versus the number declining. The advance/decline tends to top out a few months before the Dow does. Did that happen in 1987? The advance/decline topped out during the first quarter of 1987, well before the stock market peak in August. Were you looking for a top because of that? Not at that point, because a lot of the individual stocks were still doing very well. The big clue that the market was really topping was after the Dow came off its high at 2,746, there was a very feeble, low-volume rally, and then the market got hit for another 90-point loss. At that juncture, I decided it was time to move out of the market. Because the rally was on low volume? Yes, and the fact that there were very few stocks that participated in the rally, the advance/decline line did not move as high as it did on the previous rally. Also, in late August, the discount rate was raised for the first time in 3 years. I think that really stabbed the market. You haven't been in the business that long. Do you have the confidence that you will be able to trade successfully almost every year for a long time? Yes, because I have established a very defined set of principles that will provide the foundation for successful trading for years to come. Also, I plan to never stop learning. 97. Do you feel you are getting better as a trader? Yes. If you try to learn from every single trade that you make, you are only going to get better and better as time goes on. Why are you so much more successful than the typical stock investor? Because I am doing something that I love to do and find fascinating. After 8 or 9 hours at work, I go home and spend more time on the markets. I have the charts delivered to me on Saturdays, and I go through them for 3 or 4 hours on Sunday. I think if you love what you are doing, you are going to be a lot more successful. A lot of people who invest use their spare time to study the market and still have only mediocre, or even losing, results. That is probably because they have not found a disciplined system for picking stocks. They read an article and say, "That sounds like a good stock, I'll buy it." Or they buy a stock because their broker recommends it. What advice would you give the novice trader? The single most important advice I can give anybody is, learn from your mistakes. That is the only way to become a successful trader. Any final comments? The greatest thing about the market is that it is always fun to be looking for that next big winner, trying to find the stock with all the characteristics that are going to make it have a big move. The feeling isn't any different now than when I was only trading 500 shares. There is still the same satisfaction of knowing you found a stock before it made its big move. You make it sound like a game. It is. To me, it is like a giant treasure hunt. Somewhere in here, he pats the weekly chart book, there is going to be a big winner, and I am trying to find it. The conventional wisdom about how to make money in stocks is summarized by the semi-facetious advice: buy low and sell high. David Ryan would disagree. His philosophy can be summarized as, buy high and sell higher. In fact, Ryan usually will not consider buying any stock selling for less than $10. Ryan's success is basically due to using a precise methodology and applying great discipline to follow it. As Ryan has clearly demonstrated, a trading methodology doesn't have to be original to be extremely successful. Ryan readily acknowledges that most of his approach has been learned directly from the writings and teachings of William O'Neill. With the help of hard work and in-depth study, he has been able to apply O'Neill's trading philosophy with great effectiveness. When traders deviate from their own rules, they invariably tend to lose. Ryan is no exception. During mid-1983 to mid-1984, he witnessed a period of extremely poor performance. He let his previous trading success go to his Head by repeatedly breaking one of his own cardinal rules: never buy an overextended stock, a stock that is trading far above its most recent price base. The 1983 to 1984 experience made a lasting impression on Ryan, and he has not repeated that mistake. Maintaining a trader's diary is an essential element of Ryan's approach. Every time he buys a stock, Ryan annotates the chart with his reasons for buying the stock. Whenever he liquidates or adds to an existing position, a new chart is included with updated comments. This approach has helped Ryan reinforce in his mind the key characteristics of winning stocks. Perhaps more important, reviewing his past entries has helped him avoid repeating similar trading mistakes. Ryan's basic approach, like William O'Neill's approach, is to buy value and strength. He also believes in focusing on the very best stocks as opposed to diversifying his portfolio. One important observation Ryan made, which many other traders may find helpful, is that his best trades are usually winners right from the start. Thus, he has little reservation about getting out of a losing trade quickly. The maximum he will risk on any trade is a 7% price decline. A rigid stop-loss rule is an essential ingredient to the trading approach of many successful traders. 98. Marty Schwartz, champion trader. I interviewed Marty Schwartz at his office after trading hours. I found him to be very opinionated and intense about the subject of trading. This intensity occasionally spills over into anger when a raw nerve is hit, such as program trading. In fact, Schwartz readily admits that he finds anger a useful trait in trading. None of this going with the market flow philosophy for Schwartz. In his view, the marketplace is an arena and other traders are the adversaries. I was also struck by Schwartz's dedication to his daily work routine. He was doing his market analysis when I arrived and continued to run through his calculations during our interview. When I left that evening, his analysis was still unfinished. Although he appeared very tired, I had no doubt that he would finish his work that evening. Schwartz has followed his daily work routine religiously during the past 9 years. Schwartz spent a decade losing money on his trading before he found his stride as a remarkably successful professional trader. During his earlier years, he was a well-paid securities analyst who, as he describes it, was always broke because of market losses. Eventually, he changed his trading methodology, in the process of transforming himself from a repeated loser to an amazingly consistent winner. Not only has Schwartz scored enormous percentage gains in every year since he turned full-time trader in 1979, but he has done so without ever losing more than 3% of his equity on a month-end to month-end basis. Schwartz trades independently from an office at home. He is proud of the fact that he has no employees. Solitary traders of this type, no matter how successful, are usually unknown to the public. Schwartz, however, has attained a degree of fame through repeated entries in the U.S. Trading Championships, run by Norm Zada, a Stanford University professor. His performance in these contests has been nothing short of astounding. In 9 of the 10 4-month trading championships he entered, typically with a starting stake of $400,000, he made more money than all the other contestants combined. His average return in these 9 contests was 210%, non-annualized. In the one remaining 4-month contest he witnessed a near break-even result. In his single entry in a 1-year contest, he scored a 781% return. Schwartz's entry into these contests is his way of telling the world that he is the best trader around. In terms of risk-reward ratios, he may well be. Please start by telling me about your early days. How far back do you want me to go? From whenever you think is appropriate. Well, it is very relevant to go back to my childhood, quite frankly. Should I lay down on the couch? I grew up in New Haven in a family of modest means. I was very hardworking. When I was 7 or 8, I would go out with a snow shovel and come back with $10 after a snowstorm. Even now, I still put in about 12 hours a day. I feel uncomfortable not doing the work, that's why I am doing it now as you are sitting here. I calculate a lot of mathematical ratios and oscillators, and I post my own charts. My attitude is that I always want to be better prepared than someone I'm competing against. The way I prepare myself is by doing my work each night. As I grew up, I realized that education was my ticket, probably because it was strongly emphasized in my family. I studied hard and was an honor student in high school. I was accepted to Amherst College, which was one of the great experiences of my life. When I went to freshman orientation, they said, look to your left and right and realize that half of you are going to be in the top half of the class and half of you are going to be in the bottom half. Most of those who matriculated there, including myself, were in the top 5% of their high school class. Perceiving that I wasn't going to be at the top of everything was a difficult first realization. It was the first time in my life I had to struggle. I even had to get a tutor for calculus because I just wasn't getting the concept. But when I finally got it, when the light bulb clicked on, it was like looking at a magnificent painting. I really experienced the joy of learning and working hard there. Before, studying was only a means to an end. Now, I found that learning itself was a real joy. Amherst had a profound influence on me. After graduating in 1967, one was accepted to the Columbia Business School. At the time, the government had just ended graduate school military deferments. Since I was unhappy at Columbia and combat in Vietnam didn't appeal to me, I joined a U.S. Marine Corps Reserve unit that was recruiting officers. You have to be somewhat crazy to be in the Marines. It is a very unusual organization. They push you to the edge and then rebuild you in their own mold. However, I have developed a great respect for that bureaucracy. Because throughout the Marine Corps history, they've been consistent in their training procedure. As a second lieutenant, you have 46 lives under your control, so you must be well skilled. They put you under a lot of pressure. If you couldn't cut the mustard, you didn't get the bars. We had an attrition rate that I believe approached 50%. I was the only reservist in officers' candidate school in Quantico at that time. There were 199 regulars who went to Vietnam, but I came home. That was the deal I made when I was recruited. I was also the only Jewish person there, and they weren't too favorably disposed toward Jews. One time, the platoon sergeant drew the Star of David on my forehead with a magic marker. I wanted to knock the crap out of him, but I figured he didn't really know the historic significance of what it meant. I knew he was just trying to find any kind of pressure point that would make me break. The hardest thing I had to do was scrub the magic marker off my forehead. That's a bitch, he laughs. Anyway, I persevered and made it through successfully. I consider that a really fine achievement. The feeling improves as time passes, and you forget the real pain of the experience. The rigorous Marine training gave me the confidence to believe that I could perform at levels beyond my previous expectations. Just as Amherst had strengthened my mind, the Marines strengthened my body. The two experiences convinced me that I could do almost anything if I worked hard enough and provided the groundwork for my successful trading. That's not to say it worked right away, because it didn't. After getting out of the Marines, I returned to Columbia and held some boring part-time jobs while I 99 completed my MBA. My first full-time job was as a securities analyst at Kuhn Loeb. I specialized in the health and retail field, and I stayed there for 2 years. I found that, on Wall Street, the best way to receive a pay increase was to change jobs. The company you work for never wants to pay you as much as a company trying to recruit you. I left for XYZ in 1972.1. Want to leave out the firm's name and other particulars for reasons that will soon become obvious. This proved to be one of the most difficult periods in my life and career. XYZ had 30 analysts, divided into 3 subgroups often. Because the research director didn't want to work, he had one of the senior analysts of each group review the work of the analysts. The policy was that our research reports would be circulated and critiqued by the other analysts within the subgroups prior to being sent out. I had written a bearish report on hospital management stocks, saying that the industry would eventually go to a utility rate of return. As part of the normal routine, the draft was circulated among the other analysts, one of whom got drunk one night on a flight home from California and told a client about my report. He even sent him a copy of the report in progress. What right did he have to send out my work? The stocks began plummeting prior to the report's release because the client started spreading rumors that a negative report was about to be issued. It was a bitter experience. I had to testify for 6 hours before the New York Stock Exchange. My company's counsel told me, "We will represent you, but should our interests diverge at any point, we will inform you." At the time, did you know what had happened? No, I didn't, but I assumed that everything would be all right if I told the truth, which I did. I was totally exonerated. The exchange realized I had been set up. The drug analyst eventually confessed because an exchange official found out what happened by piecing it all together. It was a rotten, bitter experience for me, and I was very sour. I shut the door of my office and stopped working. I lost the spark, the drive, the desire to succeed. What were you doing at that time? I was still doing reports. But I didn't have my heart in it. Besides that whole negative experience, it was early 1973, and I felt the market was topping out. I had become very interested in technical analysis. At the time, the advance/decline line had formed a major top many months earlier. I felt that the market and the stocks I was covering were going to go down. Still, people wanted to know how many widgets a company was selling and at what price. I lost the spirit to write bullish reports, because if stock prices are going down, who cares how many widgets are being sold? I was covering growth stocks, which in those days sold at 40 or 50 times earnings. It was all so ridiculous. Were you discouraged from writing bearish reports? Also, whatever happened to the bearish report that was leaked? Nobody wrote bearish reports on Wall Street at that time. I was allowed to complete the bearish report on the hospital management industry, but I don't believe they ever intended to publish it. Of course, after it was leaked, they were forced to rush it to the printer to save their scalps. What eventually happened? I lost my job in the bear market and was out of work for 4 months. That was a very interesting period. Because I believe you learn the most through adversity. I had about $20,000, which in those days was a lot of money, and I was going to trade. I found a real lunatic who had developed computer programs for trading commodities. At the time, he had to rent time on a monster machine to run programs that today you could do on any PC. He was using different moving averages, that sort of thing. I put some of my money in with him, and I lost most of it, along with my dreams of glory. Having dissipated my capital, I decided I had to go back to work. I was in for a shock. Although I had been totally honest and forthright, I was tainted. "Oh, aren't you the guy who wrote that report?" It didn't matter that I had been totally ethical and exonerated. People don't want to get involved with any controversy, even if it wasn't of your own making. A friend of mine helped me get a job at Edwards and Hanley, which, although it was a retail-oriented firm, had a group of analysts who became real stars. It was there that I met Bob Zollner, the managing partner of the firm. He was a great, great trader. He almost single-handedly kept the firm afloat in 1974 by shorting stocks and making money in the firm's capital account, while they were losing money on the operating side. He started his own hedge fund in 1976 and went on to become an extraordinary success. I always had a good nose as a securities analyst, and it has stood me in good stead. When I noticed that the head of research, who never went out to lunch, began going out to lunch regularly, I started interviewing for another job. So, when the firm went bankrupt in fall 1975, I had another job lined up at Loeb Roads. In 1976, one met my wife-to-be, and she had a profound effect on me. She made me realize that my life was not a dress rehearsal, it was the real thing, and I had been screwing it up. Although I had steadily earned good salaries, I was still almost broke because I consistently lost money in the market. We got married in March 1978. By that time, I was working at E.F. Hutton. Being married made going on business trips harder and harder. When you are 25, seeing friends from college in different cities around the country is very exciting. But when you get in your 30s, it gets real stale. My wife literally had to push me out the door when I had to go on these trips. I resented what I called the tap dances, which made you feel like a piece of meat. You meet with portfolio managers to give them your views on the stocks you follow, so that they will give commission business to your firm. On a typical trip, you might have 5 appointments in Houston, fly to San Antonio for dinner, and then fly to Dallas later that night to be ready for breakfast the next morning. I got sick of it. I wanted to have a family, but I felt that I wasn't able to handle it financially. I had resisted getting married because I was afraid of being tapped out. But, at that point, I wondered whether it had been a self-fulfilling prophecy. People seem to know how to handle failure because they can produce it themselves. It almost becomes a negative cause and effect cycle, whereby they produce it, they know how to handle it, and they wallow in it. By mid-1978, one had been a security analyst for 8 years and it had become intolerable. I knew I had to do 100. Something different. I always knew I wanted to work for myself, have no clients, and answer to no one. That, to me, was the ultimate goal. I had been brooding for years, why wasn't I doing well when I was groomed to be successful? I decided it was now time to be successful. When a brokerage firm wants to hire you, they'll give you anything. Once you are there, they are far less responsive. So, when I was being romanced by Hutton, I asked for a quote machine in my office. I was the only securities analyst that had a quote machine. During my last year at Hutton, I started closing the door to my office so that I could watch the market. I talked to my friend Bob Zollner several times a day, and he taught me how to analyze market action. For example, when the market gets good news and goes down, it means the market is very weak. When it gets bad news and goes up, it means the market is healthy. During that year, I started taking trial subscriptions to a lot of different newsletters. I consider myself a synthesizer. I didn't necessarily create a new methodology, but I took a number of different methodologies and molded them into my own approach. I found a guy, Terry Laundrie, who lived in Nantucket and had an unorthodox approach called the magic forecast. He was an engineering graduate with a math background, and that appealed to me. His basic theory was that the market spent the same amount of time going up as going down. Only the amplitude was different. In my experience, markets come down a lot quicker than they go up. Doesn't that contradict the theory? The market movement before it goes down may be a distributive process. I call them M-tops. The point you use to measure the time element is not the price high, but an oscillator high, which precedes the price high. That, in fact, is a major cornerstone of his work. The theory had different properties that I learned, and it has been extremely helpful to me. For the record, what is the name of Laundrie's book? There is no book. He just extolled his theory through his various newsletters. He also had some pamphlets. Actually, it was kind of funny. After I mentioned him in a Barron's article, he got a lot of inquiries for his pamphlets. He is a little eccentric. His response was, "I don't have any copies available." He should have printed them and made some money. I developed and synthesized a number of indicators that I used to determine when the market was at a lower risk entry point. I focused on determining mathematical probabilities. Although occasionally there are situations where the market goes 3 standard deviations instead of 2, based on the likelihood that 98% of the moves will stop it, I came to realize that I could see much more sitting at the desk, looking at a machine, than being at a post, trading an option. On the floor, the specialists chose the symbols they wanted to keep on the quote machines, because they paid the rent on them. So, you always had to run around to find what you wanted to see. I felt much more comfortable upstairs. About a year and a half later, after I started earning a lot of money, the floor wasn't big enough. There was a much bigger arena to play in. Another reason for my move was the fact that, in 1981, a change in the tax laws made it more lucrative to trade futures than stocks and options. In my futures trading, I didn't try to make 2 one year, for the next, 8 the next, etc. I didn't earn 101 significantly more in my futures trading in 1987 than I did in 1982, because I used my profits to invest in real estate and other things to enhance the quality of my life. I was broke in the 1970s, and I never wanted to be broke again. My philosophy was that if you make money every month, nothing bad is going to happen to you. So, you won't be the richest person. You'll never be the richest person anyway. What difference does it make? I'm proud of my futures trading, because I took $40,000 and ran it up to about $20 million with never more than a 3% drawdown. Did you continue trading stocks during this period? Yes, but with a different mentality. I traded stocks from a little longer time horizon. I don't feel the same pressure when I own 100,000 shares of stock as when I own 100 S&Ps. Will you trade stocks as readily from the short side as the long side? No, I find it harder to trade stocks from the short side. Because of the uptick rule? No, it is just easier to short the S&P, because you get so much more bang for the buck. Also, I hate the specialist system. They are always trying to con you to death. I'll give you my view on specialists. Never in my life have I met a less talented group of people who make a disproportionately large amount of money relative to their skills. Having the specialist book is the most extraordinary advantage one could ever ask for. In normal markets, the specialists can always define their risk. If they have a bid for 20,000 down / they can buy the stock, knowing they can always get out / lower. So, they are protected. I always tell my friends to have their daughters marry the son of a specialist. I can't stand most established institutions. I have a me against them mentality, which I believe helps me be a better, more aggressive trader. It helps as long as I maintain an intellectual bias in my work and discipline in money management. What was your experience during the week of the October 19th stock crash? I came in long. I have thought about it, and I would do the same thing again. Why? Because on October 16th, the market fell 108 points, which, at the time, was the biggest one-day point decline in the history of the stock exchange. It looked climactic to me, and I thought that was a buying opportunity. The only problem was that it was a Friday. Usually a down Friday is followed by a down Monday. I don't think Monday would have been nearly as bad as it was, if Treasury Secretary James Baker had not started verbally bludgeoning the Germans about interest rates over the weekend. He was so belligerent. Once I heard Baker, I knew I was dead. So, you knew that you were in trouble over the weekend? Yes. Also, Marty Zweig, who is a friend of mine, was on Wall Street Week on Friday evening, talking about a Possible depression. I called Marty the next day, and he said he thought there was another 500 points risk in the market. Of course, he didn't know it was going to happen in one day. What made him so bearish at the time? I think his monetary indicators were terribly negative. Remember, the bonds were sinking rapidly at the time. What happened that Monday? When did you get out? The high in the S&P on Monday was 269.1. Liquidated my long position at 267/2.1. Was real proud of that. Because it is very hard to pull the trigger on a loser. I just dumped everything. I think I was long 40 contracts coming into that day, and I lost $315,000. One of the most suicidal tilings you can do in trading is to keep adding to a losing position. Had I done that, I could have lost $5 million that day. It was painful, and I was bleeding, but I honored my risk points and bit the bullet. That's another example where my Marine training came into play. They teach you never to freeze when you are under attack. One of the tactics in the Marine Corps Officer's Manual is either go forward or backward. Don't just sit there if you are getting the hell beat out of you. Even retreating is offensive, because you are still doing something. It is the same thing in the market. The most important thing is to keep enough powder to make your comeback. I did real well after October 19th. In fact, 1987 was my most profitable year. You liquidated your long position very well on October 19th. Did you think about actually going short? I thought about it, but I said to myself, now is not the time to worry about making money, it is the time to worry about keeping what you have made. Whenever there is a really rough period, I try to play defense. I believe in protecting what you have. The day of the crash, one got out of most of my positions and protected my family. Then at 1:30 p.m., with the Dow down 275 points, I went to my safe deposit box and took my gold out. Half an hour later, I went to another bank and started writing checks to get my cash out. I started buying treasury bills and preparing for the worst. I had never seen anything like what was going on. You were seriously worried about the banks going under? Why not? The stories I heard, subsequently, from people on the operations side of the business would have stopped the hearts of the public if they had known what was going on. The banks weren't meeting any of the calls at the brokerage firms. On Tuesday morning, we were within hours of the whole thing totally collapsing. So my caution was well advised. I think my fear of a depression is related to my father graduating college in 1929. If you talk to people who got out of college at that time, it is as though a 10-year period is missing from their lives. There was just nothing substantial going on in this country. That always stuck with me, because I feared it so much. I think that is one of the reasons why I don't try to increase my earnings geometrically. On the day of the crash, when I looked at my son in 102 his crib, I thought, I don't want him ever to ask me, Dad, why didn't you do everything you could have done? When did you start trading again? Wednesday of that week. It was funny because I started out trading only 1 or 2 S&P contracts at a time. The S&P was trading in full point increments, equivalent to $500 per contract, compared to $25 for a minimum tick. And I didn't know how to handicap what was going on. From past experiences, I knew we were in some sort of opportunity period, but they were rewriting the rule book. My attitude is, never risk your family's security. I didn't need to make any more money at that point. On Wednesday, the market got up to an area where I thought it should be shorted. I ended Wednesday short 12 S&P contracts, which for me was a minuscule position. That night, Bob Prechter, editor of the Elliott Wave Theorist, a widely followed advisory letter, put out a negative hotline message. The next morning, the market was under tremendous pressure, partially because of that. Recommendation, but mainly because one of the biggest fund managers in the country was trying to liquidate a monster long position. It has been stated that he lost $800 million during that period. I called the S&P pit just before the opening that morning, and my clerk said, Decembers are offered at 230. Offered at 220, offered at 210, trading at 200 even. I yelled, cover. I made $250,000 on 12 contracts. It was one of the most memorable trades of my life. What are your thoughts about program trading? See Appendix 1 for definition. I hate it. There used to be a natural ebb and flow in the market, but program trading killed it. Those firms doing program trading wield extraordinary power to move the market, and the locals have simply become accomplices. I'm not just paranoid, because I've adjusted to it and been successful. But I hate it. Some people say that all this criticism of program trading is a bunch of nonsense. Well, they are idiots. No, some of them are very intelligent people. No, they are idiots. I can prove to any one of them that they are idiots. How do you prove it? There is something I would like the regulators to investigate. The market closes near the high or low of the day much more frequently than it used to. During the last 2 years, the market has closed within 2% of the high or low of the day about 20% of the time. Mathematically, that type of distribution is impossible by chance. You talk about program trading as if it is immoral. What is unethical about trading stocks against futures? Because the program traders also have the other side of the equation to do. You have the so-called Chinese wall in investment banking, where they don't want the arbitrageurs and investment bankers on the same floor for fear they might talk to each other. Well, I would like the SEC to explain to me how they can allow agency program traders sitting alongside principal traders for the firm's own account. Your example introduces an element of front-running, which obscures the basic question. What I and C. An outright trade. It is not a program trade. Let me give you an example. Let's say a trading firm has a computer program that signals when stocks are overpriced or underpriced relative to futures, and they are not doing any customer business. Let me give you an example first. If these brokerage firms need an 80-cent discount to take off a customer program, they will take off their own position at a 50-cent discount. They have the edge and can run in front of their clients because their transaction costs are lower, they're not paying commissions to themselves. I keep trying to separate these things out. Let's take an example where there is, whenever you try to get all your losses back at once, you are most often doomed to fail. That is true in everything, investments, trading, gambling. I learned from the crap table at Las Vegas to keep only X dollars in my pocket and never to have any credit, because the worst thing you can do is to send good money after bad. If you can physically remove yourself from the premises, which is the same thing in futures trading as getting flat, you can see things in a whole different perspective. After a devastating loss, I always play very small and try to get black ink, black ink. It's not how much money I make, but just getting my rhythm and confidence back. I shrink my size totally, to a fifth or a tenth of the position that I trade normally. And it works. I think I ended up losing only $57,000 in November 1982, after taking a $600,000 hit on November 4th. Is there any trading mistake that you could isolate as responsible for that election day, 1982? Loss? Adding to shorts when the futures market is already locked limit against you and the cash market looks like it is 200 points higher is pretty stupid. When you look back, do you say, why did I do it? I think because I had huge gains the month before. I've always had my biggest setbacks after my biggest victories. I was careless. Do you still make trading mistakes? By that, I mean deviations from trading principles you consider valid, not losing trades. You always make trading mistakes. I made one just recently, a terrible mistake. I was short the S&P and short the bonds, and I got nervous because the bonds moved above their moving average. However, T-bills had not followed suit. One of my rules is not to have a position when my moving averages in T-bills and bonds diverge, that is, when one moving average is above the price and the other below, because interest rates can't move very far until one confirms the movement of the other. According to my rules, I should have moved my bond position from short to flat. Instead, I reversed from short to long. I paid dearly for that mistake. Whereas, I had lost only about $20,000 on my original short position, the next day I had a six-figure loss, my largest loss of the year. The great thing about being a trader is that you can always do a much better job. No matter how successful you are, you know how many times you screw up. Most people, in most careers, are busy trying to cover up their mistakes. As a trader, you are forced to confront your mistakes because the numbers don't lie. From time to time, you have alluded to your trading rules. Can you list them? Reading from a list and extemporizing, I always check my charts and the moving averages prior to taking a position. Is the price above or below the moving average? That works better than any tool I have. I try not to go against the moving averages, it is self-destructive. Has a stock held above its most recent low, when the market has penetrated its most recent low? If so, that stock is much healthier than the market. Those are the types of divergences I always look for. Before putting on a position, always ask, do I really want to have this position? After a successful period, take a day off as a reward. I found it difficult to sustain excellent trading for more than 2 weeks at a time. I've had periods where I can be profitable for 12 days in a row, but eventually, you just get battle fatigue. So, after a strong run of profits, I try to play smaller rather than larger. My biggest losses have always followed my largest profits. This next rule is a major problem for me, I'm always trying not to break it. The rule, bottom fishing, is one of the most expensive forms of gambling. It's okay to break this. Based on month-end data, my biggest drawdown was 3%. I had my worst 2 months around the birth of my 2 children, because I was worried about whether I was going to get the tennis ball in the right place in Lamaze class. My philosophy has always been to try to be profitable every single month. I even try to be profitable every single day. And I've had some extraordinary runs, over 90% of my months have been profitable. I'm particularly proud of the fact that, in virtually every year, I didn't have a losing month before April. I probably don't make as much money as I could because of that, but I'm more concerned about controlling the downside. You start off every year with a clean slate? That's my philosophy. January 1st, I'm poor. Do you trade smaller in January? Not necessarily. It is just that my attention is greater. Do you take your losses more quickly in January? No, I always take my losses quickly. That is probably the key to my success. You can always put the trade back on, but if you go flat, you see things differently. Greater clarity? Much greater clarity, because the pressure you feel when you are in a position that is not working puts you in a catatonic state. Getting back to managed money, I wonder, after years of making plenty of money trading on your own, what possible motive could you have for bothering with managing other people's money? I felt that I was getting a little stale, and this presents a whole new challenge. Also, after October 1987, one realized that downside risk can't be adequately measured. The way to get more personal leverage is with an outside pool of money. How much money are you going to be managing? I don't want to be specific about the amount, but I'm only taking on 1 or 2 large pools of money. I don't want to deal with multiple investors, even though I'm certain I could raise a great deal more money if I went with a public underwriting. The more people you have involved, the more potential headaches. For example, when I met a large fund manager, he asked me how many employees I had. I told him, none. He told me he had 70. When he wants to quit, it will be more difficult because he'll have their lives in his hands. I don't want that kind of pressure. You seem rather isolated here. Do you like working alone? It took me several years to be able to accept working alone. I used to go to a downtown office because a lot of my friends were there. But, as time passed and fewer of those people were still there, the attraction diminished significantly. Now, I have half a dozen people I talk to on the phone daily. I've taught my methodologies to a number of them, and they have methodologies of their own. Have you ever tried training people to be traders working for you? I hired 4 people, but nobody lasted. They all became intimidated. I tried to clone myself and it didn't work. 105. I taught them all my methodologies, but learning the intellectual side is only part of it. You can't teach them your stomach. Why do most traders lose money? Because they would rather lose money than admit they're wrong. What is the ultimate rationalization of a trader in a losing position? I'll get out when I'm even. Why is getting out even so important? Because it protects the ego. I became a winning trader when I was able to say, to hell with my ego, making money is more important. What do you tell people who seek your advice? I always try to encourage people that are thinking of going into this business for themselves. I tell them, think that you might become more successful than you ever dreamt, because that's what happened to me. I have the freedom I always wanted, both financially and structurally. I can go on vacation at any moment. I live in West Hampton Beach half of the year and in New York the other half. I have a wonderful lifestyle. My kids think all fathers work at home. What is the best advice you can give to the ordinary guy trying to become a better trader? Learn to take losses. The most important thing in making money is not letting your losses get out of hand. Also, don't increase your position size until you have doubled or tripled your capital. Most people make the mistake of increasing their bets as soon as they start making money. That is a quick way to get wiped out. Marty Schwartz's story should encourage those whose initial attempts at trading have met with failure. Here is a trader who was unsuccessful over a 10-year period, managing to lose enough money to keep himself near broke, despite consistently earning good salaries. Yet, Schwartz was eventually able to turn things around and become one of the world's best traders. How did he do it? There were 2 essential elements. First, he found a methodology that worked for him. Throughout his losing years, Schwartz used fundamental analysis to determine his trades. It was not until he immersed himself in technical analysis that he became successful. The point here is not that technical analysis is better than fundamental analysis, but rather that technical analysis was the methodology that was right for him. Some of the other traders interviewed in this book, such as James Rogers, have been very successful using fundamental analysis to the complete exclusion of technical analysis. The key lesson is that each trader must find his or her own best approach. The second element behind Schwartz's transition to success was a change in attitude. As he describes it, he became successful when his desire to win took precedence over his desire to be right. Risk control is an essential element of Schwartz's trading style, as attested to by his incredibly low drawdowns. He achieves this risk control by always knowing his uncle point on any trade. No doubt, his approach of sharply reducing position size after large losses, as well as extended winning streaks, contributes heavily to his success. The rationale for reducing position size after a destabilizing loss is apparent. However, the reason for taking the same action after a winning streak deserves further elaboration. As Schwartz explains it, he has always experienced his biggest losses after his biggest gains. I suspect this is true for the majority of traders. Winning streaks lead to complacency, and complacency leads to sloppy trading. Most traders cite similar rules, such as discipline and hard work, as the reasons for their success. Therefore, it is always a treat when a top trader provides a rule that is unique and rings true. I was fascinated with Schwartz's observation about maintaining a position that you are worried about, when the market action doesn't justify your fears. The implicit concept is that if the market is letting you off the hook easily on a position for which there was a basis for fear, such as a fundamental development adverse to the position or a technical breakout in the opposite direction, there must be strong underlying forces in favor of the direction of the original position. 106. 107. Part 3: A little bit of everything. 108. James B. Rogers, Jr. Buying value and selling hysteria. Jim Rogers began trading the stock market with a paltry $600 in 1968. In 1973, he formed the Quantum Fund with partner George Soros. The Quantum Fund proved to be one of the best performing hedge funds, and in 1980, having amassed a small fortune, Rogers retired. Retired is the word Rogers uses to describe the management of his personal portfolio, an endeavor that requires considerable ongoing research. His retirement also includes teaching investment courses at the Columbia University Graduate School of Business. I was eager to interview Rogers because of his stellar reputation as one of the shrewdest investors of our time, and because his comments on television financial interview shows and in the print media always seemed to strike a note of common sense with rare clarity. Since I did not know Rogers, I sent him a letter requesting an interview, explaining that I was working on a book on great traders. I included a copy of my previous book on the futures markets, which I inscribed with a quotation from Voltaire that I deemed particularly appropriate: "Common sense is not so common." Rogers called a few days later to thank me for the book and to indicate his willingness to participate. However, he cautioned, "I am probably not the person you want to interview. I often hold positions for many years. Furthermore, I'm probably one of the world's worst traders. I never get in at the right time." He was referring to the distinction I had made in my letter, indicating that I was interested in great traders rather than great investors. As I use the term, a trader would be primarily concerned with which direction the stock market was heading, while an investor would concentrate on selecting stocks with the best chance of outperforming the market overall. In other words, the investor was always long, while the trader might be long or short. I explained my use of these terms to Rogers and stressed that he was indeed the type of person I wished to interview. I arrived at Rogers' home, a baronial, eclectically furnished townhouse, on a fall-like spring afternoon. The atmosphere seemed more reminiscent of a comfortable English manor than a home in New York City. In fact, if my only exposure to New York City was that afternoon's conversation with Rogers in his antique-filled sitting room, with its pleasant views of the Hudson, I would conclude that New York City was an eminently peaceful place to live. After greeting me, Rogers immediately stated, "I still think you have the wrong man." Once again, he was referring to the fact that he did not consider himself to be a trader. This is the note on which the following interview begins. "As I told you in our phone conversation, I don't consider myself a trader. I remember when I went to buy German stocks in 1982, one said to the broker, 'I want you to buy me X, Y, and Z stocks.' The broker, who didn't know me, asked, 'What do I do next?' I said, 'You buy the stocks and send me the confirmations.' He asked, 'Do you want me to send you some research?' I said, 'Please don't do that.' He asked, 'Do you want me to send you opinions?' I said, 'No, don't.' He asked, 'Do you want me to call you with prices?' I said, 'No, don't even give me prices. Because if you do, once I see that these stocks have doubled and tripled, I might be tempted to sell them. I plan to Own German stocks for at least 3 years, because I think you are about to have the biggest bull market you've had in 2 or 3 generations. Needless to say, the broker was dumbfounded. He thought I was a madman. Now I don't consider that trading, it was determining that there was about to be a major change in a market. And taking a position. By the way, I got that one right. I bought the German stocks at the end of 1982 and sold them out in late 1985 and early 1986. What made you so bullish on Germany at that time? The bull market had started here in August 1982. More important, Germany had not had any kind of bull market since the previous all-time high in 1961, 21 years earlier. The German market had crumbled in 1962 and had essentially gone sideways since then. In the meantime, the German economy had boomed. So there was basic value there. Whenever I buy or sell something, I always try to make sure I'm not going to lose any money first. If there is very good value, then I'm probably not going to lose much money even if I'm wrong. But you could have bought that market 10 years earlier on the same theory. That's absolutely right. You could have bought it in 1971 for exactly those reasons and watched German stocks sit for 10 years, while we had a major bull market in the US. But this time there was a catalyst. You always need a catalyst to make big things happen. At the time, the catalyst was the upcoming German elections. I figured the socialists were going to be thrown out, and I knew that the opposition party, the Christian Democrats, had a platform designed to encourage investment. My basic assessment was that if the conservative Christian Democrats won the election after having been out of power for so many years, they were going to make major changes. I also knew that many German companies were holding back from investing in capital equipment and expansion in 1982 in anticipation of a conservative victory. Therefore, if the conservatives did win, there would be a real explosion of pent-up capital investment. Was the election a toss-up at the time? Not in my mind. I mean in terms of the polls. I guess so, because when the conservatives did win, the market exploded FLMT same day. What if they had lost? I still didn't think I would have lost any meaningful money for the reasons I mentioned before. I had every anticipation that there was going to be a major change, and that the bull market would last for 2, 3, or 4 years. It sounds like you have a great deal of conviction when you put on a trade. Yes, I usually do, otherwise, I don't bother doing it. One of the best rules anybody can learn about investing is to do nothing, absolutely nothing, unless there is something to do. Most people, not that I'm better than most people, always have to be playing, they always have to be doing something. They make a big play and say, boy, 109. I smart, I just tripled my money. Then they rash out and have to do something else with that money. They can't just sit there and wait for something new to develop. Do you always wait for a situation to line up in your favor? Don't you ever say, I think this market is probably going to go up, so I'll give it a shot. What you just described is a very fast way to the poorhouse. I just wait until there is money lying in the corner, and all I have to do is go over there and pick it up. I do nothing in the meantime. Even people who lose money in the market say, I just lost my money, now I have to do something to make it back. No, you don't. You should sit there until you find something. Trade as little as possible. That is why I don't think of myself as a trader. I think of myself as someone who waits for something to come along. I wait for a situation that is like the proverbial shooting fish in a barrel. Are all your trades fundamentally oriented? Yes. Occasionally, however, the Commodity Research Bureau charts will provide a catalyst. Sometimes the chart for a market will show an incredible spike either up or down. You will see hysteria in the charts. When I see hysteria, I usually like to take a look to see if I shouldn't be going the other way. Can you think of any examples? Yes. 2 years ago, I went short soybeans after they had gone straight up to $9.60. The reason I remember it so vividly is because that same evening, I went to dinner with a group of traders, one of whom was talking about all the reasons why he had bought soybeans. I said, I really can't tell you why all the bullish arguments are wrong, all I know is that I'm shorting hysteria. How do you pick the time to go against the hysteria? I wait until the market starts moving in gaps in the midst of it all, or do you wait for some sign of an end to the move, for example, a reversal day? No, I don't know about reversal days. That brings to mind a classic example of hysteria. In late 1979, early 1980, the gold market witnessed an incredible accelerated advance. Did you go short that market? Yes, I sold gold at $675. That was almost $200 too early. I told you I'm not a good trader. I'm nearly always too early, but it was only about 4 days before the top. I didn't say you were way off time-wise, but price-wise it must have been a pretty scary ride. When you do a trade like that, isn't there a point where you have second thoughts? Yes, when it goes to $676, he laughs. But you stayed with the trade? Yes, in that case, because it was chaos. It was something that couldn't last. It was the gold markets dying. Gasp. Was that a matter of recognizing the fingerprint of a market in its final blow-off, or was it a matter of gold being overpriced? Both. Gold was overpriced, but basically it was, I like your terminology, the fingerprint of hysteria. Just about every time you go against panic, you will be right if you can stick it out. So when you see panic, do you automatically go against it? The panic, the hysteria, in and of itself is only a catalyst to make me look to see what is going on. It doesn't mean I'm going to do anything. In the case of the early 1980 gold market, I had a view of the world that was bearish. For gold, Volcker had just become the Federal Reserve Chairman a few months earlier and said that we were going to beat inflation. I believed he meant it. I also happened to be bearish on oil at the time, and I knew that if oil went down, gold would go down as well. Was that because you thought gold and oil should move together? Or because you thought the rest of the world believed that? At that time, everybody in the world believed that. But, did you believe that the relationship was true? I knew that it was not true. The reason I asked is that I have always felt that the relationship between gold and oil was a coincidental correlation. Yes, that was all it was. For one very short period of time, gold and oil moved together. Does that mean you will sometimes do a trade based on a relationship you know doesn't really make any sense, simply because you think that the rest of the world believes it? Rarely. I usually like to look at what I think is the fact, the truth. The main item then was that I thought Volcker meant it when he said he was going to break the back of inflation. The fact that oil was ready to go down anyway was just the kicker. Actually, the decisive step came in October 1979, when the Fed changed its policy from controlling interest rates to controlling money supply growth. Yet the gold market apparently didn't believe it. 110. Because it went up for several months after that point. In situations like that, are the markets too wound up in their hysteria to pay attention to changing fundamentals? Absolutely. It is AMA/ING how sometimes something important will happen, and the market will keep going despite that. Now, I am experienced enough to know that just because I see something doesn't mean that everyone sees it. A lot of people are going to keep buying or selling just because that has been the thing to do. So, just because the market doesn't respond to some important news, such as the October 1979 change in Fed policy, doesn't mean that it isn't important. All the better. If the market keeps going the way it shouldn't go, especially if it is a hysterical blow-off, then you know an opportunity will present itself. Can you think of a more recent example? Yes, October 1987. October 19th is my birthday, by the way. At the end of 1986 and the beginning of 1987, one had predicted that we would have one more big move up in the stock market and then witness the worst bear market since 1937. But I didn't know it was going to happen on my birthday. It was the best birthday present I ever had. Did you have any idea that the break could be as large as it was? When John Train interviewed me in January 1987, one told him, somewhere along the way, the market is going to go down 300 points in one day. He looked at me as though I were a madman. I envisioned that the Dow would be around 3,000, and 300 points would only be 10%. In 1929, the market went down 12% in one day. 10% in one day was not such a big move, given the kind of markets we were having then. The market had already seen a number of 3, 4, and 5% days. So I said, why can't the market go down 300 points in a day? Little did I know it would be 508 points. Why did you pick 1937 as a comparison in your prediction for a stock market collapse? Because in 1937, the Dow went down 49% in 6 months. What I was trying to say was that we were going to have a major, fast, deep, horrible collapse, as opposed to say 1973 to 1974, when the market went down 50%, but it took 2 years. Why did you use 1937 as an analogy as opposed to 1929 to 1930? Because 1929 to 1930 went on to be a major depression. I knew we were going to have a bear market caused by a major financial collapse. I was not convinced we were going to have a depression. I was differentiating between a financial and economic collapse. Why were you expecting a financial collapse? It was the atmosphere. Money was flooding the world. Every stock market in the world was at an all-time high. You had all these stories of young guys, 3 years out of school, making $500,000 a year. That is not reality. Whenever you see that in a market, you are near a top. So, I went into the summer positioned for a collapse. Were you short stocks or long puts? I was short stocks and short calls. I don't buy options. Buying options is another fast way to the poorhouse. Someone did a study for the SEC and discovered that 90% of all options expire as losses. Well, I figured out that if 90% of all long option positions lose money, that meant that 90% of all short option positions make money. If I want to use options to be bearish, I sell calls. When did you cover your positions? During the week of October 19th. If you remember, by that time, everybody thought that the financial structure of America was over. Did you cover then because we had hysteria going the other way? That is exactly right. That week was a textbook case of hysteria. Under those kind of conditions, if you are still solvent, you have to step in there and go against it. Maybe that was going to be the one time it was the end of the world, and I would have been wiped out too. But 95% of the time when you go against that kind of hysteria, you are going to make money. Between October 1987 and January 1988, one didn't have any shorts. That was one of the few times in my whole life that I didn't have any shorts. Whether I am bullish or bearish, I always try to have both long and short positions, just in case I'm wrong. Even in the best of times, there is always somebody fouling up, and even in the worst of times, there is somebody doing well. Are you implying that after the collapse, you couldn't find any stocks you wanted to be short? I thought that if I were right and the world wasn't coming to an end right away, everything was going to go up, including those stocks that I knew, fundamentally, were coming apart at the seams. In January 1988, I started putting a couple of shorts back on, and even though I am losing money on one of those shorts, I am happy to do it. Because I feel more comfortable having the protection of some short positions. A lot of people blame the October 1987 break on program trading. Do you consider that scapegoatism? Absolutely. The people who blame it on that do not understand the market. Politicians and people who lose money always look for scapegoats. In 1929, they blamed the crash on short sellers and margin requirements. There were lots of good reasons why the stock market went down. What they should focus on is why there were sellers on October 19th, but no buyers. I remember why I became even more bearish on the weekend before October 19th. The week before, Federal Reserve Chairman Alan Greenspan announced that the balance of trade was getting much better and things were under control. 2 days later, the balance of trade figures came out, and they were the worst in the history of the 111 world. Right away I said, this guy is either a fool or a liar. He doesn't have any idea what is going on. Then on the weekend before October 19th, you had Treasury Secretary Baker telling the world we were going to stick it to the Germans by letting the dollar go. Because the Germans weren't loosening monetary and fiscal policy as Baker had demanded. It looked like the trade wars of the 1930s all over again. I was in a panic, and I was already short. I called Singapore that Sunday night to add to my shorts. Singapore opens earlier than we do. So all those guys who came in on Monday to sell had very, very good reasons to sell, and there were no buyers around. There were no buyers, because there was no reason for people to buy. Even the buyers were scared and bearish that Monday. Are you saying the crash was caused by Greenspan and Baker? There were a lot of causes: Greenspan, Baker, the fact that money was tight, the steady worsening of the balance of trade, and you had a market that had spiked up to 2,706 weeks earlier. If you check, you will see that during 1987, while the S&P and the Dow were going up, the rest of the market was quietly eroding away. In December 1986, one shorted the financial stocks, and throughout 1987 one didn't lose any money, even though the Dow and the S&P were going through the roof. Were there any times you faded hysteria and lost? Yes, one of my greatest lessons happened in my early days and taught me about bear markets. In January 1970, a time when I still bought options, I took all the money I had, which wasn't very much, and bought puts. In May 1970, the market caved in, and the day the market hit bottom, I sold my puts. I had tripled my money. I was a genius. I'm going to be the next Bernard Baruch, I said to myself. My plan then was to wait for the market to rally and this time to sell short instead of buying puts so that I would make money faster. Sure enough, the market rallied, and I took everything I had and went short. Needless to say, 2 months later, I was completely wiped out because I didn't know what I was doing. One of the stocks I had shorted was Memorex. I sold Memorex at 48. In those days, I didn't have the staying power, psychologically, emotionally, and, most important, financially. I ended up covering my shorts at 72. Memorex eventually went to about 96 and then went straight down to 2. I was dead right, absolutely, flat out, perfectly right to short that stock at 48.1, just ended up getting completely wiped out. The market didn't care that I was dead right. That is one of the reasons that I now know about hysteria. What did you learn from that particular experience? That the market is going to go higher than I think it can and lower than I think it will. I had a tendency to think that if I knew something, everybody knew it. I would just read things in the paper, I didn't have any inside information. What I now know is that they don't know what I know. Most people don't have the foresight to look 6 months, 1 year, or 2 years out. The Memorex experience taught me that anything can happen in the stock market, because there are a lot of people in the market who don't understand what is going on. Are you looking for a very pronounced bear market beyond what we have already seen? Yes, eventually I expect the market to break the October 1987 low. Do you expect a very deep recession as well? Right now, April 1988, I'm still looking mainly for a financial collapse. However, the politicians may foul it up and turn it into an economic collapse. Can we get a financial collapse without actually having a very serious recession? Sure. It has happened lots of times. That is why I used 1937 as an example before. I don't expect the economy to collapse because as the dollar keeps getting weaker, which is what I expect, many parts of the American economy will do well: steel, agriculture, textiles, mining. So even if the stock market falls below the October low, you can still see the economy doing well? Absolutely. Unless the politicians foul it up. By doing what? Raising taxes, tariffs, protectionism. There are lots of things the politicians can do to foul it up, and I'm sure they will, they always have. I know we will have a financial crisis. And if the politicians get it wrong, we may get an economic collapse as well. What is going to trigger the financial collapse? The trade figures will start getting worse again, and this will eventually precipitate another dollar crisis. What do you see as the main cause of the trade deficit? The budget deficit, by and large, causes the trade deficit. You are not going to get rid of the trade deficit until you get rid of the budget deficit. Given the magnitude of the deficit problem, is there anything that can be done at this point? The basic problem in the world today is that America is consuming more than it is saving. You need to do everything you can to encourage saving and investment, eliminate taxation of savings, the capital gains tax, and dual taxation of dividends, bring back the more attractive incentives for IRAs, KIOs, and 401 Burmese chots. At the same time, you need to do everything you can to discourage consumption. Change our tax structure to utilize a value-added tax, which taxes consumption rather than saving and investing. Cut government spending dramatically, and there are lots of ways of doing it without hurting the economy too badly. We would have problems, but the problems would not be nearly as bad as when they are forced on us. If we don't bite the bullet, then we are going to have a 1930s type collapse. Your answer implies that there are relatively painless ways to cut government spending. 112. Dramatically. Could you provide some specific examples? I'll give you 2 examples, I could give you a dozen. The US government spends $5 billion a year to support the domestic price of sugar so that Americans can pay 22 cents a pound wholesale, when it is selling for 8 cents a pound in the world market. $5 billion. We would be better off if the government told every sugar grower, "We'll give you $100,000 a year for the rest of your life, a condominium, and a Porsche if you just get out of the sugar business." We would save billions of dollars a year, and the whole country would be better off because we would all be paying less for sugar. If you really want to save a big number, do you know what our annual balance of trade deficit is? $150 billion. Do you know what it costs us each year to keep American troops stationed in Europe? $150 billion. American troops were sent there as an army of occupation 43 years ago. Most people in this country weren't even born when the decision was made to send our troops to Europe. They are doing nothing there but sitting around, drinking beer, getting fat, and chasing girls. The GAO has said that we don't have enough bullets to fight even a 30-day war in Europe. Yet it costs us $150 billion a year to keep those guys there. I would submit to you that if we stop spending that $150 billion a year and bring those troops home, the Europeans would defend themselves. And the kicker is, do you know who they would buy their guns from? They would buy their guns from us, because they don't have a very good defense industry establishment. But those are very unlikely actions. No politicians are even talking about those solutions. I understand that. With the present cast of jerks in Washington, it is not going to happen. The politicians are going to foul things up. They are not going to do what has to be done. They are going to be more concerned about keeping their votes and winning the next election. That is going to continue until we are forced into solving our problems. Then it is going to be a disaster. If the politicians don't act, do we eventually face a choice between very high inflation or a deep recession? It is going to be an extreme. What I suspect will happen, and I am just speculating, I don't have to make this decision yet, is that somewhere along the line a recession will develop. Initially, the politicians will say, we've got to bite the bullet and suffer through this. This is good for us, it will help clean out our system. People are going to buy that for a while. Then it is going to start to hurt. Then it is really going to start to hurt. At that point, the politicians are going to give up, and they are going to start to inflate their way out of it. But the only way to inflate your way out at that point is to really print money. In that scenario, we start off with a recession and end up with very high inflation. Right, but we could have wild inflation first and then deflation. Another very real possibility is that we will eventually have exchange controls. Fortunately, I don't have to make my investment decisions for 2 or 3 years forward right now. What kind of exchange controls? By exchange controls I mean limitations on capital flows. If you want to go to Europe, you can't take more than $1,000. You can't ship money out of the country without the government's approval. What happens to the relative values of currencies in a situation like that? The dollar disappears. What would bring on exchange controls is the dollar getting weaker and weaker. The politicians would then try to bring in draconian exchange controls, which would just make the situation worse. When you say disappear, are you talking about the dollar becoming like the Argentine peso? Why not? Why couldn't it happen? Remember the Civil War expression, I don't give a damn about a greenback dollar. You talk about the collapse of the dollar as if it's an inevitability. In 1983, we were the largest creditor nation in the world. In 1985, we became a debtor nation for the first time since 1914. By the end of 1987, our foreign debts were greater than all of the foreign debts of every nation south of the Rio Grande put together: Brazil, Mexico, Peru, Argentina, and all the rest. Can I paraphrase the chain of events you imply as follows? Nothing meaningful will be done to change the budget deficit situation. The continued budget deficit will guarantee that the trade deficit situation stays bad or even gets worse. That, in turn, guarantees that sooner or later, the dollar will come under extreme pressure. Absolutely. That's why I'm not long the dollar. How does the bond market fit into this scenario? At some point, foreigners are going to stop putting money into this country because of the weakening dollar. That means the American public will have to finance the debt. We have only a 3 to 4% savings rate. To get the American public to finance that debt, interest rates would have to be very high. If the Federal Reserve tries to avoid high rates by printing more money, then the dollar just disappears and the Fed loses control completely. That is the case where you get hyperinflation and 25 to 30% interest rates. Either way, we are going to have high rates. You might start out with lower rates first if the politicians decide to bite the bullet by having a recession. But then, they will eventually give up and start printing money. But, sooner or later, the bond market collapses. Absolutely. Sooner or later, we repeat the English experience of not having a long-term bond market. But I don't know when sooner or later is. It could be 3 years, it could be 10. How far did British bonds fall in the situation you are referring to? About 70%. 113. What kind of things do you look at in deciding which scenario will happen first, deflation or inflation? Money supply, government deficits, trade deficits, inflation figures, the financial markets, and government policy. I look at all those things for the US and key foreign countries as well. It is one big, three-dimensional puzzle. However, if you had a three-dimensional puzzle, you could eventually put it together. But this puzzle is not one in which you can spread out the pieces on a great big table and put them all together. The picture is always changing. Every day some pieces get taken away and others get thrown in. While we are on the topic of scenarios, do you have a long-term outlook for gold? In 1934, they set the price of gold at $35 an ounce, and gold production declined every year between 1935 and 1980. Production kept going down because there was no incentive to look for gold. During that whole 45-year period, the consumption of gold kept going up, especially during the 1960s and 1970s, when we had the electronic revolution. Demand got bigger and bigger, while at the same time, the supply was going down. You would have had a great bull market in gold in the 1970s, no matter what. Even if inflation was at 0%, you still would have had a big bull market in gold during the 1970s, because of supply and demand. The situation has changed entirely in the 1980s. There is nothing like taking the price of gold from $35 to $875 to make people go into the gold business. Gold production has gone up every year since 1980. Just based on known projections for mine openings and expansions, gold production is scheduled to go up every year until at least 1995. At the same time, there have been major technological advances in the recovery processes for gold. In short, there is much more gold available than there used to be, and that trend will continue at least into the mid-1990s. I own some gold as an insurance policy, but I don't think gold is going to be the great inflation hedge of the 1990s that it was in the 1970s, because supply and demand is so different. I don't know what the inflation hedge of the 1990s will be yet, but fortunately, I don't have to decide today. The supply/demand picture you are painting for gold is obviously negative. But if you put that together with a situation in which, using your own words, the dollar disappears, wouldn't such an event swamp the internal supply/demand balance of gold? Certainly, gold may keep its purchasing power. It may do better, it may do worse, but it's not going to be the best market. In other words, gold was yesterday's inflation hedge. Generals always fight the last war. Portfolio managers always invest in the last bull market. The idea that gold has always been the great store of value is absurd. There have been many times in history when gold has lost purchasing power, sometimes for decades. I should add something else about gold. Remember that three-dimensional puzzle I was talking about, where there are always pieces being removed and added? Don't forget South Africa in that puzzle. Gold is more complicated because of the South African situation. I fully expect South Africa to eventually blow up, because I think that the government has painted itself too far into a corner. If there were a revolution tomorrow and the blacks took over, the South African whites would dump all their gold. So the price would actually go down a lot. In a situation like that, I would think the price of gold would go up sharply, because of the panic related to disruptions in mine production. While the revolution is going on, the price will go up, but after that, it will go down. The move down will completely confuse everybody. They will ask, why is the price of gold moving down? But you will want to buy after that move down, because the euphoria of the revolution will also bring chaos. We have talked about your long-term views for the stock market, bonds, currencies, and gold. Any thoughts about oil? Yes, when the recession hits, and I guarantee it will someday, the price of oil is going to go way down. You can put that in writing, I don't mind saying that. It certainly is going to go under $12. Whether that is $11 or $7 or $3 1 don't know. The price of oil was approximately $16 at the time of this interview. Given the general scenario you are talking about, the stock market going down, the dollar going down, etc., is there anything that the average guy can do to protect himself? Buy European and Far Eastern currencies, buy treasury bills, buy farmland. How did you first get interested in trading? Investing. I stumbled onto Wall Street. In 1964, one had just finished college and was going on to graduate school. I got a summer job through a guy I met, who happened to work for a Wall Street firm. I didn't know anything about Wall Street at the time. I didn't know the difference between stocks and bonds. I didn't even know that there was a difference between stocks and bonds. All I knew about Wall Street was that it was somewhere in New York and something unpleasant had happened there in 1929. After that summer, I went to Oxford during 1964 to 1966. Whereas all the Americans I knew at Oxford were interested in politics, I was more interested in reading the Financial Times. Were you trading while you were at Oxford? Very lightly. I was an odd letter. The money I was investing in the market was my scholarship money at Oxford. I would get my scholarship money at the beginning of the year and invest as long as I could. Not exactly deep pockets. He laughs. If I had lost much money in either of those 2 years. So you actually started making money right off the bat? Yes, I was making money. That was the bull market of 1964 to 1965. By the time I left Oxford in the summer of 1966, the bear market had started, but I had already paid off my bills. I was lucky. If I had gone to Oxford during 1965–1967, one probably would have gotten wiped out. What happened after Oxford? I was in the army for a couple of years, and since I didn't have any money, I couldn't follow the market. In 1968, the day I got out of the army, I went to work on Wall Street. I invested everything I could. My first wife used to say, "We need a TV." I said, "What do we need a TV for? Let's put the money in the market, and we could have 10 TVs. She said, "We need a sofa." I said, "We could have 10 sofas if we just put the money in the market for a little while." What kind of job did you get on Wall Street? Junior analyst. Covering what stocks? Machine tools and then advertising agencies. Were you investing in the stocks you were covering? I invested in anything. Successfully? I came into the market on August 1, 1968, right at the top. But I still had some money left, and in January 1970, one figured out it was going to be a bear market. I don't know how I figured it out. As I mentioned earlier, I took all the money I had and bought puts. By May, I had tripled my money. In July, I started shorting stocks, and by September, I was wiped out. Those first 2 years were great. I went from being a genius to a fool. So you were back to ground zero in September 1970. What happened then? I saved everything I had and put it back into the market. I didn't care about a TV or a sofa. The wife got rid of me. I was the entrepreneurial spirit personified. Just like those guys who build up great retail chains and plow everything back into their stores, I was plowing everything back into the market. Were you trading just stocks at this time? Bonds, stocks, currencies, commodities. When did you get involved in these different markets? I traded all of them almost from the very beginning. Bonds and stocks from day one. Currencies fairly early, too. When I was at Oxford, I kept as much money in dollars as I could, because I knew they were going to devalue sterling any day. I knew it was coming, and it did, a year after I left. Once again, I was a little early. Even then, I had a strong awareness of currencies. In the late 1960s, I also got involved in commodities by buying gold. In my early years in the business, I remember interviewing for a job. The fellow asked me, "What do you read in the Wall Street Journal?" I said, "One of the first things I read is the commodity page." The guy was stunned, because he did too. This was back before commodities were commodities. He offered me a job, and when I turned him down, he almost strangled me. This job interview was in 1970, and I was already trading commodities. Going from ground zero in September 1970, where did you start picking up trading-wise to build up to your ultimate trading success? My early losses taught me a lot. Since then, I don't like to say this kind of thing, I have made very few mistakes. I learned quickly not to do anything unless you know what you are doing. I learned that it is better to do nothing and wait until you get a concept so right, and a price so right, that even if you are wrong, it is not going to hurt you. Did you have a losing year after that point? No. How did the quantum fund get started? George Soros was the senior partner, and I was the junior partner. We started off with one senior partner, one junior partner, and one secretary. How did you know George Soros? In 1970, I went to work for him at Holt & S. Bleichroeder. We left in 1973 because new brokerage firm regulations did not allow you to get a percentage of the trading profits. We could have stayed, but we couldn't have managed money. So we had to leave, fortunately. We left and started our own firm. What kind of trading did you do for the quantum fund? As I understand it, that fund was managed differently from the typical fund. We invested in stocks, bonds, currencies, commodities, everything, long and short, all over the world. Did you and George make independent trading decisions? No. If you broke down the division of labor, he was the trader and I was the analyst. Did you come up with the idea, for example, shorting the dollar, and did he decide the timing of when to do it? Yes, sort of. What if you disagreed on a market? Usually if we disagreed, we just did nothing. So, you both had to agree on a trade to do it? There were no rules. Sometimes we would disagree and do the trade anyway, because one of us felt more strongly. But that type of scenario rarely came up, since we were usually in agreement, and once we worked things 115 through, it was pretty clear that the trade was either right or wrong. When we thought something through, a consensus was formed. I hate to use that word, because consensus investing is a disaster, but we almost always seem to come together. When you were trading leveraged products such as commodities and currencies, how did you determine what your allocation was? Until we ran out of money, we were always leveraged to the hilt. When we bought something and ran out of money, we would look at the portfolio and push out whatever appeared to be the least attractive item at that point. For example, if you wanted to buy corn and ran out of money, you either had to stop buying corn or sell something else. It was an amoebic process. You know how amoebas grow, they grow out this way, then they run into pressure. So they grow out the other way. It was a very amoebic portfolio. You never evaluated the risk of your positions on an individual basis? So, if you lost money in one market and had to reduce your portfolio, you might just as easily cut back in another market? Right. We would always cut back on what we thought were the least attractive positions in the portfolio. Even today, that sounds like a very unconventional fund. Back then, I imagine it was probably unique in terms of its investment strategy. It certainly was unique. I still don't know anybody who trades all the markets. By all the markets, I mean all the currencies, commodities, bonds, and stocks, long and short, all over the world. I am retired now, and I still do all these markets. People say to me, "You're retired? We have a full staff and can't even keep up with all these markets." What do you mean you are retired? You are short stocks all over the world. I must admit, I find it amusing when you say you are retired. Now in my retirement, I'm more active than anybody, and people say, how do you follow all these things? I have the same question. I don't see how you can invest in American steel without understanding what is going on in Malaysian palm oil. As I explained before, it is all part of a big, three-dimensional puzzle that is always changing. How do you find enough time to spend on all those markets? Just the reading itself seems to be a monumental chore. I do not do it nearly as actively as I used to. Over the years, I have spent a great deal of time pouring a lot of stuff into my head. I have developed a great deal of perspective on many markets. When I teach, students are always astonished by the range of historical markets that I am familiar with. I know about these markets because I have pored over many commodity, bond, and stock books so many times, for so many years. As an example, I knew about the Great Bull Market in cotton in 1861, when cotton went from /cent to $1.05. How do you find out about a market like that? I start by finding the anomalous years in a long-term historical chart. When I see a picture like the 1861 cotton market, I ask myself, what caused that? Why did that happen? Then I try to figure it out. From that, you learn an enormous amount. In fact, one of the courses I teach at Columbia, which the kids call Bulls and Bears, requires each student to find a major historical market move. It doesn't matter which market, or whether the move was up or down. My instructions are for them to tell me what one could have known at the time to see the big move coming. When rubber was at 2 cents, everyone said, how can rubber ever go up? Yet it went up 12-fold. Somebody saw it. I always ask them, what could you have seen at the time? I always nail them. They will say, I knew the market would go up because there was going to be a war. But I will make them tell me how they could have known at the time that there was a war coming. The course gives them historical perspective across a broad spectrum of markets and teaches them how to analyze. I have lived through or studied hundreds, possibly even thousands, of bull and bear markets. In every bull market, whether it is IBM or oats, the bulls always seem to come up with reasons why it must go on, and on, and on. I remember hearing hundreds of times, we are going to run out of supply. This time is going to be different. Oil has to sell at $100 a barrel. Oil is not a commodity, he laughs. Gold is different from every other commodity. Well, damn, for 5,000 years it has not been different from every other commodity. There have been some periods when gold has been very bullish, and other periods when it has gone down for many years. There is nothing mystical about it. Sure, it has been a store of value, but so has wheat, corn, copper, everything. All these things have been around for thousands of years. Some are more valuable than others, but they are all commodities. They always have been, and they always will be. I guess the 1987 stock market is a prime recent example of that. This time is going to be different. Complacency. Right. Japanese stocks are already trading at astronomical prices in comparison with the profits of the 116 companies that issued the shares, at least by American standards. On the New York Stock Exchange, such price earnings ratios run about 15 to 1, while in Tokyo the multiples are often 4 times as high. Nippon Telegraph and telephone trades at 158 times its earnings. Japanese authorities have allowed a speculative bubble to grow, warns George Soros, manager of the New York City-based Quantum Fund. At no time in the past has a bubble of this magnitude been deflated in an orderly manner. Such worries are groundless, argue analysts in Tokyo. The Japanese attribute the high price-earnings ratios in part to accounting rules that allow companies to understate earnings to keep their taxes lower. Another factor Propping up prices is so-called cross-holding of stock. Because many Japanese companies hold large blocks of other companies' stock, which out of tradition are seldom traded, fewer shares are available for purchase, so their prices rise. Is there a lot of similarity between different cases of market hysteria? It's always the same cycle. When a market is very low, there comes a time when some people buy it because it has become undervalued. The market starts to go up and more people buy because it is a fundamentally sound thing to do or because the charts look good. In the next stage, people buy because it has been the thing to do. My mother calls me up and says, "Buy me XYZ stock." I ask her, "Why?" "Because the stock has tripled," she answers. Finally, there comes the magical stage. People are hysterical to buy, because they know that the market is going to go up forever, and prices exceed any kind of rational, logical economic value. The whole process then repeats itself on the downside. The market gets tremendously overpriced and it starts to go down. More people sell because the fundamentals are turning poor. As the economics deteriorate, more people sell. Next, people sell just because it has been the thing to do. Everybody knows it is going to go to nothing, so they sell. Then the market reaches the hysteria stage and gets very underpriced. That's when you can buy it for a pop. But for a long-term investment, you usually have to wait a few years and let the market base. Talking about extreme bull markets, I recently read that Australia sold a L/acre plot in Tokyo for $450 million that they bought for $250,000 25 years ago. Is Japan the tulip mania of our day? During 1634 to 1636, a speculative frenzy in tulips swept Holland, causing such an enormous rise and collapse in tulip bulb prices that the event is still famous today. I guarantee that the Japanese stock market is going to have a major collapse, possibly within the next year or two. Many of our stocks are going to go down 80 to 90% in the bear market. A lot more of theirs are going to go down 80 to 90%. Is there any way the average US trader can take advantage of that? Short Japanese stocks, short Japanese indexes, short Japanese calls, buy Japanese puts. A lot of Japanese stocks trade here and you can just short them. You can short the Japanese index, which trades in Singapore and Osaka. Most American brokers can do it for you. There are at least 5 major Japanese corporations which have options traded on the Chicago Board Options Exchange. Although I think a collapse is coming, you have to be very careful about going short Japan, because they might change the rules on you at any time. I don't know if you remember the Kuwaiti stock market of 1980 to 1981. In that market, you could buy stocks with a post-dated check. You could buy $10 million worth of stocks with a post-dated check. You could buy $100 million worth of stock that way. It didn't matter. Everybody was doing it. In the end, there was a passport clerk who owned $10 billion worth of stocks. All of it on post-dated checks. Although that market was a very clear example of hysteria, I didn't short it. I thought about it that long. He snaps fingers. The reason I didn't go short was because I knew when the market caved in, they would create rallies so that I would never get my money out. Of course, the market eventually collapsed. If I had gone short, they would have blamed it on me and said I caused the damn thing by shorting. People were even blaming me for the October crash last year, because I said it was going to happen. Some people claim I caused oil prices to collapse, because I said the price of oil was going to go down. I wish I were that influential or powerful. To get back to Japan, I have a few Japanese shorts, and I'm going to have more. But whatever I do in Japan, I know when the crisis comes, I don't want to be around near the bottom, because the Japanese are going to protect themselves. And whatever they do to protect themselves, it ain't going to be good for Jim Rogers. I guarantee that. You may not be able to get your money out? Yes, they could freeze the currency. They could have 3 different tiers of currency. God knows what they will do. Wouldn't you be protected if you were short a Japanese market that traded on an American exchange like that? Suppose they create 2 levels of currencies and the guy on the other side of the trade can't meet his obligation. The clearinghouse is responsible. Okay, fine, I'm happy to hear it. That's the best news I've had in a long time. Still, whatever I do, I'm going to be careful. If the Japanese stock market goes from 30,000 to 24,000 or 20,000, that's fine. But you better think about getting out of it before the last bit if it goes to 12,000. If you wait that long, you may get your profits out, but it is going to be very painful. Why did you leave the quantum fund? I didn't want to do the same thing for the rest of my life. I always wanted to have more than one career. When I came to New York in 1968, one was a poor boy from Alabama. By 1979, one had made more money than I knew existed in the world. Also, we were getting very big. We had started with 3 people, and by 1979, we had 15 people. They wanted to know when they could go on vacation, get raises, etc. I wasn't interested in any of that. I was interested in investing. I didn't want to get bigger. 117. In September 1979, one decided it would be my last year. But then, in October, there was a big collapse in the stock market, which we sailed right through. It was so much fun that I decided to stay on one more year. I left in 1980. Was 1980 the start of your retirement? Yes, in 1980, one just cashed in my chips and retired. Is that the point you became an independent trader? The term I really prefer is unemployed. Well, you teach at Columbia. That's unemployed. I did it as a part-time thing starting in 1983 so that I could play squash. I thought it was the love of teaching. It has developed into much more. But when I started out, I didn't even want to teach. I just wanted to learn how to play squash. You're not being facetious? You actually started teaching so you could play squash? I'm dead serious. Columbia is right here and the dean kept pestering me to teach a course. I told him I don't think people should go to business school. I thought that, for many people, business school was a waste of time. I still think so. But one thing I wanted to learn in my retirement was how to play squash. So I made a deal with the dean to teach one course per semester for free, in return for lifetime access to the Columbia gym. He agreed. I thought I got a great deal, but he was smarter than I was. I'm still teaching. I take it, at this point, you really enjoy it. Oh, it's good fun, yes. And Columbia is terrific. What courses are you teaching? Security analysis, investment analysis, and the bulls and bears course we talked about before. Of the multitude of your trading experiences, do any stand out as particularly dramatic? Lots. My October 19th birthday present that I talked about earlier was probably the best. August 1982 is another. I put a gigantic part of my net worth into bonds throughout 1981 and 1982, and in August 1982, they skyrocketed. Any negative dramatic experiences? August 1971 was a very exciting time. We were long Japan and short America, and one Sunday night, Nixon announced that he was taking America off the gold standard. I didn't even know it had happened. I had been off somewhere on my motorcycle, and I came in Monday morning without having read the papers. That week the Japanese stock market went down 20%, and the US stock market went up. We were losing heavily on both sides. Did you have to liquidate your positions right off the bat? You can't liquidate at a time like that. Who can you sell to in Japan? Who could you buy from in the US? If you covered your shorts, you made things worse. In a situation like that, you have to figure out whether you are right or wrong. If there was going to be a major fundamental change forever, the first loss is the best loss. But if fundamentally you are basically correct, then you do nothing but sit there and let the market hysteria wash around you. Did you stay with your positions? Yes. So, you really had to ride out a rather treacherous paper loss. There is no such thing as a paper loss. A paper loss is a very real loss. What was the analysis that gave you the confidence to stay with your positions? Our analysis was that this was not the end of the world. America had simply taken a short-term step, and it was not going to solve our country's long-term problems. Did that position actually turn out to be okay? It turned out fine. The Nixon announcement was just another step in the dissolution of the Bretton Woods Agreement, a 1944 international pact that, among other things, established guidelines for foreign exchange rate stabilization and the decline of America. America was rallying in its own bear market. So, you saw it as a cosmetic move that wasn't going to change the trend, and you stayed with your position. Right. Is that a general principle, when government measures are implemented to counteract a trend? You should sell the rally after the government action? Absolutely. It should be written down as an axiom that you always invest against the central banks. When the central banks try to prop up a currency, go the other way. What is the biggest public fallacy regarding market behavior? That the market is always right. The market is nearly always wrong. I can assure you of that. What else? Never, ever, follow conventional wisdom in the market. You have to learn to go counter to the markets. You 118. Have to learn how to think for yourself, to be able to see that the emperor has no clothes. Most people can't do it. Most people want to follow a trend. The trend is your friend. Maybe that is valid for a few minutes in Chicago, but for the most part, following what everyone else is doing is rarely a way to get rich. You may make money that way for a while, but keeping it is very hard. But actually, your whole style of trading involves staying with a trend for years. So isn't what you are saying contradictory? That kind of trend, a trend that is economically justified, is different. You have to see the supply/demand balance change early, and only by markets that are going to go on for years. By trend following, I meant buying a market just because it goes up and selling it just because it goes down. What trading rules do you live by? Look for hysteria to see if you shouldn't go the opposite way, but don't go the opposite way until you have fully examined the situation. Also, remember that the world is always changing. Be aware of change. By change, you should be willing to buy or sell anything. So many people say, I could never buy that kind of stock, I could never buy utilities, I could never play commodities. You should be flexible and alert to investing in anything. If you were counseling the average investor, what would you tell him? Don't do anything until you know what you are doing. If you make 50% 2 years in a row and then lose 50% in the third year, you would actually be worse off than if you just put your money in a money market fund. Wait for something to come along that you know is right. Then take your profit, put it back in the money market fund, and just wait again. You will come out way ahead of everybody else. Are you ever wrong on a major position play? That is, are one of your almost sure shots ever wrong, or are they so well selected that they just invariably go? I don't want to make it sound like I don't know how to lose money, because I know how to lose money better than most people, but there has not been a major mistake in a long time. But you have to remember that I don't trade that often. It is not as though I'm making 3 decisions a month. I may make 3 decisions a year, or 5 decisions a year, and I'll stay with them. How often do you make a trade? Well, there is a difference between making a trade and deciding to buy bonds in 1981. I've owned bonds since 1981, but I sell around the position. I make trades, but basically I own them. I went short the dollar at the end of 1984. Now, I have made a fair amount of trades in currencies since the end of 1984, but it is basically one trade with a lot of trades around it. Very few investors or traders are as successful as you have been over time. What makes you different? I don't play. I just don't play. I can understand that. But still, very few people can analyze the same fundamentals you are looking at and so consistently be correct in assessing all the variables. Just don't do anything until you know you've got it right. As an example, until you see American agriculture hit a low. But the good investor, or trader, to use your term, will see something else. The ability to get away from conventional wisdom is not very common. Jim Rogers' unique approach may be difficult to emulate in its entirety, but many of his trading principles are of great relevance to all traders. His basic concepts are: 1. Buy value. If you buy value, you will not lose much even if your timing is wrong. 2. Wait for a catalyst. Bottoming markets can go nowhere for very long periods of time. To avoid tying up your money in a dead market, wait until there is a catalyst to change the market direction. 3. Sell hysteria. This principle is sound, but its application is far from easy. Rogers' methodology can be paraphrased as follows: wait for hysteria, examine to see whether the market is wrong, go against the hysteria if fundamentally validated, be sure you are right, and then hold on tight. The tricky parts are the last two steps. Very few traders have Rogers' analytical skills and intuitive insights to wade through the maze of facts and statistics in the three-dimensional puzzle of world markets and arrive at the correct long-term projections with uncanny high accuracy. Without this type of accuracy, the ability to sit tight could be a lethal virtue. And even if you can predict long-term economic trends with a sufficient degree of accuracy, there still remains the problem of being able to sit tight, particularly when the financial steamroller of market hysteria is running counter to your position. For example, I doubt many traders would have been able to sell gold at $675, stay short while it surged to $875 in only 4 days, and then hold the position through the subsequent long-term collapse, eventually liquidating at a large profit. Even if you have the steel nerves necessary to duplicate this feat, you probably lack the financial resources to outstay this type of market or the same high degree of accuracy in picking your shots. Perhaps this particular concept should come with a caution label attached: warning. Any attempts by the unskilled practitioner to apply the method described herein can lead to financial ruin. 4. Be very selective. Wait for the right trade to come along. Never trade for trading's sake. Have the patience to sit on your money until the high probability trade sets up exactly right. 5. Be flexible. Biases against certain markets or types of trades limit your field of opportunity. A trader who says, "I will never go short," has a distinct disadvantage compared to the trader who is willing to go short as well as long. The trader who is open to examining a broad range of markets has a distinct advantage over someone who is willing to participate in only one market. 6. Never follow conventional wisdom. Keep this principle in mind and you will be less likely to buy stocks after the Dow has already moved from 1,000 to 2,600 and everyone is convinced that there is a shortage of stocks. 7. Know when to hold and when to liquidate a losing position. If you believe the market is going against you because your original analysis was flawed, such as when you realize you overlooked an important fundamental factor, then as Rogers states, the first loss is the best loss. However, if the market is going against you, but you are convinced your original analysis was right, then sit out the hysteria. As a cautionary word, this latter condition should be applied only by traders who fully understand the risks involved. 120. 121. Mark Weinstein, high percentage trader. After a brief period as a real estate broker, Mark Weinstein became a full-time trader. His start in trading was so naive that he virtually threw his money away. After that early failure, Weinstein withdrew to seriously study the markets and earn another trading stake. With the exception of one disastrous trading experience, Weinstein was a successful trader from that point on. He has intensively traded a wide variety of markets, including stocks, stock options, stock index futures, currencies, and commodities. Although he is reluctant to divulge specific details, it is clear that he has profited handsomely in all these trading arenas. I met Mark Weinstein through a mutual friend. Although he was very intrigued by the project, his desire for anonymity made him reluctant to tell his story. He would call me and say, "Okay, I will do it, let's schedule the interview." Then the next day he would call and say, "I changed my mind. I don't want the publicity." This pattern was repeated several times, with each decision accompanied by lengthy phone conversations regarding the merits and drawbacks of doing the interview. Finally, in exasperation, I said, "Mark, we could have done 3 interviews in the time we have spent talking about it." That was our last conversation regarding the matter until about 2 months later when, impressed by the caliber of traders who had agreed to participate in this book, Weinstein decided to do the interview. Weinstein met me at my office one summer evening. Because the building turns off the air conditioning after 5 p.m., we were forced out into a corner lobby, which, although warm, was at least less stifling. The interview was conducted over a dinner of deli sandwiches and soda. Through our phone conversations, I knew Weinstein had a strong tendency to go off in many directions in any conversation. That's how his mind works. One topic leads him to think of 5 others and their various interrelations. Dreading a mammoth editing task, I stressed to Weinstein the need for remaining focused on the specific questions. I could tell that Weinstein was making an extra effort to heed this advice. This fact notwithstanding, the interview lasted 5 hours and yielded a 200-page transcript. How did you first get involved in trading? Back in 1972, when I was a real estate broker, I had a friend who was a commodity broker. He and I had gone to school together. Did your friend get you interested in the markets? It didn't take much to get me interested because my father's hobby was gambling. He was very good at percentages, and I used to watch him at the crap tables. In a sense, I think being a trader is in my genes. Also, trading fascinated me because of my mathematics and science background in college and because I had a commodity broker friend who was into computer strategies. Do you remember your first trade? I remember it exactly. I opened up a commodity account with $8,400, and I went long corn based on a recommendation made by the firm's grain analyst. 3 days later, I was out $7,800. Did your broker friend advise you to follow the analyst's recommendation? Yes, and he also followed it. What I didn't realize then was that the market had been rising for some time and was already overbought when I went long. It wasn't even a bad reaction. I just got in on the move too late. I didn't have enough margin to keep the position going. Also, my guts turned on me, and I didn't want to put up any more money. It sounds to me like your friend let you put on a position that was clearly out of line with any money management principles. It was one of those get-rich-quick schemes. Did you know anything about the markets at the time? Absolutely nothing. If I flipped through a chart book, it looked like a collection of TV test patterns to me. Did you have any idea of the risk involved? I knew that the chances of my winning were very slim because I didn't know what I was doing. Didn't it occur to you that you should learn something before you started? No, because I was desperate for a change. I didn't like being a real estate broker. Was the money that you invested a substantial part of your savings at the time? It was all the money I had. When did you get enough money to come back into the markets? It took me approximately 6 or 7 months. I worked 7 days a week and rented as many apartments as I could get my hands on. I also sold a few co-ops. By that time, I had saved up about $24,000 and 10 cents took out $4,000 to live on, and used the remaining $20,000 to open an account. Did you make any effort to learn anything about the markets in the interim? Yes. I studied the gold market, learned how to chart, and became familiar with the concept of overbought and oversold markets. I figured that if I bought a severely oversold market and left myself enough money for 2 margin calls, I couldn't lose unless something drastic happened in the economy. That was my method. But if you use that approach in a trending market, you are going to get killed. It worked in that market. I guess ignorance was bliss. What were your trading results the second time around? I did well for several years after that and managed to build a small fortune. But a lot of that was due to luck. It couldn't have all been luck. What were you doing right when you were making money? 122. In relation to what I know now, there was very little that I was doing right. I think I just had good markets. In those days, commodities seemed to follow chart patterns a lot better than they do now. Very few people knew anything about technical analysis then, so the markets were much more orderly. I got a break by learning as much as I could about technical analysis at a time when it was working pretty well. Did you have a method for controlling risk? No, and I still don't. I depended on my nervous system and gut reaction. I covered positions when I did not feel right about them. Sometimes it would be after 2 days, sometimes after 2 hours. Were you spending all day trading? All day and all night. I was losing friends left and right. I sat in a studio apartment with charts plastered on every wall. I probably looked like a madman to the friends I had left. So this was really a full-time endeavor. Not only an endeavor, it was an obsession. I slept with it, I dreamt about it. Sometimes I would stay up all night thinking about what I would do the next day. If I didn't need sleep, I would have done it 24 hours a day. At that point, it wasn't the money that was motivating me. I was hooked on the game, on the challenge of trying to figure out the market. Did you sometimes wake up with a feeling that you knew the gold market was going higher or anything like that? No, it had nothing to do with the direction of the market. It was just an extension of what I was doing during the day. I would take so much of it to sleep that I ended up exploring unconsciously what I had been doing consciously that day. Did you have any goals when you set out? Well, the great American dream is to make $1 million, and that was particularly true in those days. I never really had a materialistic dream until I started vacationing and traveling in Europe. When was this? How many years after you started trading? It was in the mid-1970s. I had been trading for about 3 or 4 years. Had you passed the $1 million mark by that point? Yes, and I had made enough money to be able to relax, start vacationing, and think about things I wanted to buy. At that point, I was feeling confident enough to know that I could replace the money I spent with my trading profits. I figured the next logical step was to start appreciating the money I was making. I saw a castle in the south of France that I wanted. I was particularly impressed that the castle had a moat around it, and the idea of living there appealed to me. It was on the market for only $350,000, and I figured it would take about $50,000 a year to keep it up. That doesn't sound like a lot of money for a castle. Today it is probably worth $5 million. When I came back to the US, I wanted to make the money to pay for the castle almost immediately. That was a tremendous mistake. I don't understand. You already had the money to buy the castle, you didn't have to make it. Even though I had the money, I still looked at it in terms of how much it cost. I know people in this business who have $17 million in their trading account and won't buy a new car. So you didn't take your money out of the account to buy the castle? No, I came back and decided that making the money was going to be my goal. In other words, your next $350,000 in profits was going to go for the castle. Exactly. What happened? On my next trade, I put on a large long position in soybeans. The market closed up the first day, and I had about a 25% profit on my money. I was planning to get out of the position at the end of the week. The biggest mistake I made was having a specific target of what I wanted out of the trade. The target being determined not by market analysis, but rather by the $350,000 you wanted to make on the trade. Did you trade differently because you were trying to make money for a specific pose? Yes, I didn't consider the risk and took on too large a position. I was not using any type of rational judgment. I was being guided by my material desires. The market went up again the next day, but collapsed suddenly late in the session, locking limit down. Did you get stuck with your position at limit down? Yes, I couldn't get out. The next day I showed up at the brokerage office and the market opened offered limit down. I waited all day to see if it would come off of locked limit down, but it didn't. I take it that you would have liquidated your position if you could have. If the market had traded, I would have sold out at any price. Do you remember your emotions at the time? I was in a state of shock and had no decision-making capability left whatsoever. I couldn't fall asleep, and found myself almost praying the market would somehow trade the next day. On the third day, I called the office about a half an hour before the opening, and they told me it didn't look like there was any hope. I didn't even bother. 123. Going in because I couldn't face the people in the office. I was certain that they were getting a big thrill out of my situation. Why is that? There were a few other professional traders in the office who were never able to make the kind of money I had been making. When this situation developed, they were almost relieved. It seemed to justify all those years of they're not taking positions like I did. They were really heartless. The only person who was really upset was my broker. And, frankly, that was probably because he was afraid of losing the account. Did the other traders kid you about it? They overconsoled me and then laughed about it behind my back. They wanted to see me come in and fall apart. That is why I stopped coming to the office. Do you think they relished your predicament because it made them seem less deficient as traders? It went beyond that. I think there are a lot of people in this business who just enjoy watching others lose money. Once you stopped going into the office, what did you do during the day? I checked with other brokerage houses, trying to get price quotes. Why didn't you just call your own broker? I was too embarrassed, and I didn't want to take the derision. Your own broker was kidding you? I didn't know what to think of him. I was starting to get paranoid and hostile because nothing could be done. I went to a competing firm and spoke to their grains analyst. I was looking for someone to hold my hand. He told me I would be okay because the fundamentals were still strong and there would be a tremendous demand for soybeans if the market went down another day. Of course, on the fourth day, the market locked limit down again. How much were you losing each day? About $125,000 a day. This was at a time when the average annual salary was $15,000 and 10 cents was not born rich, and I couldn't stop thinking of my loss in those terms. Could you put that loss in perspective relative to your account size? Before that trade, I had nearly $1.5 million in my trading account. So I was losing nearly 10% of my equity level prior to the trade each day. I was devastated. I felt like I was wounded in a trench and watching myself bleed to death. The market went limit down 5 days in a row, and I lost over $600,000. On the fifth day, I remember sitting in a park holding hands with a girl I had picked up, literally crying on her lap. I was practically in a psychotic state. I thought about getting out of the business altogether. I started to think that what everybody was telling me was true, maybe it was just luck. That I had made money all those years. I worried that if I continued trading, I could wind up losing it all, and being forced to go back to some job I didn't like. Which was more devastating, the large monetary loss, or your feelings about going from success to failure? It was the money and the limit situation, and the fact that I couldn't act. My exact thoughts were, here I am. A person who thought it was un-American to go short, and what I found out was really un-American was not being able to get out of a position. So you felt cheated by not being able to get out? I definitely felt cheated. To this day, I think there is something wrong with limit price moves. Are you implying that price limits that were supposedly created to protect the public actually work against them by preventing people from getting out of their losing positions? Yes. I think the market should be totally free of restraints. There is talk about putting limits on stock markets as a way of reducing volatility. Would that actually be jumping from the frying pan into the fire? Absolutely. Now, the average investor knows that if he wants to get out, he can at least get out at some price. Imagine if this guy calls his broker and finds out that he can't even get out of the market. In other words, you are saying that those who are expounding the idea of limits are really going to make matters worse for the small investor. It is absolute lunacy. It is a law that is being proposed for the benefit of sophisticated institutional investors. Your earlier comment implied that, prior to the soybean trade, you always traded the long side of the markets. Is that right? Yes. I never went short. I felt it was un-American. After the soybean trade, I realized that the business I was in was the height of capitalism, and it really made no difference what side of the market you were on. All I could think about was that the people who were short made money and I lost money. How long did the emotional impact of this experience last? Months. I didn't want to trade commodities anymore. I ripped every chart off my walls. I tore up everything in my house that had anything to do with commodities. When did you begin trading again? After a few months, I started trading MX stocks, but I found it amazingly slow. I missed the leverage of the commodity markets. I didn't think I could successfully support myself trading stocks. Around that time, I ran into a friend who is a great options trader. I told him about my experiences and he 124 suggested that I join him. In my first week at his office, he told me to buy Teledyne calls right before expiration because he was sure they were going up. I followed his advice, and the calls completely collapsed. How much did you lose? About $40,000.10. Felt extremely hostile, but I didn't want to show it because he never promised me any results. I was so upset that I walked out of the office and didn't come back for 2 days. He tried reaching me during that time, but I didn't return his calls. Finally, he got a message to me through a mutual friend. Was he upset that he had given you bad advice? When I came back to the office, he told me that he had done the exact opposite trade in another account, and that the trade was mine. So I didn't really lose any money. That sounds like an awfully odd type of practical joke. It wasn't a practical joke. He was trying to teach me not to place blind trust in anyone, even him. It was his way of teaching me the importance of self-reliance in being a good trader. How did you do after that point? I did pretty well. My friend was a phenomenal options trader. He knew everything about the market and I learned a tremendous amount from him. Did you trade options based on the methodologies he taught you? Yes, combined with my own technical analysis. Your friend didn't use technical analysis? No, he didn't believe in it. He was a tape reader. Has the fact that you have been extraordinarily successful as a 100% technical trader changed his mind about technical analysis? Not at all. He thinks technical analysis is just a crutch for me. And the real reason I make money is experience. There was a point at which we separated for a few years. He came to my office one day and watched me trade. He embraced me like a father and said, "You finally made it." I told him that not only had I gained a lot of experience, but I had learned just about everything there was about technical analysis, including certain things I had created myself. He said, "You never give up, do you? It has nothing to do with technical analysis. You are trading that way because of experience." Why did you and your option trading friend eventually separate? There was a conflict in our trading styles. He was a great trader who was willing to take an occasional large loss, because he knew he would more than make up for it with large gains and come out way ahead in the long run. However, I was uncomfortable trading that way. I preferred trading for small profits and trying to eradicate losing trades. I wasn't willing to take the same type of risk. Also, my approach was purely technical, whereas he was basically a tape reader. Anyway, in 1980, one decided to go off on my own. We got together again years later. I know you once entered an options trading contest. Can you tell me about it? It was originally organized by two traders on the floor. They got 47 traders together, each of whom put up $5,000 in a winner-take-all contest. Each trader opened a $100,000 account with the same clearing firm. How long was the contest for? 3 months. What were your results? I turned the $100,000 into over $900,000 without any pyramiding, using profits to increase leverage. That's a rather phenomenal performance. Yes, but the markets were very good at that time. What did you trade when you went out on your own in 1980? I traded everything. I continued to trade stock options. When stock index futures trading began in the early 1980s, that became a primary market for me. I also traded the commodity markets. In fact, during the last 2 years, my trading has shifted to nearly 90% commodities. Do you remember your first soybean trade after the debacle in the 1970s? For a long time, I avoided soybeans. But, as I began to find myself trading the commodity markets effortlessly, I knew deep down that I would eventually get back the money I lost in soybeans. I never forgot about it. It sounds like you were looking for revenge. Yes, exactly. Every time I looked at a commodity chart book, my eyes would edge over to the soybean chart. Then I would quickly flip the page. I watched the market peripherally for years before doing anything. When soybeans went down to $4.75, one knew they were near a low, but I didn't want to buy them until I was sure I couldn't lose on the trade. I was like a Sicilian whose wife had been murdered 10 years earlier, waiting for the perfect moment for revenge. When my technical analysis convinced me that the market had bottomed for real, I jumped in on the long side. Where did you buy the beans? Around $6.18. This was shortly before the 1988 drought caused prices to skyrocket. Where did you get out? I got out of some at $7.25, and the rest at $9.92. The high of the move was $10.46. 125. How much did you make on that trade? Let's just say I made my money back in spades. The way you talk about it, it sounds like that trade was a great relief for you. Yes, it was a total catharsis. I realized that there was a reason why I had lost the money in the first place. What was the reason? Because I was inexperienced. I don't believe anyone ever gets wiped out in the market because of bad luck. There is always some other reason for it. Either you were off when you did the trade, or you didn't have the experience. There is always a mistake involved. You mentioned earlier that one of the reasons you split with your former trading partner was that your own trading style was geared to extremely low risk. Since 1980, what was the worst percentage drawdown you have experienced? I lose so infrequently that I don't really keep track of that type of number. Well, let's put it this way, what was your worst single trading month? I haven't had any losing months. You have made money in every single month since 1980. Yes. Of course, I could have made a lot more money if I wasn't so cautious, but that is the way I trade. Do you remember your worst losing week? I haven't had any losing weeks during that time, but I have had some losing days. That is an incredible statement. How can you be sure that you are not simply forgetting about a few weeks when you lost money trading? The reason I am sure is that I remember all my losses. For example, I have had 3 losing days in the last 2 years. Out of the thousands of trades I made during that time, I had 17 losers, but 9 of them were because my quote machine was down, and when that happens I just get out of my position. Most traders would be happy winning on 50% of their trades, and a win ratio of 75% would be spectacular, yet you are implying that your win ratio is somewhere in the vicinity of 99%, that is really hard to believe. You can check with Lee. I told him about hundreds of my trades during the past few years. Lee Stevens is a mutual friend who introduced me to Weinstein. Okay, reader, I know what you are saying, no losing weeks, but I've had some losing days. Give me a break. Frankly, I admit Weinstein's statements sound preposterous. I could not verify his claims by examining account statements because his partners are vigorous in maintaining the confidentiality of the partnership's trading activity as it is a private trading firm, not open to the public. In fact, a number of his partners were adamantly opposed to this interview and were nearly successful in dissuading Weinstein from participating. The only account statement Weinstein was willing, or able, to show me was his independent entry in the option trading contest, which did indeed confirm that he multiplied a $100,000 account 9-fold in 3 months with 100% winning trades. Still unsatisfied, I spoke to Lee, who has known Weinstein for years and has spent many days watching him trade. I have known Lee for 3 years and can confidently describe him as honest, low-keyed, and level-headed. Lee confirmed that of about 100 of Weinstein's trades he had personally witnessed and several hundred more Weinstein told him about on the phone. Right after he put them on, he could remember only one that was a loser. Even if because of faulty memory, I mean this literally, not as a euphemism for dishonesty, Weinstein's actual percentage winning rate is somewhat lower than he implies. I still believe his win/loss ratio is incredibly high. How can he do it? Weinstein's own response to this query follows, but to put it in perspective, I thought some further elaboration would be helpful. Weinstein employs his own custom-designed state-of-the-art computer systems to monitor constantly technical indicators designed to measure changes in market momentum. Rather than use the standard values for these indicators, Weinstein uses his own values, which he frequently adjusts for changing market conditions. He combines this intensive real-time analysis with comprehensive chart analysis incorporating a variety of methodologies, including cycles, Fibonacci retracements, and Elliott wave analysis. Finally, add to this one last essential ingredient, an uncanny sense of market timing. Only when nearly everything lines up right and he feels the timing is virtually perfect does he put on a trade. He passes up many trades that he believes have a high probability of working, but for which he lacks the same degree of near absolute confidence. Because of the combination of a lifetime devotion to studying the markets, intensive real-time analysis, innate market sense, and incredibly rigorous trade selection, virtually all of Weinstein's trades are at least marginally profitable at some point within 20 minutes of entry. That is all Weinstein needs to assure a break-even or better result. It helps to understand that Weinstein usually plays for quick profits and covers his trades within hours or even minutes. Even on position trades, Weinstein will usually take some profits quickly to assure a net profitable outcome. He also trades markets in rotation, quickly shifting his profits from market to market, always seeking the profit potential with the lowest perceived risk. Finally, Weinstein enjoys the support of a floor network that often puts him on the right side of the bid-ask spread. Weinstein's comments may sound like boasting on the written page, but that belies their tone. Naivete would be a much closer description. When Weinstein talks about trades, his comments are peppered with phrases such as, "It's obvious the market is going lower, this market is so easy." It is clear he has no conception of how difficult trading is for the rest of us. How do you explain your ability to win such a high percentage of the time? Because I have a real fear of the markets. I have found that the greatest traders are the ones who are most afraid of the markets. My fear of the markets has forced me to hone my timing with great precision. When I am 126. Trading properly, it is like a pool player running racks. If my gut feel of market conditions is not right, I don't trade. My timing is a combination of experience and my nervous system. If my nervous system tells me to get out of the position, it is because the market action triggers something in my knowledge and experience that I have seen before. I also don't lose much on my trades, because I wait for the exact right moment. Most people will not wait for the environment to tip itself off. They will walk into the forest when it is still dark, while I wait until it gets light. Although the cheetah is the fastest animal in the world and can catch any animal on the plains, it will wait until it is absolutely sure it can catch its prey. It may hide in the bush for a week, waiting for just the right moment. It will wait for a baby antelope, and not just any baby antelope, but preferably one that is also sick or lame. Only then, when there is no chance it can lose its prey, does it attack. That, to me, is the epitome of professional trading. When I trade at home, I often watch the sparrows in my garden. When I feed them bread, they take just a little piece at a time and fly away. They keep on flying back and forth, taking small bits of bread. They may have to make 100 stabs at a piece of bread to get what a pigeon gets at one time, but that is why a pigeon is a pigeon. You will never be able to shoot a sparrow, it is just too fast. That is the way I day trade. For example, there are times during the day when I am sure that the S&P is going up, but I don't try to pick the bottom, and I am out before it tops. I just take the mid-range where the momentum is greatest. That, to me, is trading like a sparrow eats. Am I paraphrasing you correctly? The cheetah is your analogy for position trading and the sparrow is your analogy for day trading. The common denominator is that both animals wait for can't lose circumstances. Exactly. How do you pick your trades? I use many different types of technical input: charts, Elliott wave and Gann analysis, Fibonacci numbers, cycles, sentiment, moving averages, and various oscillators. People think that technical analysis is unreliable because they tend to pick the one thing they are comfortable with. The problem is that no single technical approach works all the time. You have to know when to use each method. How do you do that? It is experience and gut feel. I use all forms of technical analysis, but interpret them through gut feel. I do not believe in mathematical systems that always approach markets in the same way. Using myself as the system, I constantly change the input to achieve the same output, profit. Is there anything you can single out as the most important element in deciding to put on a trade? I am always looking for a market that is losing momentum, and then go the other way. Having traded both the stock and commodity markets, would you say they behave differently? Absolutely. In contrast to the commodity markets, the stock market very rarely gives you the opportunity to enjoy a meaningful trend. Why is that? Because when institutions and specialists sell out, they don't sell out at one price level, they scale out as the market goes up. Similarly, when they buy, they scale in as the market goes down. This leads to choppier price action. And is the reason why many good commodity traders that I know lose every time they go into the stock market. But you win consistently in the stock market as well. What are you doing differently? I don't try to figure out where the market is going before the action, I let the market tell me where it is going. Also, there is such a variety of technical input in the stock market: divergence, advance/decline, sentiment, put/call, ratios, and so on, that you will almost always get a signal before the market is about to do something. Is your method of technical analysis therefore different in the stock market than in the commodity markets? I look at the individual stocks, they all have their own personalities. For example, IBM and General Motors will usually rally before a major market bottom and fail to rally before a major market top. As another example, I have never seen a real good rally without the utilities leading the market. The utilities go up when interest rates are expected to come down, and when interest rates come down, portfolio managers jump into stocks. I have done extremely well trading the indexes, because before I ever traded index futures, I had become a very experienced trader of stocks and options. What do you think is the public's biggest misconception about the markets? That people who trade the markets gamble. I know floor traders that have made money for 20 straight years. You can't call that gambling. Another major misconception is that people always expect the market to react to news. For example, when John F. Kennedy was assassinated, the market initially broke very sharply, but then quickly rebounded to new highs. This price action baffled many people. Investors who sold on the news only to watch the market reverse blamed the institutions for pushing the market higher. What they failed to realize is that a market that is fundamentally and technically poised to move higher is not going to reverse direction because of a news item, even a dramatic one. Another item I would place under the category of misconceptions is the way the media reports the reasons for the market being down. They are always saying that the market is down because of profit-taking. I think it would be wonderful if everybody was always taking profits. But the truth is, most people lose money, and the reason markets go down is because they take their losses. I know educated people who watch the news and wonder why the hell they lost money when everyone else is taking profits. The media owes it to the public to report that the market goes down. Not only on profit-taking, but on a lot of loss-taking as well. What are the trading rules you live by? 1. Always do your homework. 127. 2. Don't be arrogant. When you get arrogant, you forsake risk control. The best traders are the most humble. 3. Understand your limitations. Everyone has limitations, even the best traders. 4. Be your own person. Think against the herd, as they must lose in time. Don't trade until an opportunity presents itself. Knowing when to stay out of the markets is as important as knowing when to be in them. 5. Your strategy has to be flexible enough to change when the environment changes. The mistake most people make is they keep the same strategy all the time. They say, damn, the market didn't behave the way I thought it would. Why should it? Life and the markets just don't work that way. 6. Don't get too complacent once you have made profits. The toughest thing in the world is holding on to profits. That is because once you have attained a goal, you then set a second goal that is usually the same as the first. 1. To make more money. Consequently, for many people, attainment of that second goal is not as rewarding. They may begin to question what they really want from trading and trigger a self-destruct process in which they wind up losing. Any final advice you have for the beginning trader? You have to learn how to lose. It is more important than learning how to win. If you think you are always going to be a winner, when you lose, you will develop feelings of hostility and end up blaming the market instead of trying to learn why you lost. Limit losses quickly. To paraphrase from Reminiscences of a Stock Operator, most traders hold on to their losses too long because they hope the loss will not get larger. They take profits too soon because they fear the profit will diminish. Instead, traders should fear a larger loss and hope for a larger profit. Weinstein's most traumatic trading experience occurred when he let a material goal interfere with his trading. This is a common theme that has surfaced in other interviews. It invariably seems to be a mistake to translate the potential profit or loss of a trade into material terms. The cornerstone of Weinstein's trading approach is to wait for those trades in which everything appears to be lined up exactly right, and the odds of winning seem overwhelming. Even though most of us can never expect to remotely approach Weinstein's confidence in the trades he selects, the concept of waiting for only those trades one feels most confident about is sound advice that is echoed by a number of traders in this book. Although viewing markets as non-random over the long run, I have long believed that very short-term market fluctuations, i.e., intraday price movements, were largely random. Weinstein has shaken this belief. 128. Part 4: The View from the Floor. 129. Brian Gelber, broker turned trader. Brian Gelber began his career as a broker, managing a major brokerage firm's financial futures operations on the floor of the Chicago Board of Trade. After successfully advising institutional clients, he began trading for his own account. In the early days of T-bond futures trading, Gelber enjoyed the dual distinction of being one of the most, if not the most, prominent brokers on the floor and one of the largest local traders. In January 1986, Gelber expanded his trading to include the direct management of customer accounts. In addition to his own trading, Gelber supervises a group of traders in both cash and futures in government securities and other markets. He is the president of a group of companies, Gelber Group, Gelber Management, and Gelber Securities. These companies are involved in clearing, brokerage, and money management. Gelber's relaxed personality seemed almost out of place with his profession. Instead of the high level of intensity expected of someone who trades and supervises trading in multimillion-dollar bond positions daily, I found a man who talks about his work as if he were describing a pleasant vacation. Although our meeting took place during trading hours, Gelber did not seem to be overly concerned with the bond market. In fact, he seemed quite relaxed, despite leaving the trading desk for his private office to conduct our interview. "I'll probably do better by staying here," he remarked, obviously reflecting what he perceived to be a low opportunity market at the time. In response to a query regarding other traders I was interviewing, I mentioned that one, Tony Saliba, had made the cover of the current issue of Success magazine. Gelber asked me if I had a copy. I pulled out the magazine from my attaché case and handed it to him. He smiled as he read the bold headline describing Saliba's experience. During the week of the October 19, 1987, stock market crash, victory. He made $4 million in 72 hours. Jokingly, Gelber asked, "I made $4 million in 20 minutes on that day, how come I'm not on a magazine cover?" It was not meant to be boastful. It did, however, very specifically summarize a basic truth about great traders: many, if not most, maintain relatively low profiles and are therefore virtually unknown to the public. How did you get started in this industry? After graduating from college in 1976, one backpacked around the country. In Salt Lake City, I answered an ad for a commodity broker position. I didn't have any idea what it was, but I figured it was something like a stockbroker. I got my license while working for a guy who was basically running a boiler room operation. You really started out on the wrong side of the business. When I walked in, there was a guy seated at the back end of a penny stock office. He spent his days on the phone trying to convince people to give him $5,000 or $10,000 to speculate on his charting system. It was a real fly-by-night operation. I was keeping his charts for him while getting registered. I kept saying to myself, this guy is pretty much of a crook. I got my license and quit. Then I bummed around for another few months, just working temporary jobs to pay the rent. What kind of jobs? Unloading railroad cars. Then one day I walked into a Thompson McKinnon office and said, "Hey, I have a broker's license." The fellow there said he would pay me $800 a month. That was a large amount of money for me at the time. All I had to do was go in and cold call, any accounts I opened would be mine. But he knew virtually nothing at all about markets at that time. I had read a couple of books, and I knew something about charts, having kept them for the first fellow I worked for. What books did you read? There weren't too many around at that time. The book I learned the most from was Technical Analysis of Stock Trends by Robert D. Edwards and John McGee, John McGee Incorporated, 109, State Street, Boston, Massachusetts. What other books would you recommend to people? The first book we have our traders read is Edwin Lefebvre's account of Jesse Livermore, Reminiscences of a Stock Operator, reprinted in 1985 from the original 1923 edition by Trader Press Incorporated, Greenville, South Carolina. I've read it at least a dozen times. Anyway, around the time that I started at Thompson McKinnon, the Ginnie Mae market was just coming into its own. Thompson McKinnon had just hired a trading group to run a Ginnie Mae desk. I told them I was interested in learning more about the Ginnie Mae market. Why were you attracted to that market? It was a new market and seemed more manageable than the conventional commodities. I figured my business would grow more steadily if I focused on that market. Also, I had made a number of trades in Ginnie Mae's. The first trade was a winner, but the following ones were all losers. It was magnetic. I felt I could make money there, but I kept losing, and that made me want to learn more about it. It sounds like you had a minor compulsion to pursue it. Yes, because I had failed. Anyway, the traders at the Ginnie Mae desk taught me a few things, and I went out and opened almost every mortgage banker account in Salt Lake. Did you understand the Ginnie Mae market at that time? When I first started opening accounts, I didn't understand anything about it. How then did you sell people on yourself? I snowballed them at first, but I listened and I learned from the questions they asked me. Initially, I was 130. Confused by what they were doing, and they were equally confused by what I was trying to sell them. At least you understood futures as an instrument. Right. And with that limited knowledge, I bumbled through my first few meetings. Then I really got pretty good at it. Were these hedging accounts? Yes, all pure hedging accounts. By May 1977, one was making $2,000 a month in commissions. That was a tremendous amount of money for me. Was this all in the Ginnie Mae market? At that point, yes. Previously, I had done some brokerage in other commodity markets such as wheat, hogs, and pork bellies. Who were those trades for? Just accounts I had opened by cold calling, people who really didn't understand that they could lose, and when they lost, they were always upset. Were you giving them trading suggestions? Pretty much. Using chart analysis? Believe it or not, more off the research of Thompson McKinnon analysts, and secondarily off my charts. Newer brokers definitely tend to rely on their firm's research. Did your customers lose because the research was wrong? No. They lost because their time horizon was mostly day to day, while the research was longer term. So there was a mismatch? Exactly. I think that is a basic problem between most brokers and their customers. It is almost impossible to get market information to your customer quickly enough for the customer to act on it. What you are saying is that even if a broker can actually beat the market trading short term, he can't translate that to the customer. Insurmountable odds, because you have two people who have to pull the trigger, and the information changes so quickly. So, one of the points of advice you would give to speculators is to trade with a longer term perspective? Yes, you have to. Let's talk about floor trading. I know, at one point, you were both a floor broker and trader in the T-bond futures market. The question I think a lot of people would ask is, if you receive a large customer sell order at the same time you're thinking of closing out your own long position, how do you handle it? I never scalped, so the idea of being long and having a large customer order move the market against me 2 or 3 ticks never made any difference. Besides, I had so many customers that they were often going opposite ways. Okay, that's an easy one. But what if some important news was breaking, and all your customer orders were going one way against your own position? Did you ever end up trapped in a position because you had to execute all the customer orders first? Yes, that happened to me about half a dozen times, and it probably cost me a grand total of $500,000 over a number of years. But measured against the amount of money I was making, it didn't kill me. That was the cost of doing business? Right. It must be a gut-wrenching situation though, knowing you want to get out, but not being able to act because of a conflict with customer orders. Usually, you are too busy acting as a broker and thinking, okay, I have to sell 1,000 lots, how can I do it best? Then, when you are done with the order, you might say to yourself, oh damn, I'm still long, I have to get out of this thing. Is there a built-in disadvantage for a floor trader who also handles customer orders? Absolutely. As I tell the people I hire, if you are a broker, you are not a trader, if you are a trader, you are not a broker. But you were. It was a wild time. I was the biggest trader and the biggest broker in the same market. I worked very long hours and was totally exhausted when I went home. Then I would just get up the next day and do it again. This went on for 3 years, and while it was a great experience, I really shouldn't have done it. You can't be a great broker and a great trader. I did a good job, but it probably took years off my life. Are most of the significant size traders on the floor just traders, or do some also handle customers? They all are either brokers or traders now. That is the only way to go. There is no doubt about it. Is that true of most floors, or just the T-bond floor? Primarily, the T-bond floor. In the S&P and in the New York markets, some of the big brokers are also big. 131. Traders. Given today's increased scrutiny, are people who violate the confidence of dual trading, handling customer orders and trading one's own account, likely to get caught? It is still very difficult to create a flawless audit trail in an open outcry market. Say bonds are trading at 95.00 and the market gets hit with some bearish news. The broker executes a large amount of orders for customers and his own account, and the market goes straight from 95.00 to 94.00. His tills are 94.31, 94.30, 94.29, and all his customers get fills at 94.27 or lower. Bond prices trade in 32 NDS. How does he explain his way out of that one? He could give his order or his customers' orders to another broker. Or he could fill both orders and put another broker's number on his own order. There are always ways to get around extra scrutiny. The smart crooks will always be difficult to catch. Is the temptation in dual trading too great? No. After having been through it, I would say that dual trading is good for efficiency in the marketplace, but it is too heavy a burden for the individual. Should the rules be changed to disallow dual trading? That is a difficult question. What is more important, the efficiency of the market or the integrity of the individual? There is no doubt in my mind that dual trading adds tremendous liquidity to the system, and that is probably more important than the fact that a small percentage of dual traders may cheat. Besides, even if dual trading were banned, the stealers would still find a way to steal. That is their perception of how to make money in this business. When did you first get involved in the T-bond market? Hi, September 1977, one moved to Chicago and became a broker on the T-bond floor. I was just 25 and I got lucky. I went to New York in November 1977 and met with 8 big-name companies, 7 of whom opened accounts. I was at the right place at the right time. When did you start trading for your own account on the floor? In 1979. Were you tempted to give up your floor brokerage so that you could concentrate on trading? Actually, it was just the opposite. I had started out as a customer's man, and from 1979 through 1981 one built a massive customer base. We were a powerful force in the market at that time. Probably the saddest thing I ever did was to become a trader too. I was a great broker in my 20s, and if I had parlayed that for 10 years, I probably would have ended up where I am now without enduring all the pains of trading. I consider trading to be an unrewarding, unglamorous game. It's odd you say that, because you have been far more successful than most traders. I guess my point is that as a broker I was at an even higher echelon. I was really good at it, and it suited my personality. So, plus $50,000 more. Since I was making about $50,000 per month as a broker, my attitude was that I basically broke even that month. But I didn't like the feeling at all. So, I cut my position size down and started trading a little more actively. This happened during the bear market of 1979. The problem was that I was bullish all the way down. Why were you bullish? My customers kept telling me that rates couldn't go much higher. For example, I was handling the orders for Citibank and Citicorp and they were buying all the way down. These were renowned people saying that they had an opinion and backing it up with deeds. Bond prices fall when interest rates rise. This is a basic concept that is sometimes confusing to the novice. The reason that bond prices decline if rates increase can be explained as follows. If rates rise, it means that all existing lower-yielding instruments are less attractive to investors. To induce an investor to purchase these lower coupon bonds, their prices must fall sufficiently so that the return is equivalent to the return on the higher coupon bond purchased at face value. What would you do today in the same situation? Now, I know the characteristics of various institutions. Let's take Citibank. Back then, I was buying because they were buying. Now, if Citibank was buying, I might conclude that they were just reallocating their assets or changing the duration of their portfolio. Today, I have little regard for the views of portfolio managers, because their outlook tends to cover a much longer time perspective than mine. I didn't understand that back then. So, you don't pay much attention to those types of opinions anymore? I listen to them in passing. I don't read the Barron's interviews of portfolio managers anymore. It never did much for me, and I don't think it does much for any trader. In other words, the problem wasn't the fact that you were listening to other people, but that you 132 were listening to the wrong people. I didn't know how to decide which were the right or wrong people. I was a naive kid saying, here is a major account that is buying a lot of stuff, the market should go up. You really had no strategy, no plan, no system. You were just shooting from the hip. That's right. Then over time, I started to get a grip on how to make money. As opposed to saying, I have an opinion and I want to express it in the market, I started asking, how do I make money out of all this? What had you learned by that point? I had learned that an opinion isn't worth that much. It is more important to listen to the market. I became a reactive trader as opposed to an opinionated trader. In 1980, one of my customers was Salomon Brothers. At the time, they were bearish on bonds from 65 to 80. If I had listened to my big customers as I had done in 1979, one would have thrown away money all over again. What told you not to listen to your customers then? The 1979 experience of losing money based on someone else's opinion, a sound opinion by intelligent people. That was just absolutely wrong. Where were your successes coming from? I learned how to read the tape and developed good instincts. We were such big players in bonds back then. We, meaning my customers and myself, that the spots we picked to trade could virtually stop the market. We were actually creating some of the support and resistance points. It didn't take that much to do it back then. I think there was a streak of months when I hardly had any losing days. Could you have done it without the commercial accounts? I would hope that I could have done it without them, that it wasn't a self-fulfilling prophecy. But if it was, fine. I don't know. When did that streak end? From a trading standpoint, I never had a losing year until 1986, although I did struggle in 1985 during the mid-stages of the bull market in bonds. Was your trading success a matter of being able to read the tape? Yes. I was attentive and had good instincts. It sounds like you are saying that either you are born to be a good trader or you are not. Well, to a certain extent, that may be true. My feeling is that you don't have to be, but it helps. Is it a matter of having a sixth sense about the market? Yes. Your gut often tells you what to do. Are people who don't have the natural instincts for trading wasting their time? Or can almost anybody be successful if he or she works at it hard enough? Working hard has nothing to do with it. About 2 weeks ago, a very bright fellow who works for me said, "This is a very frustrating business. It doesn't matter how hard I work, it has no bearing on whether I make money or not. You have to know yourself and put that knowledge to work in the market." That sounds like a cliché. What do you mean by know yourself? I'll give you an example. I think I'm a good trader, but there is a guy working for me who is better. I could go out there and beat my head against the desk and try to outdo him, or I can just be myself. Let him make whatever he can, and I'll make whatever I can. This is my view of a year in the life of a trader, for out of 12 months you are hot. You are so excited that you can't sleep at night. You can't wait to get to work the next day, you're just rolling. 2 months out of the year, you are cold. You are so cold, you are miserable. You can't sleep at night. You can't figure out where the next trade is going to come from. The other 6 months out of the year, you make and lose, make and lose. You can't sleep, because you are trying to figure out how you are going to make money. The net result is that you never sleep, because you are constantly thinking too much about trading. It is an all-consuming thing. That is why you need to know yourself, to moderate your emotions. If you don't, then after a big success, you are high as a kite. You are not prepared when just around the corner, the market suddenly brings you back to earth. Or, in the opposite situation, when you are consistently losing, you might end up jumping out of a window. Why did I leave the floor? Again, because I know myself. I need to interact with people and that doesn't happen there. Being on the floor sounds like a very intense thing to be doing day in, day out. Does it physically grind you down? Absolutely. You can see that in the older fellows. When you are in your 20s and 30s, you can rebound pretty well from the physical and mental stress. As you get older, you don't rebound as well, and you have to push harder to maintain your performance. It sounds like professional sports. You get to a certain age and no matter how good you were. That's right. It's exactly like that. Out of every 100 people who go to the floor to become traders, how many will make at least $1 million within 5 years? Maybe 5 or less. How many will end up losing everything they came in with? 133. At least half. You have been more successful than most traders. What do you attribute your success to? The reason I have been so consistent is that I'm a great listener. I probably talk to about 25 traders each day. Most traders don't listen to your opinion, they only want to tell you their opinion. I am different because I honestly and truly listen to what they say and how they say it. For example, if one of the major locals calls me up 3 days in a row when the market has rallied, and he is asking me what I think, I know that he has been selling and is not sure of his position. What does that tell you? If it is in line with what the other traders I talk to are doing, it tells me the market will probably go higher. So if you talk to 25 people, and 20 of them are nervous about the market going higher because implicitly they are short, does that tell you that you should be trading on the long side? Yes. I know a large number of people in the industry, and that is a big plus. I listen to them. I go with the people who are hot. Sure, I can form my own opinion, but that is not what makes me do the things I do in the market. Sometimes, my opinion is right, and I'll go with it. Sometimes, I know somebody else is hot, and I'll go with their opinion. I'm not picky about how I make my money. It doesn't matter if my opinion is right or wrong. All that matters is whether I make money. Doesn't it get confusing when you talk to 25 people and 15 are bullish and 10 are bearish? Sometimes, but I've been doing this since 1976. I've always been able to read people very well, even though no one thinks I listen. For example, I have one trader here who is cold as ice right now. All I have to do is listen to him. Last night, he told me he wanted to be short. I knew that I was going to be long. As long as he is cold? Right, and the one time he gets hot, fine. When the guy is cold, he is cold. You can't say to a trader, "You're cold," you can't trade. You have to let them run their course. Is reading other traders a key component of your personal trading right now? Yes, I'm pliable. I know these people, so I understand how to read them. I don't want to hear what Jack Schwager says, because I don't know him. I only want to talk to people I know very well. What other things are important to your trading success? The realization that when you don't care, you do well, and when you try too hard, you don't do well. By trying too hard, do you mean pressing when there is no trade? Pressing is one of the reasons I'm sitting in here with you for so long during trading hours. The markets haven't traded well in weeks, and we are proud of ourselves for not having thrown a lot of money away. So when the opportunities aren't there, you just lay fairly low? Don't misunderstand me. I'm not that good at that, but I have gotten better as I've gotten older. I've learned that lesson over the last couple of years. After Richard Dennis left the floor, he said, "The first year I left the floor was the most painful experience for me, and I have paid the largest tuition I ever have." It was the same with me. What was the motivation for coming off the floor, since you were so successful there? I felt that the industry had developed to the point where my brokerage skills were no longer needed. All anyone wanted to know was, where's the next tick? How can I move size? The price to be paid for my particular skills was too low. You are talking in terms of customer business? Customer business and trading. The market had gotten so voluminous that my style of swing trading was worthless. It got to the point where I was just trying to read the next tick instead of the next 8 ticks. Why couldn't you play the same game? The volume was too big, capitalization was too big. I couldn't read the market from the floor. Because there were too many players? Exactly. In the early days of T-bond futures trading, the depth was low and you could read when people were overextended long or short. You couldn't do that anymore. Did your performance start decreasing? Did you see the handwriting on the wall? In 1985, one made under $1 million trading for the first time, and I knew something was wrong. I had always been a very consistent trader, making more money each year. I looked at my results and found that my profits were smaller, meaning 3 and 4 ticks, and my losses were greater. My first reaction was to become a much more active pit trader. I found that I was taking on tremendous positions and the risk-reward was insane. That was when I became convinced that I had to make a change. Were you just lucky that you didn't get hit really hard during that period on any particular trade? Actually, I did get hit pretty hard a couple of times, but I had some good winners too. The point is that as I worked harder and harder, I found that all I was doing was running in place. I don't like to work hard at trading, and here I was just mentally and physically exhausting myself. If you had been doing as well as in previous years, would you have stayed in the pit? Yes. The pit is a very stimulating environment. Off the floor, you have to force yourself to be motivated each day. That was a very difficult transition. 134. Is it harder to trade off the floor? Not in the long run. My profitability in 1987 and 1988 has been pretty good. You mentioned that your first year off the floor was very difficult. Was the main problem that you were still trying to trade the market as you did on the floor? Yes, that was the number one reason. The second reason was that the transition occurred during the 1986 runaway bull market. I was bound to lose because my style was not based on following trends. Is that still true? No, it has changed. I've gotten better. I can still counter-trend trade real well, but I found you can also make a lot of money trend following. Do you use trading systems? No, we are discretionary traders. We only use technical indicators and systems as trading tools. 1 particularly interesting system we have developed is based on quirks related to volatility. Our belief is that volatility offers clues to trend direction. Although we found through backtesting that this system gives you good signals, we do not blindly follow the trades. For an automated, computerized system, what would you consider good results in terms of average annual return? About 40 to 50%, with maximum equity drawdowns under 10%. But systems will always have larger maximum drawdowns than that. That is why we haven't directly traded money on them. Do you think any system can compete with a good trader? I haven't seen one yet, although there may be one somewhere. There are some traders who have the skills, but who don't succeed. What is it that keeps them from becoming successful? A friend of mine at one of the Japanese shops told me about a Japanese trader who bought just about every long bond on the screen. About 15 minutes later he called back and asked, why is the basis, the price spread between cash T bonds and T-bond futures, going out? Naively, the Japanese trader had noticed that cash prices had gone way up, while futures didn't go up very much. My friend told him, well, you just bought every bond available. Of course, the basis is going to go out. They didn't really understand the impact of their trading. The Japanese did much the same thing in the US equity market in 1987 as they did in bonds in 1986. They practically took control of it, buying because prices kept going higher. One never forgive myself for not buying stocks and selling bonds in 1987. That was going to be my number one trade in 1987. Was the reasoning that the bond market had already run way up while stocks hadn't? Did you just believe the two markets were out of line value-wise? That's right. Also, we knew the Japanese were buying the high capitalization US stocks. Having already learned their buying style in the bond market, the trade was even more obvious. Then why didn't you do it? The spread between the S&P and the T-bond contract was trading between $19,000 and $25,000 on a 1-to-1 contract value basis. I went on a 4-day vacation, and in just a few days, Japanese buying in the stock market had pushed the spread to $30,000. Why didn't you buy the spread before the vacation, since you had the idea? I was waiting for the spread to break out above its trading range. I wanted to buy it above $26,000. At a $30,000 spread, I just couldn't pull the trigger. What is the key trading rule you live by? Never add to a loser. What does the average trader do wrong? He overtrades and begs for tips. How do you handle a losing streak? I instinctively trade smaller and sometimes I just take a break. It is a good habit to wipe the slate clean and start fresh. When you are going bad, but still have some good positions on, do you liquidate them as well? Absolutely. They are bound to turn against you too. I found the subjects of dual trading and the Japanese impact on the US T-bond market among the most interesting portions of my conversation with Brian Gelber. These subjects, however, did not provide any insights into the art of trading. On a more practical note, one of the primary caveats provided by Gelber concerned the misuse of brokerage research. He noted a tendency for the broker and client to use longer-term research for short-term trading. This misapplication of information often leads to trading losses, even when the research is right. Clearly, flexibility and suppression of ego are key elements of Gelber's success. Referring to hot traders, he notes, "I'll go with their opinion. It doesn't matter if I'm right. All that matters is whether I make money." Finally, Gelber's reaction to losing streaks is one-sided by a number of traders. He advises wiping the slate clean and starting fresh. Getting out of everything allows the trader to achieve greater clarity. Liquidated positions, if they still appear attractive, can always be re-entered once the trader has regained his confidence. 136. Tom Baldwin, the fearless pit trader. The trading pit of an active futures market is an imposing place. Scores of traders push over each other, while shouting buy and sell orders at the top of their lungs. To the uninitiated, it seems miraculous that this institutionalized bedlam actually functions efficiently as a process for executing orders. In the frenzied world of futures pits, the T-bond ring, with over 500 traders, stands out as the unchallenged giant. The pit is so large that one side of the ring often does not know what is happening on the other side. By most accounts, Tom Baldwin is the single largest individual trader in the T-bond pit. His trading size puts him in the same league as the primary institutional players. Single trades as large as 2,000 contracts, $200 million. Face value T-bonds are not unusual for him. On a typical day, he may trade over 20,000 contracts, the equivalent of $2 billion in face value T-bonds. Baldwin is in his early 30s, having begun trading T-bonds a scant 6 years ago. Baldwin's entry into the world of floor trading sounds more like a recipe for failure than success. In 1982, with no prior trading experience, Baldwin left his job as a product manager for a meatpacking firm to lease a seat on the Chicago Board of Trade. His stake was only $25,000. Out of this skimpy capital base, he had to pay over $2,000 per month to lease the seat, and at least another $1,000 per month for living expenses. As if this were not enough, his wife was pregnant at the time. Obviously, Baldwin is not one to play it safe. His aggressive risk-taking posture is one of the key elements of his success. He turned a profit from the beginning. He was a millionaire before his first year was up and has never looked back. Although he declines to discuss the extent of his winnings, $30 million appears to be a conservative estimate. The true figure could be significantly higher. I considered an interview with Baldwin essential to this project, because of his prominence as the most successful floor trader in the world's largest futures market. Baldwin, however, was not eager to be interviewed. Although he had done some interviews in the past, he had obviously grown reluctant to do any more. Without Brian Gelber's generous intervention, the two are friends and admire each other's trading abilities, this interview would never have taken place. Gelber had warned me that Baldwin could be either abrasive or gracious, but to be prepared for the former. As an example, Gelber said that Baldwin would probably answer the question of how he first got involved in trading. With the curt response, I went down to the floor and began trading. As it turned out, this was very close to the spirit of his answer. I arrived at Baldwin's office several minutes after the end of the day's trading. Baldwin arrived a few minutes later. Since he had just moved to new offices and the furniture had not yet been delivered, the interview was conducted sitting on a windowsill. Baldwin's attitude was neither abrasive nor gracious, aloof might be the best way to describe it. I had the distinct impression that the minute I hesitated in asking the next question, Baldwin would be gone. It was St. Patrick's Day, and this impression was intensified each time someone left the office saying that he or she would meet Baldwin at a local bar. I could sense that Tom was anxious to join them. I decided to conduct the interview completely impromptu, shooting off a new question the second he finished answering the prior one. Often his responses were quite short. I felt like a photographer stalking a rare bird, one false step and the bird would fly off. I knew that, at some point, I would not be able to think of an immediate follow-up question. This happened about 40 minutes into the interview. I quickly glanced down at my index cards, searching for a lead. Unfortunately, my eyes focused on a question I had already touched upon, and though I tried to ask it from a different perspective, it was too late. The game was over. Baldwin said he had to get going and excused himself. How did you first get interested in trading? I had taken some classes in commodities in graduate school. I wanted to trade, but I didn't have the money to buy a seat. In 1982, one found out I could lease a seat, and that's when I began. Did you always want to trade as a local as opposed to any other type of trading? Yes. How did you learn to trade? One lot at a time. I always had an opinion. All day long I stood there and developed an opinion. As I came to see that my opinion was right, I was reinforced, even if I didn't make the trade. Then when I traded, I knew from standing there 6 hours a day, every day, that most of the time I was right. I would see the same scenarios develop over and over again. Are you talking about market patterns or traders doing certain things? Both. Market patterns would occur over and over again, or market players would do the same thing over and over again, and you just trade it. What were your first few months like? Were you profitable initial? I think the most I was ever down was 19 ticks, so I pretty much started out profitably. Coming to the pits with no background, what was it that gave you enough of an edge to be right on the market? I worked hard. Were there periods when you were unsuccessful, or did you remain consistent? Consistent. Didn't you have any losing months? Yes, I had 1 or 2. But not 2 together? No, never. What percentage of those who come to trade on the floor are still around after 5 years, versus losing their stake and dropping out? Less than 20%. That is really the rule of thumb, and it's probably less than that. What percentage are successful to the point of making and keeping at least a couple of million? 1%. In other words, a very small fraction of traders. Right. It is like any other industry. How many people get to be president of General Motors? Do you have an opinion about what separates the 1% from the other 99%? Yes. It is a lot of hard work, for one. It's perseverance. You have to love to do it. Also, in our business, you have to have a total disregard for money. You can't trade for money. Do you mean as long as you like the position, you stay with it? That you can't think, I'm losing $1 million on this trade, and with $1 million I could have bought a great house. You can't translate it into real terms. Exactly. Most people do. I guess another way of saying it is you have to have almost no fear. Right. Is that a characteristic of winning traders? They have less fear than the losers? Yes. Can you size up a new trader on the floor and tell if he is going to make it or not? Yes. What kind of things would tip you off that he is a loser? Most important, losers don't work hard enough. Most people walk in and think there is a 50-50th chance on any trade. They don't think there is anything more to it than that. They don't concentrate. They don't watch the factors that affect the market. You can see it in their eyes. It is almost as if there is a wall in front of their face. By factors, do you mean fundamentals? No. Paying attention to what other markets are doing, such as the Dow Jones or gold. Watching the traders in the pit. Patterns? Yes. 138. In other words, they are not paying enough attention. They are standing there trying to pick a trade here and there, but they are not absorbing everything that is going on. Right. Also, their expenses are usually way too high. They can't stand there and hack it long enough to pick it up. Because it is like any job, if you stand there long enough, you have to pick it up. It is just a matter of how long you can afford to stand there before you do. Do you really believe that? Well, the average guy might not be $1 million trader, but if he stands there for 5 years, he would have to pick it up. It is just like a job. You don't start any job and feel comfortable in the first 6 months. You did. Yes, but I did start as a one-lot trader. And I wasn't really comfortable, because I had to make money. I only had $25,000 to my name. At what point were you confident that you were going to be successful at it? That is an interesting question. You are never really confident in this business, because you can always be wiped out pretty quickly. The way I trade is, live by the sword, die by the sword. There is always the potential that I could get caught with a big position in a fluke move with the market going the limit against me. On the other hand, there is no doubt in my mind that I could walk into any market in the world and make money. What percentage of your days are losers? One day out often. Has that percentage changed over time? That is over a long period of time. From your perspective, what does the average trader, that is, public trader, do wrong? They trade too much. They don't pick their spots selectively enough. When they see the market moving, they want to be in on the action. So, they end up forcing the trade rather than waiting patiently. Patience is an important trait many people don't have. Waiting for the right spot? Right, I bet most people are probably ahead after their first 5 trades. They think, this is great, like free money. But then they forget that the reason they made money on their early trades was because they waited a long time. They said, I bet this is a good spot to buy it because I've seen the market act this way a lot of times. And they made money. But all of a sudden, they are doing a trade every day. The next thing that happens is they lose on a few trades, and invariably don't know how to take a loss. They made money to start, and before they know it, they are even. Now they hesitate. Where do I get out? The minute they hesitate, the market just keeps going. Now they are losing money and they say, if I sell it here, I'm going to lose $1,000. They don't like to lose $1,000 when they're getting paid $500 a week. Now, all of a sudden, they are thinking about the money. Once you think about the money, you are dead? Yes. That is what usually happens to the public. What is your own way of handling losses? Get out quickly? If I can. My point is that I have a lot of patience and I wait. If I know it is a losing trade, I wait for what I think is the optimum time to bail out. Then I try and reverse. So, if you realize you don't like the trade anymore, you'll get out, but you'll pick your time? Right, but I will get out. Let's say you are doing that on a day when the market is a one-way street. At what point do you just have to cough it up? It depends how far it has gone against you. If it's against you a long way, at some point you just throw it in. Those days happen maybe 3 or 4 times a year. You just start bailing out. But you usually have a feel for when that is the thing to do? Yes, because it has happened before. But normally, if you are just a bit behind in a trade, you are better off if you let the market move a little in your direction and try to sell on strength, or buy on weakness, instead of just trying to dump it in a hurry? Right. Is that a key element to your trading style? Yes. Never give up on a trade. Many traders who are in a losing trade will just get out because they were taught that you have to have discipline. Great. Those traders will always be around. But if they just had some patience and said, yes, it is going to be a losing trade, but instead of getting out here at 7, maybe if I wait and just sweat it out for another minute, I can sell at 10. Is it a matter of just wanting to get out to stop the pain? And if they were willing to stand the pain a little longer, they would be better off. Is that a fair way of putting it? Yes. They give up too quickly. In most cases, if you don't give up, you might be able to turn a 5-yard loss into a 2-yard loss. Your trading size has obviously grown quite dramatically since you first got into the business. Has 139. That made it harder to trade? Yes, you have to adapt. You need to change your method of buying and selling. Because the market is continually changing in subtle ways. What changes have you seen in the bond market since you got in? Well, you can trade bigger size. Now you can usually trade a couple of hundred at each tick. It doesn't move the market as much. How about 1,000 lots? It depends on the liquidity at the time. Lots of times you can get out. It is amazing how much liquidity there is when you want to get out. On average, if you had to dump 1,000, how much would that move the market? Depending on the time of day and the liquidity, maybe 1 or 2 ticks. Not much at all? No, not much. Has size been an impediment at all if the liquidity is that good? Yes, it is harder. Generally, when you get into a big position, the rest of the floor knows about it because they stood there and watched you. At least they think they know. They all put their hands down and wait when they think you are wrong. It is natural for a trader to be skeptical. I would almost think that because you have a long-term record of success, they would more often coattail you. Lots of times that is true, and that also makes it harder to get in and out. When you go to offer them, they are all offering too. How do you handle those situations? You have to pick your spot. You have to wait for the big paper order to come in and then go for it. Does it become like a chess game, where you sometimes want the pit thinking that you are selling when you are really buying? Yes, sometimes. But generally, you can't trade big size when you are doing that. So, frequently, if you are long and want to liquidate, you just wait for the bid to come in? Right. What kinds of things do you look for in a chart? Key points such as the high and low for the week, the halfway back point, and consolidation areas. Do you use charts for short-term or long-term perspective? Short-term. Short-term in your case meaning? I guess as short as possible. You get in a trade, make money as fast as possible, and minimize your risk. I've noticed that a lot of times, bonds will take out 1 and 2 week highs or lows by a few ticks, and then pull back. The price action almost seems like a trap for the breakout players. Is that a pattern in the bond market? Yes. It always has been. Do you use fundamentals? Whenever any important fundamental numbers come out, I use them. Do you use the fundamentals indirectly, that is, by seeing how the market responds to the new information? Yes, but also by being the first one to trade off the new fundamental information. I know what I am going to do if a number comes out one way or the other, and I usually have the opportunity to be first. You want to get there before the crowd does. Are you normally right on that type of trade? Yes. You've done tens of thousands of trades. Does any single trade stand out as particularly emotional? The first 100 lot I did. It was a milestone. What kind of jump was that for you? You tend to go from 1 lot to 5 lots to 10 lots to 20 lots to 50 lots. So, you probably went from 50 to 100? Do you remember that trade? Yes, it was a much bigger risk. The market was trading at 64.25 and a broker bid 25 for 100 lots. But he didn't put a size on it, he just bid 25. So I said, sold. He thought I was being funny and said, I'll buy the 100. Knowing I had never traded that big before. So I said, well, I'll sell you 100. The market went to 24 offered. Instantly. It almost sounds like you did your first 100 lot as a dare? Well, almost. But I wasn't a very good trader then. I immediately bought 10, then 10 more. I was trying to bid at 23, and the market went to 22 offered. By the time I got out, I had 10 different people in the trade, because I 140 didn't know how to cover 100 lots. But the trade worked out for you? Oh yes. Well, actually, the word got out that this small trader had done a 100 lot. So I had to go up to the office to talk to the clearing firm after the close. How long had you been trading at that time? 6 months. That was pretty early on. I assume your capitalization was really inadequate to handle 100 lots. Right. I had probably made $100,000 by then. Maybe not even that. Even at $100,000, that wouldn't cover you for much of a move. Yes, only 1 point. In bonds, 1 point equals 32 ticks, the smallest price movement. I told them, look, I just thought it was a great trade at the time, and I'll probably never do it again. How long was it before you traded 100 lots again? 2 days. You just never thought about the risk side of it? No, if a guy bids 25 for 100, and I think that it is a great trade, I just say sold. Is there any element in your mindset as a trader that says, I had better be careful that I'm always in the game? That came later. Are you always in control, or are there days when you have lost control? There were days when I've lost control. Any that stand out? A couple. You have to say that about any day you lose a couple of $1 million. Were those days one-way street markets? Yes, one-way streets. Because I'm a market maker, I take the other side of the trend. So, if the market goes one way for 50 ticks, I can guarantee you I'm going the wrong way, and at some point, it is going to be a loss. What was your position at the October 1987 low in bonds? I was long. When did you start getting long? 5 points higher. 5 full points. You mean 81? Yes. The day it broke below 77, one was long thousands of contracts. Other traders were also heavily long. That was the day we gapped sharply lower. Who was selling? The commercials just kept selling. Did you have second thoughts? Yes. Did you think if the market went down to 76, maybe it could go to 70? No. At that point, you had to say it was all over and done. Why? Technical analysis and experience. Was that an example of your being patient in picking your spot to get out, even when the initial trade was wrong? Right. Do you ever use any trading systems for anything? No. They wouldn't be there if they weren't wrong. Do you think trading systems are a losing game? Sure. Why do they exist? You tell me. Because people aren't confident in their own ability. If you had a really good trading system, you could make millions. Why would you sell it for $29.95? Does luck have anything to do with trading? Trading is like any other job. You work hard, put in the time and effort, and make your own luck. I was lucky that the first 100 lot I sold was a winner. But why was I lucky? Because I stood there all day for over 6 months. Developing and honing market feeling. When the opportunity occurred, I didn't hesitate. You have to pay your dues to get the luck. Right. Are there people on the floor who are not good traders, but are way ahead because they just happen to do a couple of big trades on the right side of the market? Can anybody really get by just on luck? No, not for long. The rule of thumb is if you have lasted a year, you will make it, but it is hard. 141. Are there traders that you are influenced by because you respect what they are doing? Oh, yes. They are indicators. So, that is actually part of your trading approach. For example, if Trader X is a good trader, and he is on a roll, and you are thinking of selling, and he does, then you know you're right. But if he is buying? Then you hesitate. Maybe you don't get into the trade. Are there traders who can't succeed because their ego is too big to ever be influenced? Yes. Is part of the success a willingness to not always do your own thing? Right. You have to adapt to your success. If you make a lot of money, all of a sudden you start to think you are infallible. You forget the reason you were right was because of all those little factors that you followed. As soon as you think, I'm the guy who is going to lead the way, you get slammed. So, it really doesn't make a difference whether it is your idea or somebody else's. Winning or losing is all that counts. Where the idea came from isn't important? Right. Do you have to be somewhat of an egomaniac to be a good trader? Actually, the best traders have no ego. To be a great trader, you have to have a big enough ego only in the sense that you have confidence in yourself. You cannot let ego get in the way of a trade that is a loser. You have to swallow your pride and get out. After you get way ahead, is there a temptation to say, the extra money doesn't mean anything anymore, maybe I should cash in the chips? I never thought that way. Obviously, when I started, I needed to make money to support my family, but I never had a goal to make $1 million. I said, hey, this is great, maybe I can make $100,000. You passed that a very long time ago. Do you have any other goals? No. You just do what you do because you enjoy it? Yes. And I hope it lasts. Baldwin's incredible trading achievements made him an ideal interview candidate for this book. However, I did not really expect his comments to be pertinent to myself or other off-the-floor traders. After all, what could a floor trader, whose time horizon is measured in minutes and seconds, say that was relevant to traders who hold positions for weeks or months? To my surprise, the interview yielded some relevant insights. Perhaps the most important point made by Baldwin was his emphasis on not viewing trading in terms of money. To him, money is only a means of keeping score. By contrast, most traders tend to think of gains and losses in terms of their monetary implications, a frame of mind that only gets in the way of making trading decisions. For example, assume you originally planned to risk up to $5,000 on a trade, and quickly find yourself down by $2,000. If, at this point, you start to think of the trade in terms of money, for example, the extra $3,000 can pay for my vacation, you might well liquidate the position, even though you still believed in the trade. It is one thing to get out because you no longer like the position, but it is quite another matter to liquidate on impulse simply because you have translated the risk into tangible terms. Another interesting point made by Baldwin is an unconventional one: don't get out of a losing trade too hastily, instead, wait and choose your time. This advice seems to fly in the face of most trading advice. After all, isn't one of the basic tenets of trading success to cut your losses quickly? However, I don't think Baldwin's statement contradicts the rule. I believe he is saying that often the worst time to bail out of a position is during a violent price move against you. Baldwin's point is that by bearing the pain just a little longer, you may be able to find a more Favorable circumstance for liquidating. Of course, this philosophy should be applied only by disciplined traders, those with the ability to maintain a risk control strategy. 142. Tony Saliba will not triumphs asterisk. Tony Saliba came to the floor of the Chicago Board Options Exchange in 1978. After a half year of clerking, Saliba was ready to try it on his own. He found another trader to back him for $50,000, and after a favorable start, nearly self-destructed, he pulled back from the brink of disaster by altering his trading techniques, and has been successful ever since. Saliba's trading style can be described as trying to do a little better than treading water day in, day out, while being positioned to take advantage of the rare spectacular trading opportunity. His fortune has been built largely by exploiting only a handful of such events. Two of these situations, the Teledyne price explosion and the October 1987 stock market collapse, are discussed in the interview. The impressive aspect of Saliba's trading achievements is not the few spectacular gains he has registered in his career. Rather, it is that these gains have been achieved by using a trading approach exemplified by incredible risk control. In fact, at one point, Saliba managed to string together 70 consecutive months of profits exceeding $100,000. Quite a few traders have become multimillionaires by scoring several big hits. A much smaller number have managed to hold on to their gains. Only the rare trader can boast both occasional dramatic gains and consistent trading profits. Asterisk readers unfamiliar with options may wish to first read Appendix 2 in order to understand the trading-related references in this chapter. Although the homework required for Saliba's successful trading is extensive, he has nonetheless managed to diversify into a wide range of other ventures, including real estate investments, a software company, and a restaurant chain. Overall, his extracurricular business endeavors have proven only modestly profitable, but they have indulged his appetite for variety. During the time these interviews were being conducted, Saliba was involved in the most important business venture of his life, negotiating with a French bank to back him with several $100 million to form a major trading company. His goal is to discover and train a generation of successful traders. Saliba is a likable person who makes you feel like you're one of his best friends within 5 minutes of meeting. He is a person who genuinely likes people, and it shows. On the evening before our scheduled meeting, Saliba had a minor accident, slipping on the marble floor at the health club in the Chicago Board Options Exchange building. As I showed up at the scheduled time, his aide told me that Tony would not be in that morning due to the accident. I left a message. Saliba called later that day, and to spare me the inconvenience of missing my flight that evening, or making another trip to Chicago, he arranged to meet me several hours later. We talked at the LaSalle Club bar, which was sufficiently empty to not cause a major distraction. Initially, I was too intensely focused on directing the interview to pay any attention at all to the large movie screen at the front of the bar. Later on, however, as I relaxed, I glanced at the screen as Saliba was answering one of my questions. I instantly recognized the train scene from the movie Risky Business, in which the sensuous Rebecca De Mornay seduces Tom Cruise. I have a bad habit of severely overscheduling my appointments, and as Saliba was my third interview of the day, I was beginning to feel the strain. My first thought was, keep your eyes off the screen, you are having a hard enough time keeping your mind focused as it is. My second thought was, it would be incredibly rude not to pay full attention to Tony, especially after he literally hobbled over to spare me the inconvenience of having to reschedule our interview. My third thought was, thank God I'm the one facing the screen. What led you to become a trader? I was a caddy for some grain traders when I was in high school. In college, a friend of mine asked me if I would like to be a broker. I thought that he meant doing the same thing as the guys I had caddied for. So, I said, yes. Great. Where? Indianapolis, he answered. I said, what exchange is in Indianapolis? None, he said, you. Do it on the phone. I had this impression of, hello New York, bye, Chicago, sell. When I got there, I found out I was a salesman. After a few months, I asked the guys in the office, who makes all the money in this business? They said you have to be on the floor. Right there I decided to go to the Chicago Board Options Exchange. On the floor, I met one of the traders I had caddied for years ago, and he grubstaked me with $50,000. Isn't that unusual, giving $50,000 to a kid who used to caddy for you? It was, except that he was very wealthy and needed to get off the floor because of his high blood pressure. He owned a seat that he had bought for only $10,000, and just needed the ability to trade in a customer account. I was going to help him do that. What made him think you could make it as a trader? He had heard some rumors around the floor that I was a hotshot clerk, and he basically took a chance on me. What happened? I went from $50,000 to about $75,000 in the first 2 weeks. I had put on all these volatility spreads, an option position that will gain if the market becomes more volatile, and they were getting pumped up. Did you think, boy, this is easy? I thought, this is it. I mean, I was a genius. But what I was really doing was taking the opposite side of positions the other brokers were liquidating, letting them out of the market with their profits, while I was left holding the bag. This was spring 1979 and implied volatilities were very high because 1978 was a very volatile year. Well, the market went nowhere, and the volatility and option premiums collapsed. Within 6 weeks I had lost almost everything. The original $50,000 was down to only about $15,000 and was feeling suicidal. Do you remember the big DC-10 crash at O'Hare in May 1979, when all those people died? That was when I hit bottom. 143. Was that a metaphor for your mood? Yes. I would have exchanged places with one of those people in that plane on that day. I felt that bad. I thought, this is it, I've mined my life. Did you feel guilty because you had lost someone else's money? Yes, and I felt like a failure. Had you started out confident? Initially, I was very confident because before I started trading on my own, I had clerked for a broker for 4 months and picked his brain clean. And now you thought the game was over? Yes. In June 1979, one decided that I better find another job. I went to the Levy brothers, who owned a chain of restaurants that my dad built for them. They said, anytime you want a job, you can run one of our restaurants. So I said, hold that line. I am going to give it 1 more month. Did you feel better because you had a cushion? Yes. I said, this is great, I've still got 15 grand in my account. You had a stop on your life, so to speak? Exactly. I had a stop on my career. So, I decided to go back and give it 1 more shot. Did the fellow who staked you know how much you had lost? Did he ever say anything? Oh, good question, Jack. He called me every night. I've grubstaked many guys since then, and 3 or 4 of them have lost more than 50 grand each. This man was a multimillionaire, and he acted as if this was the end of the world. Did he ever ask you for the rest of the money back? No, he just moaned and groaned. He had become wealthy through inheritance and money he made in another business. He really didn't know much about option trading. He had bought the seat to have something to do with his life. He told me, if you lose $5,000 more, we'll pull the plug. So, I spent the next few weeks winding down my positions. During that time, I sought advice from the more experienced brokers on the floor. They said, you have to be disciplined and you have to do your homework. If you do those two things, you can make money down here. You might not get rich, but you can make $300 a day, and at the end of the year that's $75,000. You have to look at it that way. It was like a light bulb went on. I realized that this chipping away approach was what I should be doing. Not putting myself at a big risk, trying to collect a ton of dough. At the time I was in Teledyne options, which was a very volatile market. So, I switched to Boeing, which was a very tight, narrow range type of market. I became a spread scalper trying to make a quarter or an eighth of a point on a trade. I stuck strictly to my goal of trying to average $300 a day, and it was working. This period taught me to be regimented and disciplined. This day, I live by the credo of hard work, homework, and discipline. I teach my guys that. Anyway, at this same time, I still had the remnants of a big spread position in Teledyne that I was in the process of liquidating. It was a position that would lose in a rising market. One day after I had been trading Boeing for about 5 weeks, Teledyne started moving up sharply. I was not going to let it get me again. I rushed into the Teledyne pit to take my position off. I was hearing floor brokers come in with orders, and all of a sudden I found myself responding to them. I was adapting the same technique I had learned in Boeing to Teledyne, except instead of scalping for an eighth or a quarter, I was scalping for halves and dollars. What size were you trading at the time? I was doing one lot at a time. The guys didn't like me because I was getting in their way. They wanted to do 10 or 20 lot orders. In other words, you were just a nuisance. Exactly. How did you get someone to take one lot? On the options floor, it's first come, first served. If you have 100 to sell and someone bids first for just one, you have to do his one before you do 99 with the number 2 guy. The broker could ignore you if he wants, but if he does, he's breaking the rules. Were you ignored? The brokers never did, but the market makers on the floor did. By brokers, you mean order fillers? Yes. The floor brokers are the order fillers, and the market makers are the locals who trade for themselves. On the options exchange, the two are separate. Were you the only one-lot trader in Teledyne? For the most part, yes. Did you take a lot of ribbing? Oh, did I? They call 144. Did your ego get dented by these really successful traders railing you? Oh, yes. And it went on for almost a year, day in, day out. Were you tempted to pick up your trading a little bit? I did, but not for that reason. My backer, who had given me such a hard time when I was down, was the prod. Although he didn't know that much about trading, he did give me one piece of very useful advice. Once I started turning it around, he told me to increase my size. He said, Tony, a banker makes his first loan and he is very careful, but as he gets more comfortable, he makes his loans bigger. You need to increase your size. How did the harassment you were taking on the floor finally end? When they introduced puts in June 1980, the lead trader, who had given me the hardest time, hated them. He said they were bad for the business and he didn't want to trade them. I seized that opportunity to really study what puts would mean to us, and I was one of the first market makers to start trading puts. Actually, it opens up a whole range of new strategies. Oh, unbelievable. These other guys were set in their ways, even though they had only been there a couple of years. Sooner than you might think, this Enmer 1 trader befriended me and suggested that we work together. We started working on advanced strategies, getting real creative and abstract. Were you working these out on a computer? No, we did everything by hand. Writing out all these what-ifs. Didn't you still have to be guessing right on price and volatility direction? You would have to guess right on volatility. However, we didn't have to peg market direction, because we were setting up spreads that had a big edge. For example, one option might be highly overvalued because it was popular among the member firms. Eventually, I felt I was doing more of the work, while this top trader in the pit was counting on his ability to muscle the market. He would also stray from the strategies we had worked out and even started doing things to try to hurt me. I would say, "What are you doing?" He would just answer, "I changed my mind." Finally, I just said, "Forget it, I'm working on my own." I started taking on more size. When interest rates went through the roof in 1981 and early 1982, my strategies worked really well and I started making a lot of money. Then in the bull market in 1982, one had days when I was making $200,000 a day. The guys in my clearinghouse couldn't believe the sheets, there was just tons of paper. "What kind of trades were you doing?" I was doing everything. I consider myself a matrix trader. I trade everything on the screen as it interrelates to everything else. My basic strategy, however, was buying butterflies, a long or short position at one strike price, balanced by an opposite position in higher and lower strike options, for example, long 1 IBM 135 call, short 2 IBM 140 calls, and long 1 IBM 145 call, and offsetting that with an explosion position. By buying butterflies, do you mean you were long the middle or long the wings, that is, the higher and lower strike price options? Long the wings. Your risk is limited, and if the market does not move widely, time decay works in your favor. Barring a favorable price move or an increase in volatility, the value of an option erodes steadily. The premium erosion in options with a strike price near the market price, middle and butterfly spread, will be greater than that of options further removed from the strike price, wings and spread. Of course, I tried to buy the butterflies as cheap as I could. If I chained enough of them together, my profit zone would be fairly wide. Then I would do an explosion position in a more distant month. What do you mean by the term explosion position? That's basically my own term. An explosion position is an option position that has limited risk and open-ended potential, which will profit from a large price move or an increase in volatility. For example, a position consisting of long out-of-the-money calls and long out-of-the-money puts would be an explosion position. It sounds like the basic unifying feature of the explosion position is that as the market moves, the delta, the expected price change in the option position given a 1-unit change in the price of the underlying market, increases in your favor. So, you are really betting on volatility. Exactly. In effect, this is the opposite of what you do with the butterfly. Yes. I put on the butterfly in the front month, where time is working for me, and the explosion position in the mid or back month. Then I complement that with scalping to help pay for the time decay in the explosion position. In other words, the explosion position is your money bet in case of a big move, while your scalping is paying the bills, that is, the time decay cost of the explosion position. Exactly. Were you always offsetting one position with another? In other words, were you always delta neutral, an option position in which total equity will remain roughly unchanged for small price changes in either direction? Usually, but once in a while I would take a significant net position. What was your first really big trade? Teledyne in 1984. The stock had dropped sharply and I was building up a position in the out-of-the-money October calls. Well, the stock started inching back up, but these guys from the Pacific Coast Exchange, where they also list Teledyne, were leaning on my longs. They just kept battering them on the close every night. Instead of shying away, I stepped up and would buy them. You want to sell them at, I'm one bid for 50. This went on for over 10 trading days. 145. Why were these Pacific Coast traders leaning on the calls? The stock had gone down from 160 to 138, and then inched its way back up to 150.1. Guess they didn't think it was going to go up anymore. On May 9th at 9:20 they stopped trading in Teledyne because of news pending. The news comes across the tape. Teledyne announces a stock repurchase program at $200 per share. Buying back their own stock? Yes. The stock was at $155, and I owned the $180 calls. Overnight, I made millions. The stock eventually went up to $300. The next 4 to 5 months were great. What happened after that? One of my goals in life was to become a millionaire before I was 30 and retire. Well, I was a millionaire before I was 25. I had decided to retire when I was 30. On May 5, 1985, my 30th birthday, I walked off the floor and said goodbye to everybody, and that was it. I was never going to come back to the floor. How far were you up then? About $8 to $9 million. Did you know what you were going to do? I didn't really know. I thought I'd stay in the business somehow, but work off the floor. How long did your retirement last? About 4 months. Were you bored? Yes. I missed the markets. I missed the excitement. So, in the beginning, money was the goal, but once you got there it became secondary. Maybe if I had a wife and kids, or someone special in my life, I might not have gone back. But trading was my life. It made me feel like something, it gave me a reason for being. I understand one of your best trading periods was the week of the October 1987 stock crash. Tell me about it. I was expecting a big move, but I didn't know if it would be up or down. So, I started building the same type position that I had in Teledyne. The butterfly spread combined with the explosion position. Yes. What was the explosion position in this case? In this case, it was formed by buying out of the money puts and out of the money calls in the back months. To counterbalance this position, I had butterfly spreads in the front month, which would profit from time decay. What told you the market was going to have a big move? You could feel it in the wild gyrations that were occurring by late September. Did you expect the move to be on the downside by that time? Actually, I thought it was going to be on the upside. At first, I thought we were going to attack the old highs again. When did you change your mind? On Wednesday of the week before the crash, the market fell apart. Thursday, it didn't bounce back, but kind of churned. Now, if it had rallied on Friday, then I would have been confused. But instead, the market cracked on Friday. At that point, I was sure we were going down. Because it was the end of the week? Yes, and there is a high correlation between the action on a Friday and the follow-through on the next. Maniti, at least on the opening. Did you have any inkling of the size of the impending move on the following Monday? Do you know what I really thought was going to happen Monday? I thought the market would open lower, go down sharply, and then bounce back to about unchanged. I actually bought out of the money calls that Friday for protection. But you said you thought the market was going down? Yes, but I just wanted to have some insurance. A trader once told me, Saliba, in stealing second, you never take your hand off first until your other hand is on second. That's the way I am, I always have insurance. Still, you must have been awfully confident that the market was going sharply lower on Monday morning. According to the cover story in Success magazine, April 1988, it sounds like you knew the market would collapse. It says you even deliberately chose to go to the office instead of the floor to avoid being influenced out of your position by all the confusion on the floor. Isn't that highly unusual for you to go to the office instead of the floor on a trading day? Yes, if I'm trading, I'm on the floor. But that article is completely misleading. They wrote it that way to sell magazines. They make it sound like I planned and plotted to avoid the floor that day. That's not the story. I was concerned about the positions held by my clearing firm. One guy in particular had a huge position, which he wasn't closing, and I had to spend a great deal of time on the phone. Now, that's not as dramatic as the way the magazine wrote it up, but that's what really happened. 146. Didn't you also sell your seat that day? You must have been really confident the market was going down to sell a seat. I hit that seat before the market opened. I figured if I didn't hit the bid for the seat, someone else would. Anyway, I had 7 seats, I just sold one. Was this the first time you traded a seat? I mean, seats aren't exactly a liquid market. Yes, it was the first time I did it like that, trading the seat round turn in one day. But I have traded seats before. I trade them depending on my mood in the market. On balance though, I want to be long seats. I believe in our industry. But in that circumstance, it did seem like a good trade. I figured, hey, I have a lot of exposure in seats, a few $1,000,000 worth, I'd better take some protection. I sold that seat for $452,000 in the morning and bought it back the next afternoon for $275,000. How much did you make that Monday? That has caused me a lot of headaches. I would rather not say. Obviously, your big money was made in the out-of-the-money puts. What percentage of that position did you keep as of Monday's close? About 95%. You kept most of it. But the profits were so huge. Wasn't it tempting to just take it? The reason I didn't cover was because I felt my long puts hadn't gone up enough. They all went to parity. The puts that were 30 points in the money were trading at $30. In other words, the option premiums consisted almost entirely of intrinsic value. The market wasn't giving them any time value premium. Given the enormous market volatility, I thought that was crazy. So, you figured you would wait till the next day? Yes, and do you know what I did to hedge myself? I bought more insurance at the close on Monday. I covered hundreds of my short calls. You were basically buying more volatility. It was the best thing I could have done. The next day they didn't know what they wanted more of, half the world wanted puts, and half the world wanted calls. But everybody wanted volatility. That's when the register really started ringing. It was the day that the sun was so close to the earth that everybody needed zinc ointment, and I was the only guy that had some left. Let's take the other side of the fence. What did the traders who got buried in October do wrong? They took for granted that Monday would be a normal day. They started out long, thinking the market was just correcting and was due for a bounce. Then they bought on the way down, they bought every dip. Did some traders just freeze? Sure, some did. I have one friend who is a $1 million annual earner. On Tuesday morning, I walk in and say, "Hey, Jack, what do you think? Are you going to get them today?" But he just stood there. He didn't say a word to me. He looked shell-shocked. He just kept going over his sheets, looking for something to do, but not knowing what to do. So he missed all the opportunity. Why was the way you responded to the market so different from the way your friend responded? He wasn't sure what his position risk was. I always define my risk, and I don't have to worry about it. I walk into the pit every day with a clean slate, so that I can take advantage of what is going on. A clean slate sounds like you come in with a flat position every day, but you obviously hold positions overnight. I mean that I'm always hedged, and I'm always prepared. Do you always know the maximum risk in a position that you hold? Do you always know what your worst case is? Yes. Now, what could happen? The market sits, it explodes, or something in between. But no matter what happens, I know my worst case. My loss is always limited. Why do so many traders who come to the floor end up losing everything? I think the biggest problem with some traders that come on the floor is that they think they are bigger than the market. They don't fear the marketplace, and they lose sight of their discipline and the hard work ethic. Those are the traders who get blown out. But most guys on the floor really work hard. What is the biggest misconception the public has about the marketplace? The idea that the market has to go up for them to make money. You can make money in any kind of market if you use the right strategies. With futures, options, and the underlying markets, there are enough tools available to set up a game plan for any situation. In other words, the public has too much of a bullish bias? Yes, it is the American way, the market has to go up. The government never said anything about program trading when we were in a 3-year bull market. Once the market started going down, all of a sudden, program trading became a major concern, and they set up commissions galore. For the average person, like my mom or dad and their relatives, the biggest misconception is that they think 147. When the market goes up, you make money, and when it goes down, you lose. People need to approach it from a more neutral standpoint and say, I'm going to be a little long in this category and short in this category, but limit my short side risk because it is infinite. How do you handle a losing period? How do you lose money? It is either bad day trading or a losing position. If it's a bad position that is the problem, then you should just get out of it. Is that what you do? Yes. I either liquidate it or neutralize it, because then you are back afloat. When you are in a boat that springs a leak, you don't drill another hole to let the water out. What if your trading losses are due to your making bad decisions? What do you do then? Take a day off. If I get myself all wound up, I like to lay out in the sun and bake for a while and let all the strenuous stuff go out of my head. What are the elements of good trading? Clear thinking, ability to stay focused, and extreme discipline. Discipline is number 1, take a theory and stick with it. But you also have to be open-minded enough to switch tracks if you feel that your theory has been proven wrong. You have to be able to say, my method worked for this type of market, but we are not in that type of market anymore. Trading rules you live by. I scale in and scale out of my positions, so that I can spread out my risk. I don't like to do all of a large order right up front. What else? Always respect the marketplace. Never take anything for granted. Do your homework. Recap the day. Figure out what you did right and what you did wrong. That is one part of the homework, the other part is Project Hive. What do I want to happen tomorrow? What happens if the opposite occurs? What happens if nothing happens? Think through all the what-ifs. Anticipate and plan, rather than react. When you made your first few million, did you sock some of it away to limit your worst case possibility? No. My trading strategies were growing and I needed new capital. Then after I made some more, I started putting money into other investments, real estate, stores, exchange seats, and things like that. Then when the market crashed, I hate to use that term, on Monday, October 19, one realized that I didn't have a big chunk of cash anywhere, so I took a couple of $1 million out of the flow and bought T-bills. Then, a few weeks later, I used the money to buy an annuity. I guess because your trading style is so focused on limiting losses, the first time you felt the need for a safety net was when the market seemed to be saying that a catastrophe could occur and have nothing to do with you. Yes. What happens if you have $10 million in your trading account, but they shut down the game? How do you set goals? Until recently, I set goals on a monetary level. First, I wanted to become a millionaire before I was 30. I did it before I was 25. Then I decided I wanted to make so much a year, and I did that. Originally, the goals were all numbers, but the numbers aren't so important anymore. Now, I want to do some things that are not only profitable, but will also be fun. For example, I'm currently working on setting up a trading company and a software company. I also want to do the family type thing. How do you judge success? I used to judge success as being the best in your field, like Bruce Springsteen in rock music. In my industry, it would have to be dollar-wise. Now, I think it is more quality of life. A lot of people think I'm a success, but I don't feel like I'm a success. I really don't. I feel like I've made a lot of money, and I've been successful at this one area in my life. I help the needy, but I don't have that family fulfillment. How do you judge success? I don't know. All I know is that all the money in the world isn't the answer. You thought it was at one time. Yes, I did. And to be honest, money is important because it is influential. See that guy standing over there? I don't know him from Adam. But say he came over to talk to us. If he made a really bad first impression on me, I might not have much respect for him. But if you then told me that guy is worth $50 million, and he made it on his own, that would completely change my opinion of him. That may not be fair, but that's the way it is. How does trading affect your personal life? I'm able to handle it well from a business standpoint, but from a social standpoint it clobbers me. It doesn't allow me to give the time to women and friends that they require. People like to just sit and talk sometimes. Unless it is about business, like this with you, I'm out of here. Are you always that conscious of time? Yes. Most people aren't. They say, well, don't you ever just sit home and watch TV? Do you? Well, I might have the TV on, but my head is always on trading. Last night I came back from a dinner date at midnight. I was tired and wanted to go to bed, but I was up until 2 a.m. figuring out trades. It's an addiction. 148. Used to be much worse. I got lots of grief from former girlfriends because I would take my work with me on dates. I don't do that anymore, but I'm always still thinking about trading. What makes you different? I think I can do anything, and I'm not afraid of hard work. Right now, for example, I'm working on a deal with a French bank to put together a trading company. I can't wait until this venture starts up, so that I can start working with these kids, training them to be traders. I don't know exactly how much the bank is going to give me, but I could have hundreds of millions to work with. I love that type of challenge. It is important to realize that many of the great traders interviewed in this book were not immediately successful. Saliba's initial trading experience was so disastrous that it brought him to a near-suicidal state of mind. However, what these traders share is a sense of self-confidence and persistence. In the case of early failure, these traits are enough to lead to eventual success. Besides allowing him to make a comeback from his early poor start, Saliba's persistence also came into play at other points in his trading career. For example, many others faced with the type of constant ridicule that Saliba was subjected to in the Teledyne pit might have abandoned their strategy. This same Teledyne example also illustrates another important characteristic of the superior trader, the maintenance of rigid risk control, even in difficult circumstances. It must have been very tempting for Saliba to trade a larger position size in the Teledyne pit when he was being derided as one lot. Instead, he maintained his discipline and continued to trade small until his capital had grown sufficiently to allow him to increase his position size. Working hard and examining many different scenarios so that he is prepared for all contingencies is a critical element of Saliba's success. By anticipating all the what-ifs, he can take advantage of situations such as the October 19th stock slide, instead of being immobilized by such events. For many people, the concept of a great trader conjures up an image of someone using a shoot-from-the-hip approach, moving in and out of markets with great agility and a near sixth sense. The reality is far less glamorous. In the majority of cases, exceptional traders owe their success to hard work and preparation. In fact, similar to Tony Saliba, many of the very successful traders will do their homework every night, not allowing leisure or other business from interfering with their daily regimen of market analysis. When they stray from that discipline, it usually ends up costing them money. In Saliba's own words, referring to a recently missed trade due to his failure to have his orders in while on a business trip, "It cost me 10 grand, and all those little 10 grands can add up." 149. Part V: The Psychology of Trading. 150. Dr. Van K. Tharp: The Psychology of Trading. Dr. Van K. Tharp is a research psychologist who received his Ph.D. from the University of Oklahoma Health Sciences Center in 1975. He has spent his career studying how stress affects human performance. His strongest interest is in the psychology of winning, especially as winning applies to the markets. In 1982, Dr. Tharp developed his investment psychology inventory, a test that measures winning and losing traits. Thousands of investors and speculators, myself included, have taken this test, which includes a written evaluation and a 10-minute phone consultation. Dr. Tharp has written 5 books on successful investing which provide the core of his investment course. He is a contributing editor for technical analysis of stocks and commodities and has also written numerous articles for other financial publications. Dr. Tharp is a frequent guest on financial television and radio programs, and has spoken at many investment conferences. Dr. Tharp currently devotes himself full-time to counseling traders from his office in Glendale, California, and continuing his research on trading success. A recent focus of this research has been interviewing and studying top traders so that he could create a model for success. His basic theory is that by teaching the winning traits of the top traders, not specific trading methodologies, he can dramatically improve the performance of less successful traders and investors. In his most recent project, he is attempting to turn his most successful clients into super traders by extending his normal program of 2 two-day sessions into an ongoing semi-annual process. After I interviewed Dr. Tharp, he asked whether he could do a videotape interview of me as part of his ongoing research. Since I thought such an interview might be helpful in improving my own trading performance, I eagerly agreed. The interview lasted for over 4 hours. Dr. Tharp has a particularly probing questioning style. After an initial response to a question, he would ask, "What else?" and repeat this process several times. When I could no longer think of any additional responses, he would have me shift the direction of my gaze. He later explained this in Structation was intended to facilitate accessing different parts of my brain, and sure enough I would think of another point I had somehow overlooked. I felt that this interview yielded some important personal insights. One of these self-realizations is briefly discussed in the next chapter. I would have liked to provide my personal impression of Dr. Tharp's basic course, which includes 5 books and 4 tapes. However, although I reviewed the material briefly as background for this chapter, the combination of simultaneously working at a full-time job and writing this book did not leave me with enough time or energy to give the course the serious attention it calls for, a personal project I plan for later. I can, however, attest to the fact that one of the traders interviewed in this book served as a subject in Dr. Tharp's project on modeling success and was duly impressed with his intellect and insight into successful trading. How did you first get interested in the connection between psychology and trading? My primary research interest after graduate school was how various drugs affect human performance. After receiving my PhD in psychology, I spent about 8 years doing fairly standard psychological research. For example, I helped standardize the current field sobriety test battery that police throughout the country are still using. While I was doing that, I also learned how to lose money trading options. In fact, I lost money so fast and so consistently that when I finally got out of the market, I had to conclude that the losses had something to do with me. During that same time period, I enrolled in a class in prosperity at the local Church of Religious Science. One of the principles taught in that class is that what happens to you reflects your mindset. I had read a lot on the psychology of trading, and while I considered most of that information to be folklore, I wanted to test it out. I decided to do so by developing my investment psychology inventory, a test to measure investment strengths and weaknesses, as a creative project for that class. No one in the class would take it, so I sent it to R.E. McMaster, the editor of a newsletter to which I was subscribing. McMaster took it and then offered it to his subscribers. Overall, I received close to 1,000 responses, and that really roused my interest in this area as a career. What did you learn in analyzing the responses to your test? Were there any major surprises? I had several measures of success built into the test, so I could rank the responses according to success level. The investment literature suggested 10 different areas that might be important. As a result, I designed questions to measure each of those areas. I did a number of statistical analyses of the data and found a significant correlation between each area and investment success. In addition, I found that those 10 areas could be grouped into 3 major clusters, which I labeled the psychological factor, the management and discipline factor, and the decision-making factor. Although I've since refined the test, I still use the same 3 major clusters. In addition, I still keep the 10 original areas, and I've added an extra one, intuition. What are the 11 areas you measure? Well, the psychological factor has 5 areas. These include a well-rounded personal life, a positive attitude, the motivation to make money, lack of conflict, and responsibility for results. Motivation to make money is not significantly correlated with success, but I keep it in the test because lack of such motivation plus high conflict is very significant. There are 3 factors in the decision-making area. These include a solid knowledge of technical factors in the market, an aptitude for making sound decisions without common biases, and the ability to think independently. Incidentally, knowledge of technical factors has little relationship to success based on the test scores. Also, there are 3 management discipline factors. One needs risk control and the ability to be patient, high. Addition, I also include intuition in this category. Although I have not found any relationship between intuition and trading success, I keep the factor in the test because it is interesting to me. Given those areas, what are the characteristics of the losing trader? The composite profile of a losing trader would be someone who is highly stressed and has little protection from stress, has a negative outlook on life and expects the worst, has a lot of conflict in his/her personality, and blames others when things go wrong. Such a person would not have a set of rules to guide their behavior and would be more likely to be a crowd follower. High addition, losing traders tend to be disorganized and impatient. They want 151. Action now. Most losing traders are not as bad as the composite profile would suggest. They just have part of the losing profile. You now consult with many traders. How did you get started in that? After I started using the test regularly, people began to ask me what to do about their particular problems. Since investment psychology is a rather unique area of study, I found I didn't know how to respond to many of their questions. As a result, I decided to write a pamphlet on each of the 10 areas, both to learn about the areas myself and to provide investors with a source of help. The first pamphlet turned into a book. I decided at that point to cover the subject matter in 5 workbooks, which would constitute a course in the psychology of investing/trading. After I finished the second workbook, I started training in neuro-linguistic programming, NLP. NLP is really a science of how to duplicate success. And I was able to incorporate a number of those techniques into my course. The development of the course naturally led to a private consulting service. Have your ideas and concepts changed from what they were early in your research? I designed the test to predict who could win and who couldn't. Now, I believe that anyone can win if they are committed to do so. Primarily, it's just a matter of learning how. Too many people get stuck by the beliefs they hold, yet they continue to cling to those old beliefs. My beliefs, in contrast, are constantly evolving, and I think it's because I value them according to their utility. Thus, I'm willing to admit most of my beliefs are probably wrong. For example, there may be people who could not be successful in trading even if they were committed to doing so. But right now, it's most useful for me to believe that anyone can win. When I hold that belief, I am much more effective at helping people become winners. Could you provide some specific case examples of people who succeeded or failed in consultation? One trader who came to me hadn't been able to trade for over a year. He wanted me to get him trading before he did the full consultation. As a result, I had him drop by one morning for about 45 minutes. I gathered some information and made an educated guess that he had a conflict problem. He then went through an exercise that took about 10 minutes. It took him 2 weeks to mentally integrate the results of that exercise, but after that he was trading again. He'd spent a lot of money and done a lot of things to correct the problem and none of it had worked. Yet, it only took a 10-minute exercise and 2 weeks of integrating the results to solve his problem. I tried that with another person who was unable to afford my consulting fee, for whom a simple exercise of that nature didn't work. His problem had nothing to do with his investing. Although he was in his late 40s, he was still a little boy in that he couldn't accept adult responsibilities. He still lived with his mother, and his whole lifestyle supported being a child. The only reason he wanted to trade was to be able to continue that lifestyle. I doubt that I could have helped him without a major commitment on his part to change his lifestyle, which he was unwilling to give. Another client made minor adjustments after 2 days of consulting. He was reluctant to do the follow-up because he thought it would probably be superfluous. But he eventually decided to do it. I spent another 2 days listening to him talk, and then we did a simple exercise together. At the end of that exercise, he was a totally changed person, although it probably took him a week to integrate the effects of that exercise. He called me 2 months later and said he had made over $650,000 trading in the markets. In the case of a trader who uses a non-quantifiable approach, for example, I buy or sell whenever I get a feeling about the market's impending direction from the chart patterns. How do you distinguish whether trading problems are related to lack of skill or to psychological impediments to success? Before I take someone on as a client, I need to know that they have some sort of methodology that they think works. I determine what evidence they have of that. Can they, for example, convince me? Have they tested that methodology? Does their testing amount to a hindsight evaluation? Or is it based on actual trading signals that one can follow? I also am convinced that it is difficult to make money day trading or trading in a short time frame, so I am skeptical about anyone who wants me to help them day trade successfully. At the same time, I think that lack of skill is, in itself, a psychological impediment to trading. People don't develop a systematic approach or don't test their approach because of poor judgment, lack of goals, internal conflict, etc. So, perhaps the area they need help in is overcoming internal resistance to developing a systematic approach to the market. If somebody came to me and said that was the problem they wanted help with, I would have no problem at all accepting that person as a client. What are the primary psychological impediments that keep most people from being winning traders? How can they deal with each of those problems? What typically happens is that when people approach the markets, they bring their personal problems with them. The markets are a natural place to act out those problems, but not to solve them. Most people end up leaving the markets, but a few decide that they need a system to trade more effectively. Those people who do adopt a systems approach usually just end up transferring their problems from dealing with the market to dealing with their system of trading. One of the basic problems that most traders face is dealing with risk. For example, two primary rules to successful speculative trading are: cut your losses short and let your profits run. Most people cannot deal with those two rules. For example, if making money is important to you, as it is to most people who play investment games, then you will probably have trouble taking small losses. As a result, small losses turn into moderate losses, which are even harder to take. Finally, the moderate losses turn into big losses, which you are forced to take, all because it was so hard to take a small loss. Similarly, when people have a profit, they want to take it right away. They think, "I'd better take this now before it gets away." The bigger the profit becomes, the harder it is to resist the temptation to take it now. The simple truth is that most people are risk-aversive in the realm of profits. They prefer a sure, smaller gain to a wise gamble for a larger gain, and risk-seeking in the realm of losses. They prefer an unwise gamble to a sure loss. As a result, most people tend to do the opposite of what is required for success. They cut their profits short. 152. And let their losses run. If you think of trading as a game and that a mistake is not following the rules of the game, then it becomes much easier to follow these two rules. You should review your rules at the beginning of the day and review your trading at the end of the day. If you followed your rules, even if you lost money, pat yourself on the back. If you didn't follow your rules, then mentally rehearse what you did and give yourself more appropriate choices in the future. The second major problem people have is dealing with stress. Stress really takes two forms: worry and the biological fight/flight response. Our brains have a limited capacity for processing information. If your mind is preoccupied with worry, that worry takes up most of the decision space, and you don't have enough capacity left to perform effectively. One aspect of the fight/flight response is that it causes people to narrow their focus. They revert to earlier, well-practiced response patterns. For example, a common decision that people make under stress is not to decide. They do what they did when they were a beginner. They do what their broker advises. In short, they do anything. Simple solutions are rarely correct. When people are stressed, they also tend to be crowd followers. The behavior of others provides a simple example to follow. Crowd followers don't have to make decisions, but crowd following is a sure way to lose money in the markets. A second important effect of the fight/flight response is that it causes people to expend more energy. When this part kicked in to make sure that he would not become too successful. He was the one who made $650,000 in about 2 months after we had completed the parts negotiation. Are you implying that some people actually want to lose on a subconscious level because it fulfills some other positive intention? How common is that? Half the traders I work with have problems of this nature. I think it's very common. So far, you've cited poor risk attitudes, stress, and conflict as impediments to trading success. Are there any other major problems people have with the markets? A fourth major problem is that many people allow their emotions to control their trading. In fact, most trading problems appear to involve emotional control in some manner. I know of at least 10 methods of helping people control their mental states. An easy method that people can adopt right away is simply to control posture, breathing, and muscle tension. If you change those factors, you will probably find that you change your emotional state. Finally, the last major problem is making decisions. Although there are many facets to decision-making Problems: what most people do is bring their normal method of making decisions to trading the markets. 4. Example: think about what you go through in order to buy a new car. You have to think about the model, make, deal, service, cost, accessories, etc. And it probably takes you a week or more to evaluate those factors and make a decision. Most people bring that same method of making decisions to trading and it just doesn't work. It takes too much time. So, the solution is to adopt a trading system that gives you signals to act. But most people with a trading system continue to apply their normal method of making decisions to the signals given to them by their trading system. And, of course, that doesn't work. The best method that I've found of dealing with long, ineffective decision making problems is to short-circuit them through a process called anchoring. That process is a little too involved to explain here. Do you believe that most people can be successful traders if they learn to eliminate negative emotions? Well, that assumes that negative emotions are the cause of trading problems. I think they are just a symptom of the basic problem. In most cases, I don't believe it's even necessary to solve specific problems to produce success. 153. You simply have to teach people to do things in an effective manner. The teaching process, however, involves working with how people think, and most trainers do not emphasize that. Right now, I consider myself to be an expert modeler. By that, I mean that if someone can do something well, then I can figure out how they do it and teach those skills to anyone else. I'm concentrating on modeling trading and investment excellence. So naturally, I believe that I can teach anyone who is committed to being a successful trader to be one of the best. Are superior traders better because of keener analytical skills, or because they have better emotional control? Better emotional control, but I think that both of those factors are overemphasized. So what does it take to duplicate successful trading? There are 3 primary factors involved in duplicating success: beliefs, mental states, and mental strategies. If you duplicate the way the best traders use those 3 factors for every aspect of the trading task, then you can duplicate their results. As a non-trading example, most martial arts experts believe that it takes years of practice to break a board with your bare hand. I was able to observe someone for about 15 minutes and then break 2K-inch pine boards with my hand. I even showed my son, who was 10 at the time, how to do it. That's the power behind modeling. What happens with most experts is that they are unconsciously competent. They do things well, which means they do them automatically. For example, most people are unconsciously competent at driving a car. You don't even think about it when you do it. When someone who is unconsciously competent tries to explain what he or she is doing to someone else, much of what is important is left out. Thus, my focus is to discover the missing pieces and help people install those pieces. Let's talk about the first factor, beliefs. How are beliefs important to trading success? Let me give you an example from another modeling project. The Army modeled the rifle skills of the 2 best sharpshooters in the U.S. They were then able to develop a training class for Army recruits in which they reduced the training time from 4 to 2 days, while increasing the qualification rate from 80 to 100%. In addition, they were able to use the same knowledge to help the top shooters improve their skills. The information they gathered about shooting beliefs was particularly revealing. The 2 top shooters, for example, believed shooting well is important for my survival. Hunting is fun. Mental rehearsal is important to successful performance. If I miss a shot, it has something to do with my performance. One of the 2 top shooters, when they were in competition together, always won. And you could tell the difference between the 2 in accordance with their beliefs. For example, the best shooter believed that it was important to rehearse an entire 1,000-round match the prior evening, whereas the second best shooter only believed That mental rehearsal was important. In addition, the best shooter believed that it was important to hit the center of the bullseye on each shot, even though you didn't get extra points for that, whereas the second best shooter believed that it was only important to hit the bullseye. Can you understand why one was better than the other just from their beliefs? Now, contrast the beliefs of top shooters with the beliefs of new recruits coming into the army. The latter might believe guns are evil, they kill people. If they shoot this weapon too many times, they might go deaf. If they miss the target, it means the gun is misaligned. I think, just on beliefs alone, you can begin to understand why the top shooters were so much better than the raw recruits. Now, let me explain some of my findings in working with top traders. You might find some of these beliefs confirmed in other interviews in your book. Generally, I find that top traders believe money is not important. It is okay to lose in the markets. Trading is a game. Mental rehearsal is important for success. They've won the game before they start. Although there are a lot more than 5 critical beliefs, I think these 5 are among the most important. Most people approach trading to make a lot of money, and that is one of the primary reasons they lose. Because money is so important, they have trouble taking losses and letting profits run. In contrast, when you think of trading as a game and play by certain rules, then it becomes much easier to follow those 2 golden rules. In addition, because of mental rehearsal and extensive planning, top traders have already gone through all the trial and error in their mind before they begin. As a result, they know they are going to win in the long run, and that makes the little setbacks much easier to deal with. You mentioned that winners know they've won the game before they start. Although I can easily see how such confidence would be beneficial for the established winning trader, might the impact of this trade actually be reversed for the novice trader? For example, in your first week on skis, confidence about your ability to go down the expert slope might not be such a great quality. How does the less expert trader distinguish between justified and misplaced confidence? The top traders that I've worked with began their careers with an extensive study of the markets. They developed and refined models of how to trade. They mentally rehearsed what they wanted to do extensively until they had the belief that they would win. At this point, they had both the confidence and the commitment necessary to 154 produce success. In addition, they also had the entire constellation of beliefs I just described. As a result, I believe that there are 3 major differences between justified confidence and misplaced confidence. First of all, justified confidence comes from a constellation of beliefs, such as the one I just described. If a trader has confidence and nothing else, he is probably in a lot of trouble. Second, justified confidence comes from extensive testing of some sort of model of trading. If you don't have a model that you have properly tested, then your confidence is probably misplaced. Third, justified confidence comes with an extensive commitment to being successful as a trader. Most people who want to be traders are not committed, they just think they are. There is a poem by W.N. Murray, of the Scottish Himalayan expedition, that says that the moment that one definitely commits oneself, then providence moves too. If you are really committed, then not only are you certain that you are doing the right thing, but somehow events just seem to occur to help you. If you are really committed to being a trader, then you probably have an understanding at some level of what I'm talking about. You probably even understand that those events that help you might be big losses. If you are not committed, on the other hand, then you are probably saying, I don't understand what Tharp is saying. I'm committed, but events certainly have not been helping me. Earlier, you mentioned mental states as the second critical factor in modeling success. Could you explain what you mean by that? If you ask people to list their trading or investment problems, they are of 2 types: problems they don't own and mental state control problems. Problems they don't own consist of blaming the markets, blaming floor traders or locals, blaming insider trading, blaming their broker, or blaming their system for what goes wrong. We have a natural tendency to blame something other than ourselves for what happens. Society promotes it. For example, the recent media coverage of program trading virtually implies that investors who lost money in the stock market did so because of this activity rather than because of any fault of their own. Yet, when you blame something other than yourself, you can continue to repeat the mistake because it was the result of something beyond your control. The best thing an investor can do, when things go wrong, is to determine how he or she produced those results. Now, I don't mean that you should blame yourself for your mistakes either. I mean that at some point in time, for any situation, you made a choice that produced those results. Determine what that choice point was and give yourself other options to take when you encounter a similar choice point in the future. Change the decision at similar choice points in the future and you will change the results you get. And by imagining doing so now, you can make it easy to select those alternatives in the future. When people own their own problems, they discover that their results usually stem from some sort of mental state. Common examples are: I'm too impatient with the markets. I get angry at the markets. I'm afraid at the wrong time. I'm too optimistic about what will happen. These are just a few examples of mental state problems. Once you identify a mental state problem, you can do something about it because this sort of problem is within your control. I've already mentioned how one can use body posture, breathing, and muscle control to manipulate one's mental state. To try this out for yourself, go into a shopping mall and notice how other people walk. Duplicate a dozen or so walks for yourself and notice how your mental state changes with each one. I'm not saying that controlling your mental state is the magic solution to trading success. It's just part of the answer. But when you admit that the answer is within yourself, you've come a long way. The realization that you are responsible for the results you get is the key to successful investing. Winners know they are responsible for their results, losers think they are not. Can you give a practical example of how someone can control their mental state? Well, mental state manipulation is what most people call discipline. I teach people a very simple procedure that they can use right away. For example, suppose you are at your desk and you become aware that you are in a mental state that you would like to change. Get up out of the chair. Walk away about 4 feet and then look at how you looked in that chair. Notice your posture, your breathing, your facial expressions. Then imagine how you would look if you had the sort of mental state you would like. When you can see that clearly, sit down in the chair again and assume the position that you just imagined. That exercise works for almost any situation as it involves several important principles: changing your body posture, seeing yourself from a more objective viewpoint, and imagining a more resourceful state. Please elaborate on mental strategies, the third element you cited earlier as critical to duplicating success. Could you provide some examples? To understand strategies, you have to understand how people think. People think in the same modalities as their 5 senses, that is, in terms of visual images, sounds, feelings, and for some people, tastes and smells. Those 5 modalities are to mental strategies as the alphabet is to a great novel, or as musical notes are to a great symphony. It's not the elements, but the way in which the elements are put together. A mental strategy is really the sequence in which you think. Rather than explain a complex topic in detail, which I think is beyond the scope of this interview, let me give you 2 examples. First, imagine that you have a trading system that gives you specific signals. Since most signals are visual, such as a particular chart pattern or certain signals on your computer, imagine that your system gives you visual signals. Now, try on the following strategy. See the signal. Recognize that it is familiar. Tell yourself what might go wrong if you take it. Feel bad about it. 155. Could you trade effectively using that strategy? Would you even take the signal? Probably not. What if you used the following strategy? See the signal. Recognize that it is familiar. Feel good about it. Could you trade from that signal? Probably. So even though the two strategies are quite similar, they lead to very different results in terms of trading. If you are trading a system, you need a simple strategy like the last one in order to use it effectively. Two of the top traders that you used in your research and modeling success have completely different trading styles. One is very mechanical, while the other uses a much more intuitive approach. Could you contrast their differences and compare their similarities? First, let me talk about their similarities, because they are extensive. In fact, when you find extensive similarities between two excellent traders who seem so different, then you can begin to assume that those similarities are essential to successful trading. Both traders, for example, developed models for how the markets work and did extensive research to test those models. Although their ideas are very different, I think the process of developing and testing some sort of model is probably very important. In addition, both traders share all the same beliefs that I mentioned earlier as common to successful traders. Third, both traders are very aware of their purpose in life and as a trader, they believe they are part of a bigger picture and they just go with the flow. The mechanical trader is very logical. He constructs his models visually in his imagination. He is very precise in his language and thinking. His models tend to focus on his concept of how to trade successfully and of how the economy works. He does not believe that his models are adequate until they can be converted into algorithms for the computer that match his own mental processes. As a result of this belief, he has computerized his models, modifying both his constructed image and his computer output, until both models match, in his words, until they both look right. This is a very slow and laborious process. I think it hinders his decision-making on everyday events, and he tends to agree with me, but it helps him in the long run. When his mental image and the computer model match, he virtually takes himself out of the trading picture. The computer does everything, so at that point, decision-making is easy for him. The intuitive trader, in contrast, has developed a model of how he thinks markets operate, rather than a model of how to trade successfully. He also believes that the markets are constantly evolving and that it is more important to keep up with changes in the market than to test his models by developing an algorithm to computerize them. He trades from his expectations of what the markets will do, which are visualizations. But I think that he tends to convert his visualizations into feelings. Feelings actually are a mode of thinking, but they are difficult to communicate to others or to computerize. As a result, he believes that exercises such as computerizing a trading system are a waste of time. Remember that his main emphasis is to explain how markets work, rather than how to trade, and he believes that the markets are constantly evolving. As a result, he has difficulty explaining how he trades to anyone else. He just calls it intuitive. At the same time, he makes day-to-day decisions easily, a distinct contrast to the mechanical trader who is uncomfortable until he has proven his work by computerizing it. What are the most difficult problems to solve? I think there are only two difficult problems. One is lack of commitment to trading. People are not going to do what I tell them to do unless they are committed to becoming a good trader, so I don't see many non-committed traders. It's only occasionally, when I do a free or reduced rate consultation, that I see traders with this sort of problem. The man who wanted to remain a little boy, and was trying to use trading as a means of accomplishing that, was a classic example. I don't make the mistake of seeing non-committed traders too often. The second most difficult situation is the trader who does not own his problems. This person can continue to repeat his problems because he never gets at the source. Once again, I usually don't see these people. When people come to me, they realize that they produce their own problems, although, to some extent, everyone has problems that they don't own, even my clients. Among the people who come to see me, I think the most difficult type is the compulsive gambler. Since these people typically crave the action of the markets, they are not likely to want my help until they are heavily into debt. At that point, I refer them to Gamblers Anonymous or to some local source for help. However, I have had one compulsive trader among my clients. He's now in my Super Trader program. I've simply channeled his compulsiveness from the markets into working on himself. I'm not sure that correcting trading problems is always the answer though. For example, one approach to teaching a class on trading would be to give everyone the fundamentals in the first session and a simple trading system in the second. You could then spend the remaining sessions dealing with their problems trading that system. That would probably be a very effective class. On the other hand, you could conduct the same class by giving them the fundamentals. Then you might give them the beliefs, mental states, and mental strategies necessary to trade the system. Finally, you might give them the system. I'm willing to bet that the second method would be more effective than the first. At least that is the direction I'm heading. Talk about the origins, concepts, and direction of your Super Trader program. It all began on Christmas Eve one year, when that one trader called and told me that he had made $650,000 in the 2 months since I had finished working with him. In a sense, I felt that we had only started working together. The more I thought about it, the more the question kept popping into my mind: what if we pushed this to the limits? What is he capable of accomplishing? So the idea of the Super Trader program was born from those thoughts. I called him up and suggested the idea to him. Naturally, he was all for it. About 4 of my clients have now graduated to the Super Trader program. It simply means that I continue to work with these people on a regular basis, usually semi-annually. The idea is to stretch their performance to the limits. Many people aren't ready for that, but I have enough among my clients who are. Who knows, in 3 or 4, 156 years, I might just have about 50 top traders that I work with on a continual basis. Incidentally, I find that my best clients now make excellent models to use to study top traders. I sometimes have dreams which involve impending market direction. Although these are rather infrequent, they prove right a high percentage of the time. Is this unusual? I imagine that it's quite common because people tell me that all the time, especially top traders. For example, both the mechanical and intuitive super traders that we talked about earlier expressed that they had dreams about the market that were amazingly accurate. But most traders say that such dreams are infrequent enough so that they could not trade on them regularly. This phenomenon may even occur more frequently than one might imagine, in symbolic form. But most people do not bother to interpret their dreams, so they miss the symbolic predictions. However, I must admit that although it interests me, I have not investigated this area very extensively. I know of lots of people of genius level who claim that some of their creativity comes from their dreams. Michael Jackson claims he doesn't write his songs, they just come to him. Paul McCartney said that he heard the song yesterday in a dream. Einstein essentially dreamed the theory of relativity. I think there are probably a lot of famous examples of this sort. It all boils down to what intuition really is, but don't ask me to explain it. I don't understand it, yet. I assume that the reason you have not tried trading again is that you perceive that it would interfere with your objectivity in dealing with your clients. Yet, given all that you have learned about successful trading during the past 5 years, I imagine there must be some temptation to try it again. How do you handle this conflict? What do you envision as the long-term resolution? There are two reasons I don't trade. The first is the reason you mentioned about objectivity with clients. If I'm helping someone trade and I have conflicting positions, then I may not be very objective about what they are doing. An equally important reason, however, is that I am fully committed to doing what I am doing. I love helping other people, writing, giving talks, and so on. I'm very happy doing that. It is also a 60-hour per week job right now. If I wanted to start trading, then I would have to devote almost as much time to doing that, at least at the beginning. Why should I do that and give up what I already know I love doing? Player coaches, in the history of most sports, usually are not that effective at either coaching or playing. Your question also assumes that I am committed to trade, and as a result there is a conflict. Actually, I find that as I get more and more into helping others become successful, I have less and less interest in trading myself. I'm investing in myself and in my business right now. I constantly work at improving my skills and knowledge, and that is paying off for me. Why should I dilute that effort? Perhaps sometime in the future, I will decide that I have done everything I can do, or perhaps I'll want to change what I'm doing, or perhaps I'll just want a break. For example, 3 to 4 years from now I might just be working with 50 or more top quality traders. If that happens, then maybe I'll also trade. But for the near future, it doesn't seem very likely. 157. The Trade a Personal Experience. In the course of conducting the interviews for this book, I came to realize that one of my primary motives for the entire project was a quest for self-discovery. Although I have been a net profitable trader over the years, substantially multiplying a small initial stake on 2 separate occasions, I had a definite sense of failure about my trading. Given the extent of my knowledge and experience about markets and trading, as well as the fact that on numerous occasions I had correctly anticipated major price moves, I felt that my winnings were small potatoes compared to what I should have made. In one of my trips for this book, on one evening, I was interviewed at length about my trading by Dr. Van Tharp, and the very next evening, I had a probing conversation about my trading with the very perceptive Ed Seykota. This back-to-back experience caused me to focus intensely on the flaws that had prevented me from reaching what I perceived to be my true potential as a trader. As a result of this self-examination, I came to realize that one of my great errors had been failing to exploit major price moves that I had correctly anticipated. Invariably, my initial position would be far too small, given the potential I perceived in such trades. This mistake was then compounded by a highly premature liquidation of the position. Typically, I would take profits on the first leg of the price move, with the intention of re-entering the position on a correction. The problem was that subsequent corrections usually fell short of my re-entry points and, refusing to chase the market, I ended up watching the rest of the price move unfold while I was on the sidelines. I vowed to myself that the next time such a situation would arise, I would make a concentrated effort to come closer to realizing the true potential of the trade. I did not have to wait very long. 2 weeks later, while on a plane to Chicago to conduct some further interviews, I was thinking about my review of the price charts the previous evening. I recalled that I had come away with the distinct impression that precious metal prices were ready to move higher, even though the foreign currency markets appeared vulnerable to further price erosion. Suddenly, the trade I should have made became crystal clear. Given my combination of expectations, a trade of long precious metals and short foreign currencies would be particularly attractive. Since these markets normally move in the same direction, the combined position implied less risk than an outright long position in precious metals. I made a mental note to generate some charts on this trade at my first opportunity. The next morning, I found a quote machine capable of generating price charts and sat down to evaluate various price relationships. First, I looked at the interrelationships between silver, gold, and platinum and decided that silver was my preferred buy among the metals. Then I reviewed the interrelationships between the various foreign currencies and decided that the Swiss franc appeared to be the weakest currency. Having made these two determinations, I then reviewed charts of the silver/Swiss franc ratio for various time spectrums, ranging from 10 years to 1 month. This analysis led me to the conclusion that we were at the brink of a possible multi-year advance of silver relative to the Swiss franc. Although I had intended not to trade because my traveling prevented me from paying attention to the markets, the potential of the trade seemed so dynamic that I had to put on at least a base position. To be done properly, a ratio trade requires approximately equal dollar positions in each market. I quickly calculated that at the prevailing price levels, it would require approximately 3 long silver contracts to balance 1 short Swiss franc contract. I looked at a short-term chart of the silver/Swiss franc price ratio. To my dismay, the price ratio had already moved sharply in the direction of my intended trade since my realization about it the previous morning. Even on that morning's opening, the trade could have been implemented at much more favorable price levels. As I was trying to decide what to do, the silver/Swiss franc ratio continued to move higher and higher. I decided that I had to act to prevent the possibility of missing this trade altogether. I immediately called in an order establishing the minimum position of long 3 silver contracts and short 1 Swiss franc contract. No sooner had I placed the order than the price ratio seemed to reach its peak and began retreating. The ratio pulled back further during the next 2 days. As it turned out, I had managed to implement the trade at the exact worst possible moment in time since the inception of my idea. However, the silver/Swiss franc price ratio quickly recovered, and a few days later I was well ahead. At this point, I thought about my recent realization regarding my continued failure to adequately profit from major price moves. I decided to maintain my position and, moreover, selected a reaction point for doubling up the position. The correction came about a week later and I followed my game plan. My timing proved good, as the trade once again rebounded in my favor, this time with double the initial position. Given my account size, approximately $70,000 at the time, the long 6 silver/short 2 Swiss franc position was about twice as large as the one I normally would have held. My efforts to correct my aforementioned trading flaw seemed to be paying off, as the trade raced in my favor during the following 2 weeks. Within a month of putting on the trade, my account was up over 30%. I now faced a dilemma. On the one hand, my newfound realization suggested that I hang on to the trade for the long run. On the other hand, one of my other rals is that if you are ever lucky enough to realize a very large profit on a trade very quickly, take it, because you will usually get an opportunity to re-enter the trade at considerably more favorable levels. The second ral came to mind when the silver/Swiss franc price ratio began falling. A cursory examination of the price charts suggested it might be prudent to take at least partial profits. I should have done more analysis to reach a decision. However, the combination of having undertaken a new job while at the same time writing this book left me with very little time and energy to focus on other areas, trading included. Instead of doing the necessary work, I made a snap judgment to stay with the trade. The trade now moved swiftly against me, and within a week, I had given back a significant portion of my earlier gains. Although a week earlier, I had rationalized that my substantial profits would give me enough of a comfort cushion in the event of a reaction. Now that such a reaction had occurred, I found that I had seriously misjudged my comfort level. Suddenly, I was concerned that I might give back all my profits, and possibly even ride the trade into a 158 loss. I could not decide whether to blow out of the trade or stay with it as initially planned. That night I had a dream. I was talking to a friend of mine, who is a developer of software for the analysis of futures and options markets, but not a trader. In my dream, he had begun trading. We were talking about trading. And my current dilemma regarding the silver/Swiss franc position. My friend commented on my predicament. Everybody gets what they want out of the markets. I replied. You sound just like Ed Seykota. This sounded a bit odd to me, since as far as I knew, he did not even know Seykota. To my surprise, he answered, I have been talking to Ed Seykota for a while and I have been winning in my trading ever since. He had a sheet in front of him, with one of the columns indicating his month-to-month ending equity. I glanced at the sheet and was astounded to see that the last figure exceeded $18 million. I exclaimed, Bert, you have made $18 million in the market. I hope you plan to take a few million out for safekeeping. No, I need all the money. For trading, he replied. But that is crazy, I said. Take $3 or $4 million out, and that way you will be sure then that no matter what happens, you will come out way ahead. I know what I am doing, and as long as I do my homework on the markets every day, I am not concerned, he replied. His answer had implied, quite correctly, that I did not diligently do my homework on the markets every day. His point, although unstated, was quite clear. If I did my work on the markets every day, I wouldn't have any trouble understanding why he did not need to pull out several $1,000,000 in profits from his account to feel confident that he would not lose back all his profits in trading. You say you don't have enough time each day to do your work on the markets. You are too busy with your new job and writing your book. Here, let me show you something. He started citing assumptions regarding the sales of my book, royalties per copy sold, and the total hours I had spent writing the book. He then scribbled various calculations on a yellow pad. He arrived at a final figure of $18.50 per hour. Here, he said, this is what you are making on your book. The tone of his voice implied that I was crazy to jeopardize tens of thousands of dollars in my trading for such a paltry sum. Actually, the $18.50 estimate is probably wildly overinflated, but remember this was a dream. It was no coincidence that this dream occurred the night after editing the section of the Marty Schwartz interview dealing with his diligence in doing his daily homework on the markets. I realized that there are no shortcuts. If you want to be a good trader, you have to do your work on the markets every day. If there is not enough time, you have to make time. The costs for straying from this daily discipline, in terms of lost profit opportunities as well as losses, can be very substantial. The message my subconscious seemed to be crying out was, if you are going to be serious about trading, you have to re-establish your time priorities. 159. 160. Postscript Dreams and Trading. The relationship between dreams and trading is a fascinating subject. Readers may look up Seykota's and Tharp's comments on this matter. There was another interview in which this topic was prominently discussed. In that instance, the trader decided to rescind his approval for use of our conversation in the book. I was somewhat puzzled by his decision, since the chapter was basically complimentary. What could you possibly have found so offensive as to back out completely? I asked. Absolutely nothing, he replied. In fact, you made me sound almost human. It turned out that he was upset about his inclusion in a recently published book and that he was adamantly opposed to his appearance in any book. Even the offer of anonymity failed to change his decision. I did, however, manage to get his permission to use the dream-related portion of the interview. The name references in the following conversation have been changed. In 1980, the year when corn set its record high, I was long the position limit. One night I had the following dream. I'm talking to myself and I say, hey Jerry, where is corn going to? To $4.15. Where is corn now? $4.07. You mean you are taking all that risk for an extra 8 cents? Are you crazy? I woke up in a flash. I knew. I had to get out of my entire corn position as soon as the market opened the next day. The next morning, the market opened up a little higher, and I started selling. The market moved a little higher, and I sold more heavily. The market moved up some more. For a minute, I thought the floor broker had executed my order backwards. He hadn't. Anyway, a few minutes later, I'm completely out of my position and the phone rings. It's my friend Carl. Another good trader, who had also been long corn. He says, "Jerry, is that you doing all the selling?" I tell him, "Yes, I just got out of my entire position." "What are you doing?" he shouts. I say, "Carl, where is corn going to?" "About $4.15-4.20, he replies. "Where is corn now?" I ask him. I hear an immediate click over the phone. He didn't even waste any time saying goodbye. And was that the top of the corn market? It might have gone up another day, but that was just about the high. Once it started falling, I could never have unloaded a position of my size. I found this trader's narration of his dream particularly fascinating, since I have occasionally had similar experiences. Usually, I have found that when you feel strongly enough about a trade, either getting in or getting out, to dream about it, the message should be heeded. Of course, like anything else, this does not work all the time, but I believe it places the odds more in your favor. As I interpret it, the dream is the means by which our subconscious penetrates the barriers we sometimes erect in accepting the true analysis of a market. For example, if I am bullish and not in a market, I might rationalize that it is prudent to wait for a reaction before entering the trade, even if a realistic assessment would suggest that such a development is unlikely. This is because entering the market at a higher price is a confirmation that, to some extent, I have already failed, that is, by not buying sooner, a distasteful acknowledgement. In such a case, a dream that the market was going to run away on the upside might be the subconscious way of breaking through mental impediments. 161. Final word. There is no holy grail to trading success. The methodologies employed by the market wizards cover the entire spectrum from purely technical to purely fundamental, and everything in between. The length of time they typically hold a trade ranges from minutes to years. Although the styles of the traders are very different, many common denominators were evident. 1. All those interviewed had a driving desire to become successful traders, in many cases, overcoming significant obstacles to reach their goal. 2. All reflected confidence that they could continue to win over the long run. Almost invariably, they considered their own trading as the best and safest investment for their money. 3. Each trader had found a methodology that worked for him and remained true to that approach. It is significant that discipline was the word most frequently mentioned. 4. The top traders take their trading very seriously, most devote a substantial amount of their waking hours to market analysis and trading strategy. 5. Rigid risk control is one of the key elements in the trading strategy of virtually all those interviewed. 6. In a variety of ways, many of the traders stressed the importance of having the patience to wait for the right trading opportunity to present itself. 7. The importance of acting independent of the crowd was a frequently emphasized point. 8. All the top traders understand that losing is part of the game. 9. They all love what they are doing. 162. Appendix 1. Program Trading and Portfolio Insurance. One subject that has received widespread publicity in recent years is program trading. Perhaps never in the history of financial markets has there been more criticism about a trading approach that was less understood. I would venture a guess that less than 1 out of 10 people opposed to program trading even know the definition of the Term. One source of confusion is that program trading is used interchangeably to describe both the original activity and as a more general term encompassing various computer-supported trading strategies, for example, portfolio insurance. Program trading represents a classic arbitrage activity in which one market is bought against an equal short sale in a closely related market in order to realize small, near risk-free profits, resulting from short-lived distortions in the price relationship between such markets. Program traders buy or sell an actual basket of stocks against an equal dollar value position in stock index futures when they perceive the actual stocks to be underpriced or overpriced relative to futures. In effect, program trading tends to keep actual stock and stock index futures prices in line, insofar as every program-related sale of actual stocks is offset by a purchase at another time, and most program trades are first initiated as long stock/short futures positions, because of the uptick requirement in shorting actual stocks. Arguments that program trading is responsible for stock market declines are highly tenuous. Moreover, since the bulk of economic evidence indicates that arbitrage between related markets tends to reduce volatility, the relationship between increased volatility and program trading is questionable at best. Portfolio insurance refers to the systematic sale of stock index futures as the value of a stock portfolio declines in order to reduce risk exposure. Once reduced, the net long exposure is increased back toward a full position as the representative stock index price increases. The theory underlying portfolio insurance presumes that market prices move smoothly. When prices witness an abrupt, huge move, the results of the strategy may differ substantially from the theory. This occurred on October 19, 1987, when prices gapped beyond threshold portfolio insurance sell levels, triggering an avalanche of sell orders which were executed far below the theoretical levels. Although portfolio insurance may have accelerated the decline on October 19, it could reasonably be argued that the underlying forces would have resulted in a similar price decline over a greater span of days in the absence of portfolio insurance. This is a question that can never be answered. It is doubtful that program trading, as defined above, played much of a role in the crash of the week of October 19, since the severely delayed openings of individual stocks, tremendous confusion related to prevailing price levels, and exchange restrictions regarding the use of the automated order entry systems severely impeded this activity. 163. Appendix 2 Options, Understanding the Basics ***. There are two basic types of options, calls and puts. The purchase of a call option provides the buyer with the right, but not the obligation, to purchase the underlying item at a specified price, called the strike or exercise price, at any time up to and including the expiration date. A put option provides the buyer with the right, but not the obligation, to sell the underlying item at the strike price at any time prior to expiration. Note, therefore, that buying a put is a bearish trade, while selling a put is a bullish trade. The price of an option is called a premium. As an example of an option, an IBM April 130 call gives the purchaser the right to buy 100 shares of IBM at $130 per share at any time during the life of the option. The buyer of a call seeks to profit from an anticipated price rise by locking in a specified purchase price. The call buyer's maximum possible loss will be equal to the dollar amount of the premium paid for the option. This maximum loss would occur on an option held until expiration if the strike price was above the prevailing market price. For example, if IBM was trading at $125 when the 130 option expired, the option would expire worthless. If at expiration, the price of the underlying market was above the strike price, the option would have some value and would hence be exercised. However, if the difference between the market price and the strike price was less than the premium paid for the option, the net result of the trade would still be a loss. In order for a call buyer to realize a net profit, the difference between the market price and the strike price would have to exceed the premium paid when the call was purchased, after adjusting for commission cost. The higher the market price, the greater the resulting profit. The buyer of a put seeks to profit from an anticipated price decline by locking in a sales price. Like the call buyer, his maximum possible loss is limited to the dollar amount of the premium paid for the option. In the case of a put held until expiration, the trade would show a net profit if the strike price exceeded the market price by an amount greater than the premium of the put at purchase, after adjusting for commission cost. Whereas the buyer of a call or put has limited risk and unlimited potential gain, the reverse is true for the seller. The option seller, often called the writer, receives the dollar value of the premium in return for undertaking the obligation to assume an opposite position at the strike price if an option is exercised. For example, if a call is exercised, the seller must assume a short position in the underlying market at the strike price, since by exercising the call, the buyer assumes a long position at that price. The seller of a call seeks to profit from an anticipated sideways to modestly declining market. In such a situation, the premium earned by selling a call provides the most attractive trading opportunity. However, if the trader expected a large price decline, he would usually be better off going short the underlying market or buying a put, trades with open-ended profit potential. In a similar fashion, the seller of a put seeks to profit from an anticipated sideways to modestly rising market. Some novices have trouble understanding why a trader would not always prefer the buy side of the option, call or put, depending on market opinion, since such a trade has unlimited potential and limited risk. Such confusion reflects the failure to take probability into account. Although the option seller's theoretical risk is unlimited, the price levels that have the greatest probability of occurrence, i.e., prices in the vicinity of the market price when the option trade occurs, would result in a net gain to the option seller. Roughly speaking, the option buyer accepts a large probability of a small loss in return for a small probability of a large gain, whereas the option seller accepts a small probability of a large loss in exchange for a large probability of a small gain. In an efficient market, neither the consistent option buyer nor the consistent option seller should have any significant advantage over the long run. The option premium consists of two components, intrinsic value plus time value. The intrinsic value of a call option is the amount by which the current market price is above the strike price. The intrinsic value of a put option is the amount by which the current market price is below the strike price. In effect, the intrinsic value is that part of the premium that could be realized if the option were exercised at the current market price. The intrinsic value serves as a floor price for an option. Why? Because if the premium were less than the intrinsic value, a trader could buy and exercise the option and immediately offset the resulting market position, thereby realizing a net gain, assuming that the trader covers at least transaction costs. Options that have intrinsic value, i.e., calls with strike prices below the market price and puts with strike prices above the market price, are said to be in the money. Options that have no intrinsic value are called out of the money options. Options with a strike price closest to the market price are called at the money options. An out of the money option, which by definition has an intrinsic value equal to zero, will still have some value, because of the possibility that the market price will move beyond the strike price prior to the expiration date. An in the money option will have a value greater than the intrinsic value because a position in the option will be preferred to a position in the underlying market. Why? Because both the option and the market position will gain equally in the event of a favorable price movement, but the option's maximum loss is limited. The portion of the premium that exceeds the intrinsic value is called the time value. The three most important factors that influence an option's time value are 1. Relationship between the strike and market price. Deeply out of the money options will have little time value since it is unlikely that the market price will move to the strike price, or beyond, prior to expiration. Deeply in. The money options have little time value, because these options offer positions very similar to the underlying market. Both will gain and lose equivalent amounts for all but an extremely adverse price move. In other words, for a deeply in the money option, the fact that risk is limited is not worth very much, because the strike price is so far from the prevailing market price. 2. Time remaining until expiration. The more time remaining until expiration, the greater the value of the option. This is true because a longer lifespan increases the probability of the intrinsic value increasing by any specified amount prior to expiration. 3. Volatility. Time value will vary directly with the estimated volatility, a measure of the degree of price variability of the underlying market for the remaining lifespan of the option. This relationship is a result of the fact that greater volatility raises the probability of the intrinsic value increasing by any specified amount prior to expiration. In other words, the greater the volatility, the greater the probable price range of the market. 164. Although volatility is an extremely important factor in the determination of option premium values, it should be stressed that the future volatility of a market is never precisely known until after the fact. In contrast, the time remaining until expiration and the relationship between the current market price and the strike price can be exactly specified at any juncture. Thus, volatility must always be estimated on the basis of historical volatility data. The future volatility estimate implied by market prices, i.e., option premiums, which may be higher or lower than the historical volatility, is called the implied volatility. Asterisk adapted from Jack D. Schwager, A Complete Guide to the Futures Market, John Wiley & Sons, New York, New York. 1984. 165.